Who
So
puts
we're
the data
laser
in, right?
focused on that, and how do we responsibly roll out artificial intelligence or large language models in the markets to add transparency to those markets. The continuation of a trend we've been really embarking on for more than a decade.
You go into the exchange how often?
Every day.
Will you say hi to those guys?
I absolutely will.
Post 9, they come on after. We give them our best.
I absolutely
We
will.
We wave.
We do.
Here.
And we have a little tension. You know, we're NASDAQ, we're based in the NASDAQ. But we love you, but, you know, right? We cover all our bases.
Well, we love you guys as
What
well.
what have you coded?
Ooh.
And can you help me? What is the ampersand?
I am going to date myself on the languages that I coded in.
High performance Pascal?
I did, actually.
So is
Nailed it. I don't even know what that is.
Pascal and
I thought he was
C.
an artist.
Pascal,
No
Pascal
Python.
and C.
No Python.
And importantly, C is very closer to the assembly portion of
We got to
it.
go make some money and go to commercial. We're going to be coming back in just a moment. Coming up, but one of the biggest topics here at the World Economic Forum, the future of this very topic. We're talking about artificial intelligence, from advancing technology and medical innovations to replacing jobs. We're going to talk to the co-founder of AI research lab DeepMind about AI's potential to disrupt the global economy. And then coming up at 7 a.m. Eastern Time, you don't want to miss this, JP Morgan Chase Chairman and CEO Jamie Dimon joining us for an extended interview on everything from the global risks to the future of interest rates, his meeting with President Zelensky, and more. Squawk Box coming back from Davos, Switzerland in just a moment. Welcome back to Squawk Box Live at Davos, Switzerland, of the World Economic Forum. The potential power and pitfalls of AI is top of mind here at the forum. Joining us right now is Mustafa Suleiman. He is the co-founder of AI Research Lab DeepMind, which was acquired by Google. He's now the co-founder and CEO of Inflection AI. He's also the author of The Coming Wave, Technology Power in the 21st Century's Greatest Dilemma. And we're going to talk a little bit about the perils, the opportunities, and that dilemma with Mustafa right now. Good to see you.
Great to be here, Andrew. Thanks for having me again.
So let's talk about, maybe just say what we were talking about during commercial break, AI hype. You go to the promenade, and it's quite, promenade being this street behind us, and it's like you can't, I mean, I don't know if people can see it over here, but you can't, everything's AI.
It is quite surreal. I mean, it does feel like the entire event has been rebranded the World AI Forum. Every company on the street has been leading with the fact that they're now an AI-first company. Look, I think on the face of it, that's amazing. I mean, AI is truly one of the most incredible technologies of our lifetime. But at the same time, it feels like expectations about its delivery are higher than they've ever been. And maybe we have hit a kind of peak hype for this moment. So we'll see.
The scary thing about that is that when we've hit peak hype for things in the past, that usually means there's a reckoning in the market. Are you predicting that that's to come, that the market, which has been giving huge props to anything that's labeled AI, is going to take and start digging down a little deeper to figure out what, separating the wheat from the chaff?
I don't think so. I think that this is a truly transformational technology. I mean, think about it. Everything that is of value in our world has been created by our intelligence, our ability to reason over information and make predictions. These tools do exactly that. So it's going to be very fundamental.
Let me ask you this. So Jim Breyer was on with us yesterday.
Right, yeah.
He said that he believes there's $1 trillion of market cap in Microsoft's valuation today focused solely on AI. The question is there really $1 trillion of value in that company as a function of AI? Is AI going to be a feature set that's embedded in every company? Are there going to be other companies that are going to be sort of massive winners everyone's going to lose? I mean, how does that work in your mind?
I mean, I think more than 70% of the S&P 500 use Microsoft for various cloud services. Imagine how much of that data about the way that a business operates is already embedded in their systems. And so the key goal of putting that data in there in the first place is to extract insight from the information to run things more efficiently.
But the question is, are they going to capture more share as a result? How much more is a company like a Microsoft or Google or yourself in the future going to be able to charge those companies for this service? And on the other side, clearly those companies are either going to think that they're going to create remarkably more revenue as a function of it, or going to save on the cost side in terms of workforce.
These tools do two things. They take an existing process and make it massively more efficient, and there's a huge saving there. And what I'm starting to see is business models that share in the saving and the value add that is created. But secondly, they allow us to do new things that software has never been able to do before. These tools are creative, they're empathetic, and they actually act much more like humans than a traditional relational database, where you only get out what you put in.
What does that mean for jobs in the future? I know right now it's a really tight labor market, but are they going to replace humans in the workplace in massive amounts?
I think in the long term, we have to think, over many decades, we have to think very hard about how we integrate these tools, because left completely to the market and to their own devices, these are fundamentally labor-replacing tools. They will augment us and make us smarter and more productive for the next couple decades, but in the longer term, that's an open question.
Maximum hype, but there haven't been enough public companies to be a true mania yet in terms of sucking, remember the .com, pets.com? We're nowhere near there yet. So what inning are we in before enough of the public gets to, act on the hype with a publicly traded IPO or a stock?
We are just at the very beginning of this revolution, right?
The hype about it might be there, but the stock market hype is not there yet.
That's right. And in many ways, I think that things are undervalued, because if you're a company that has amazing data, really good distribution, you control your supply chain and your customer, then these tools definitely allow you to deliver a better experience to your user. And I think that is underrated, how much that's going to change.
Ask you a question real quick. One of the things Inflection does, and you guys have talked about this, is therapists. We're just talking about psychiatrists, right? People like to interact more with his interface effectively.
Right.
Then they like to interface with an actual therapist as you're lying on the couch trying to tell them all your problems.
Because they don't think that the AI is judging them the way a person would?
Exactly right. So we make an AI called PI, which stands for Personal Intelligence, and we focused on EQ. ChatGPT and the other AIs out there focus on IQ. They're all about productivity and knowledge. We want a fluent, smooth, conversational experience, which is kind and supportive.
Or somebody just basically tells me I'm right the whole time, though?
Well, no. I mean, it occasionally pushes back. That would be super boring after a while, right? You wouldn't want to really engage with that. So it's finding the essence of when to gently push
So here's
back.
my question. If an hour with a therapist is $100 or $150 in person,
Right.
is your version in the future, if you and I create psychiatry.com,
Right.
And that's how you do this, is that $5 an hour? Or are you trying, all of a sudden it's $80 an hour and that's the margin?
Oh, I think
You
it's a
what I'm
question
saying?
of scale, though, right? So hundreds of millions of people who don't have access to kindness and support, to a really good analyst, to a project manager, to a chief of staff, to a scheduler, a personal assistant, to a financial advisor. You know, these services are only available to the top few % of us in the world today. In the future, Pi is going to be like having a high net worth family office for everybody.
But it
All
is
of
going to
these
bring down the
roles are going to be
margins for
available.
everybody else, for therapists and everybody else who are in the business.
For sure, it will create competition in that market.
You buy a dog, Andrew. I don't know what you pay for a therapist, but seriously, you should see the way my dogs look at me. I feel, I feel fine.
I love the AI therapist, though. They're never going to tell you.
I can't
they don't get
imagine
sick
that.
of
That
your
sounds
guests.
ridiculous.
They
That sounds like how. That sounds ridiculous to me. A machine.
Right.
Oh, Joe, that sounds ridiculous.
You were
Okay.
right. Andrew,
Oh, yeah,
I want to thank you. I will be sending Joe my therapist bill. Thank you very, very much.
This has been great. Thank you, Andrew. Thanks, Sean.
I'm why you
Thank
have a
you.
therapist, I think, right?
All right, when we come back this morning, Secretary of State Antony Blinken with the reaction to the Taiwan election and the trouble in the Red Sea that's impacting trade and raising tension levels with Iran. Squawk Box will be right back.
Welcome back to Squawk Box. We are live at the World Economic Forum in Davos. Yesterday, I spoke to U.S. Secretary of State Antony Blinken in his first interview since the election results in Taiwan. This is what he had to say about the relationship now.
Thousands of ships have had to reroute, move around and away from the Suez Canal. It's adding costs to everyone. Insurance costs are going up, shipping times are going up. That means that whatever's being shipped is getting more expensive. This has been an attack on international commerce, international shipping, not an attack on Israel, not an attack on the United States. That's why more than 40 countries came together to condemn what the Houthis were doing. It's why other countries came together to say, if this continues, there are going to be consequences, not for purposes of escalating, but for purposes of getting them to stop.
We flipped the sound there just for a moment. That was obviously a conversation about what was happening with the Houthis in Yemen.
I mean, that's really interesting. What's happening in the Red Sea and where this could go, because the escalation continues.
And that's what he's worried about.
Yeah.
Let's show you the video we were hoping to show you about the relationship between U.S. and China in the aftermath of this election in Taiwan.
When it comes to Taiwan itself and when it comes to cross-strait relations, we've been focused on one thing, and one thing intensely, with many other countries around the world. Peace, stability, no change to the status quo, the peaceful resolution of any differences. And there's a reason that matters, and it matters to virtually everyone here in Davos. You know this. 50% of the world's commerce every single day goes through that strait. The semiconductors made on Taiwan are powering the world in every conceivable way. If that's interrupted or disrupted in any way, it's bad for everyone.
The full interview with Secretary Blinken is available at CNBC.com, and it'll be released as a special episode on the Squawk Pod later this morning. Also worth noting, you know, there's a huge Chinese delegation here. He did not meet with that delegation while he was here. There were a lot of people trying to read the tea leaves of what was happening when he made his, when the Taiwan president was first announced after the election, he sent a congratulatory note. The Chinese put out a statement saying that was an escalation between the countries. He said he thought he was doing the right thing. Then President Biden came back on the other side and said, we don't want there to be independence. We don't want Taiwan independence.
Right.
So we got into a whole conversation about that. I hope you have the opportunity to watch that video.
Is the speculation then that they didn't meet with the Chinese delegation because the Chinese delegation is still mad?
Unclear. He said that he had just met with some of the Chinese before the election, which is true, literally a week ago.
I remember.
And said that there was no plan to have a meeting, but nonetheless, a lot of people obviously hear whisper about what they think is going on.
Well, instead of Biden having to do the strategic ambiguity, you got the two-pronged strategic ambiguity. You know what the hell they're, and that's what we want, because we can't really decide. Coming up, we're going to get into into the AI race with Cisco CEO Chuck Robbins and what it means for his company and the global tech economy. Squawk Box is coming right back.
Welcome back, everybody. Companies across the globe are trying to keep up in the AI race, and our next guest is in charge of a company that is no exception to this. Joining us right now is Cisco's chairman and CEO, Chuck Robbins. He is also the newly appointed chairman of the Business Roundtable. And Chuck, first of all, thank you for being here with us.
Thanks for having me.
We
Yeah, quite the lineup today.
Yeah, we do. We just finished a really interesting conversation talking about AI, and this is a huge issue for you all too. What are you doing right now? What can clients actually expect when they're using Cisco's AI? How are you guys doing this ahead of the Splunk acquisition?
Well, we have, first of all, we've been doing predictive AI for a decade, right? Because people confuse the two, and it's basically machine learning and just creating really great analytics around things that are likely going to happen. We've used AI in our WebEx portfolio. We've used it in other places. And now we're doing a lot of things that other companies are doing as well. We're building assistants to create natural language processor interfaces to our technology versus having to type on a command line or some sort of technical interface, as well as we'll use it to deliver a better customer service experience for our customers, et cetera. And then we're also working right now we're certainly working on the infrastructure underneath the GPUs that's required in the large language models like in the web scale space. But we're also in preliminary work right now on what does an enterprise infrastructure stack look like that'll allow them to run inference and those sorts of things at the edge. So there's a lot going on.
One of the things people have been wondering is what happens with Splunk. End of the year, that's a closer to the end of the year integration into the company. What will be different with that? It's the biggest acquisition you all have ever
It is by a long shot, and we're really excited about it. So if you think about what Splunk's going to do for us, it's going to do several things. Number one, they have this security data platform that ingests lots of security information that's going on inside their customers. And then we have an extended detection and response system that correlates threats in real time to give our customers insight.
So know exactly what's happening if there's something weird happening.
So we lay our detection and response team, our platform, on top of all their data that they have. The ability to provide insights to customers in a very rapid time frame is going to be super important. And we also have, there's an emerging space around observability. And we also will converge our portfolios in that space to bring customers a better set of insights around what's going on in their technology infrastructure. And then over time, Splunk will actually just become the data platform for the entire company.
I know that you are in a quiet period right now ahead of earnings, but the biggest question on the street has to be surrounding what's going on with the company since you issued guidance, lowered expectations for the current quarter, and said it's because your customers are still trying to put in place and implement all the things that they've been buying for 3 or 4 quarters before that. What can you tell us just around what you're seeing from customers, what the landscape looks like?
Well, what I would tell you is that what we said we expected on the last earnings call is playing out the way we thought it would.
Okay.
And so if I think about the calendar year, I think we're going to get through the end of this supply chain challenge. We're going to get through this digestion phase that we talked about. And again, none of us had ever gone through this before, so we didn't anticipate it, although you could argue that the PC and storage markets, I think, saw the same thing a couple of years earlier. But I think you're going to we're going to get back to normal ordering lead times for sure, and I think we'll see our customers get back to normal ordering this year.
So this was really just like the pig and the python with the...
I mean, the cloud providers had bought so much inventory that they're deploying it now, and as lead time shrunk, they don't need to order it in advance as much as they used to, so we're just having this little lull. But I think it's going to get back to normal this year.
Okay, we had Jim Breyer on yesterday, and he said that on air that Cisco is a value company now, not a growth play. I followed up with him afterwards to talk more about it. He said he thinks Cisco is a compelling value today if they keep making strategic acquisitions and folding the talent of technologies into their platform. He said he thinks you do a great job. But what would you say to that, just in terms of the acquisitions? You think they can keep coming? What's your plan?
Well, I think we're a valuable company that's going to grow. How about that? We'll have a variation for Jim. But yeah, we'll continue. Our M&A strategy hasn't changed. Obviously, we're going to be very focused on ensuring that we do the integration properly with Splunk. So we'll probably stay very focused on that for some period of time. We'll still do tech and talent acquisitions. And in today's world, things are moving so quickly, and particularly we talked about AI already. There may be tech and talent acquisitions we need to do in that space. We've already done several. So we actually have a lot of AI talent that we've brought in through our collaboration portfolio and our security portfolio. But our strategy won't change.
Okay. Chuck, I want to thank you for joining us out here today. If there's one thing that you've taken away from the conference so far, what would that be?
AI?
Yeah.
I think everybody believes we're much further along with AI than we really are. We're really it's so early right now. We don't even know what the applications and the use cases are ultimately going to be. We know some, but not the killer enterprise apps are still yet to be determined.
Okay. Chuck Robbins from Cisco.
Thank you. Appreciate it.
When we come back, JP Morgan Chase Chairman and CEO Jamie Dimon will join us right after this quick break. Squawk Box will be right back.
NBC.
Good morning from the World Economic Forum in Davos, Switzerland, where world leaders and business titans are gathering to discuss the biggest issues facing the global economy. In this hour, we'll be hearing from JP Morgan Chairman and CEO Jamie Dimon on the markets, the global economy, and just about anything else we can think of. Plus, philanthropist and Carlyle Group co-founder David Rubenstein will join us to talk about the Fed's inflation fight and much more. The second hour of Squawk Box begins right now.
No.
Is you?
No. Whoa, whoa. Good morning. Welcome back to Squawk Box. Yeah, caught up on CNBC live from the World Economic Forum in Davos, Switzerland. I'm Joe Kernan, along with Becky Quick, Andrew Ross Sorkin, and Jamie Dimon. He's here, but you can't see him on that shot. We'll get to him in a second. Here are the futures. We're going to take a quick look because we're down again. We were down yesterday. I'm not going to spend too much time here. Down about 147 points now. on the Dow. We will look at treasuries, though. I think 405 was what we were, the last level that we saw, 406 now on the 10-year. And Bitcoin, no, we're not going to do that. But Bitcoin, I think, is around 43,000 or so. It's actually down, must be in the 42s if it's down 555.
Dipped a little bit. We'll talk about that in a little bit. But our first headliner of the morning, as Joe kept alluding to, JP Morgan CEO Jamie Dimon is here. There's about 100 things we want to talk to you about. And it's nice to see you, sir.
Great to be here again.
But I'll tell you where I want to start, because I see that you have the Ukrainian flag there on your lapel.
Yep.
And you spent some time with President Zelensky yesterday.
I did.
Tell us about that meeting.
You know, he came and met with a bunch of, first of all, thrilled to be here, all of you and around the world. You know, he came and met with a bunch of business leaders and people who can help think about refinancing the redevelopment of Ukraine after this terrible war is ended. So they're starting to think ahead. So a lot of people, how do you set up structure and stuff like that. But you know, my heart goes out to the guy. I mean, people forget that every day he wakes up in the morning, there's a 600-mile front. There's 1 million soldiers fighting off, Russians. They've had 300,000 casualties so far. This may go on for longer. We have to help them. We have to teach the American public that this is about freedom and democracy for the free world, and that's where the battle's being fought. And so I hope our government gets together and finally passes these new bills, et cetera. So I just want to show my support for Ukraine.
Do you think that's a message that is going to get broad support back in the United States? Because clearly there is a huge polarized split on this. In fact, when I talked to Zelensky later in the day, we talked about the prospect of former President Trump becoming the president again and what that would mean for the support or actually lack of support for Ukraine in the future.
I think American leadership has to explain to the American public why it's important. Has to remind them of what happened in 1917. Has to remind them what happened in 1941. And so while, America, we have to protect America, this is America first. This is the battle zone of democracy and freedom and free enterprise is affecting all other relations in the world. A Russian victory could cause huge problems that might, I may write an op-ed on how the West lost. And, and looking back for 2050, is did we keep together the alliances, the democracies? We have to put trade back on the table. That's how important this is.
But what do you, what do you
point.
say to the politicians back in the U.S. and even politicians in other countries around the world who say, look, we have our own problems back home. We've got immigration issues, other things that cost money. We have other crises that we have to contend with that we have to pay for, whether it be what's happening in Gaza or other places around the world. And where do you, in this sort of stack prioritization, do you put Ukraine?
Very high up. I think Ukraine is about whether the world is free and maybe about whether the world is free and safe for democracy for 100 years. We are screwing up tons of other things, including immigration, but life isn't either or. So you can't say, well, we'll do this and do that. You're dealt the hand you're dealt, and you got to deal with it. And so we should be very clear about helping the lower income population. No country, every country's got to control the borders, and we have to control the borders. And so. So they're all important.
Would you take the deal that the Republicans have put on the table, though, which is we want this border immigration policy as we've laid out, and then we'll fund the rest? Would you rather take that than neither?
I have not read that deal in total, but I probably would take it. Yeah. We have to control the borders. Yeah. We need more merit-based immigration. We need more seasonal immigration. We need more. We need DACA have a place here. We need a path to citizenship. If you do not control the borders, you are going to destroy our country. And so I think the people who think that somehow this is okay, so now they're sending the migrants into New York and stuff like that. So all of my super liberal friends, now they realize what a problem is. Did it have to be that? That we realize it. So we want to have a big heart for the world, but we have to control the borders.
I mean, do you view Putin's intentions as beyond Ukraine? I mean, there are some people that think that he wants the great Russia. He feels like it's been, I don't want to say castrated, but it's certainly not the Soviet Union anymore, Mother Russia. So he wants to bring some of that back. You don't think that there's certain parts that he would stop? You think Poland's next? You think that there are larger intentions that are going to come? Because that almost a domino there, because we've had those.
Yeah, I would defer a little bit to people like Condi Rice and Bob Gates and all these folks who are experts. He clearly has designs in a bigger, broader Russia, stuff like that. And, we don't exactly know if he wins something there, what he's going to do next. Why take a chance?
Right.
I'm not looking at it. You have to know the answer. we do know if we don't take a chance, we're better off than we do take a chance. So, and it's not, and this is also, remember, this is also about Iran, North Korea. I think it's about how how China positions itself over time.
Well, that's where I was going to go next, because we talked to Tony Blinken just yesterday about China and the relationship that the U.S. has with China and the prospect of them effectively taking over Taiwan in the next, call it, several years.
Yeah.
What do you think the prospect of that is, and how do you think that multinational businesses are supposed to react or think about that risk?
Yeah, so we met with the Chinese premier yesterday, and look, I'm going to defer to Tony Blinken. You know, the chance of a Taiwan war in the next 5 years, everyone says, is rather low for a whole bunch of different reasons. You know, China may one day have to take sides. They haven't done that. You know, that we shouldn't force them to, because we can't tell other nations that how they should behave or how they should act. But I would look at China holistically. You know, the Western alliance, democracy, should stay together, keep it free, but we have to do trade, diplomacy, development, finance. Like, we are not all over Africa and Latin America like we should be. Now, Tony Blinken actually set up a meeting with Janet Yellen and a bunch of big financial companies about how to help generate more development finance with the World Bank. With the, you know, but here you need private capital. Private capital dwarfs what these multinational institutions can do. So it's a holistic view. There is no simple way to deal with China and the rest of this world. But if we do it holistically, you know, you guys heard me. We have the better hand. We have food, water, energy, the most prosperous nation the world's ever seen.
How challenged do you think the Chinese economy is right now? And that's one of the reasons, and we heard last year actually from the president of Taiwan, one of the reasons she thinks that actually China won't try to take the country is because they have to deal with their own challenges at home.
I think there's some truth to that, but I think it's good they're here. You know, I mean, I think they're trying to make sure that they're open for business, that they're being fair to foreign companies. You saw that foreign direct investment for the first time, kind of ever, I think, since WTO was negative this year, and direct investment is down, and so they need to invigorate their own economy for their own citizens, their own growth, their own people, and that may very well play into their geopolitical view.
But do you, I mean, the message is that they're open for business now. I think people who have gotten burned in the past may be a little reticent before they're willing to invest more into it.
They have, so take financial services, they've been very consistent in opening up. Took a long time, so we have full license there now, but I think, you know, anyone who's looking at investing there has to be a little worried. So, and you know, the risk reward has changed dramatically. You know, and of course, you know, it's a company like J.P. Morgan. You know, I always say when it comes to foreign policy, Blinken decides and the president. You know, I salute. I'm an American patriot, but they want us there. They're not asking American companies to leave. And you know, being a premier bank in China helps us educate the government. It helps us educate the world about China. We bank, I'm going to say, 1,000 multinationals in China. So we obviously got to be very careful. And the laws have changed, and we have to change with the laws, both in China and America, and we're actively doing that.
How do you see the U.S. economy playing itself out over the next 12 months? This is an election year. We've been talking a lot about what just took place in Iowa, and trying to understand how the American public is going to feel about the economy may ultimately dictate how the president is decided.
Yes, I agree with that. I think it's a mistake to assume that everything's hunky-dory. And, you know, and when stock markets are up, it's kind of like this little drug we all feel. Like, it's just great, you know. But remember, we've had so much fiscal and monetary stimulation, so I'm a little more on the cautious side, that we are facing a lot of things in 24 or 25. And we mentioned Ukraine, the terrorist activity in Israel, the Red Sea, quantitative tightening, which I still question if we understand exactly how that works. I don't think we do. How QE actually worked, what the effect of negative, you know, zero rates was for all this time. And obviously the politics, and you know, and then the Ukrainian war is affecting oil, gas, food, migration. So you have all these very powerful forces that are going to be affecting us in 24 and 25. So if I was the government, I would be preparing for what I'm going to do about that, assuming things aren't good. And I just also want to point out, I wish the Democrats would think a little more carefully when they talk about MAGA. You know, and if you travel this country. You know, and the country's unbelievable. We took our bus trip this year, and Leslie Picker was on Spokane and Boise and Bozeman. People are growing. They're hungry to grow. They're innovating. It's everywhere. It's not just Silicon Valley. So we've got this great hand. But when people say MAGA, they're actually looking at people voting for Trump, and they think they're voting, and they're basically scapegoating them, that you are like him. But I don't think they're voting for Trump because of his family values. And if you look, just take a step back, be honest. He was kind of right about NATO, kind of right about immigration. He grew the economy quite well.
China virus.
Tax reform worked. He was right about some of China. I don't like what he did.
No, I said China virus.
Yeah, I understand. He may have been right. And I don't like how he said things about Mexico. I don't like, but he wasn't wrong about some of these critical issues, and that's why they're voting for him. And I think people should be a little more respectful of our fellow citizens. And when you guys have people up here, you should always ask the why. Not like it's a binary thing. You're supporting Trump, you're not supporting Trump. Why are you supporting
It's hard to hate
Trump?
75 million of your fellow Americans.
I agree.
It's done
And you know, the Democrats have done a pretty good job with the deplorables, hugging onto their Bibles and their beer and their guns. I mean, really, like, could we just stop that stuff and actually grow up and treat other people with respect and listen to them a little bit? And I do think the economy will affect, and I think this negative talk about MAGA is going to hurt Biden's election campaign.
I just want to ask you back to the 34 trillion that we got, because it seemed like when rates were going up and we thought the Fed was going to keep going higher for longer, it looked like some of that was coming home to roost because the auctions weren't going well. It's like, wow, debt service is much more expensive. This is going to hurt. Suddenly the pat answer is, wow, we're already through that. Rates are coming down again. So the 34 trillion suddenly is okay again, and I don't think it works that way.
Yeah, I think people are making a mistake. I think it is going to come to bite. You know, that could be in 3 years or 5 years or 7 years. I think it may very well bite in the markets way before that, because the market makers don't have because of regulations, don't have the capability to make markets like you used to. So we can easily handle it, but we're restricted by all these rules. And you're absolutely correct. If my numbers are right, in 1980, debt to GDP was 35%. We spent 5% of the deficit because of recession. Now debt to the GDP is 100%. The deficit's 6%, and it's in a boom time. And of course, it feels pretty good because we spend all that money. It seems to be working. I think governments are starting to feel a little omnipotent, and central banks. I'd be much more cautious about them.
Because we don't use the word crowding out anymore. Doesn't the private sector get crowded out?
Don't know until it happens. And like I said, we feel good. You know, when the government spends $1 trillion more, what happens? People have more money in their pockets.
Right.
Corporate profits go up. People spend more. Stock markets go up. It creates liquidity.
No money on that, though.
Exactly.
There's a lot of money that's going to continue to be spent on bills that have already been passed this next year. Your outlook for the economy is so different than what we've heard for so many people that it worries me, because we make the case that a lot of times Davos is the antithesis in terms of they're always wrong on what they're predicting on things. Are you making these predictions as a premier risk assessor, somebody who's looking at these things, or are you making this thing as an idea of this is the more likely case?
No, a risk assessor. I mean, it's a very important distinction, is that you got to look at all these factors, and you got to look at different points in time. You can't look at, oh, it feels pretty good today. And so a lot of people, when you come up here, it's about how they feel, their order book, what they see. But these forces you mentioned, like when I look at inflation, the green economy is inflationary, the IRA Act's inflationary, whatever restructuring trade happens inflationary, the remilitarization of the world's inflationary, deficits are inflationary, and that you can't sit here and say that won't have any effect at all. Right. And that stuff is cumulative. Right. It's like you guys saw this article recently about the cumulative negative effect on work from home on young people. Well, we spoke about that 2 years ago. You can kind of see that these kids aren't coming in, they're not meeting people, they're not learning enough. So do you have to wait for it to actually happen to figure out that might be what happens?
Yeah.
I want to go back to your comments about Biden and Trump, because you effectively made a case for Trump in some ways. I
made a case for respect of Trump's voters.
So we had Bill Ackman on the program last week, who's wanted you to be run for president for a very long time, as you know, and he's been a longtime Democrat. Yeah. And he effectively said that he thought that Biden was just too old, and effectively opened the door to possibly voting for President Trump. I'm curious, when you just look at the candidates as a CEO of a multinational global business, what you think would be better for the business?
Yeah. Remember when I gave opinions in the UK, I got nasty emails from all the people in the UK, like, leave, get out of here, Yankee, who would have you right. I have to be prepared for both. I will be prepared for both. We will deal with both. My company will survive and thrive in both. I hope the country survives in both. And so, and I hope whoever it is, is respectful of other people, and it's not about retribution, it's about growing the economy and helping people. And, if you talk about America first, I always say, no president's going to run for president and say, America second.
America.
Well, of course it's America first, but America first has multiple different reasons, which has changed over time. And when Washington was president, don't get involved in European things. Well, we got involved, two major ones, to save the world for democracy and freedom. And this country is the arsenal of democracy and the bastion of freedom. So, I hope whoever's president does that. And so,
Could we pivot to a topic that I know you find sort of laborious at this point?
It's a good word.
Which is Bitcoin.
Yeah.
This ETF was approved just about a week ago now, and I think a lot of people are trying to understand what it ultimately means.
Yeah.
JP Morgan, I imagine if you were a client of JP Morgan, you could call your broker and say, get me some of this ETF. What are you telling your brokers to tell them back when they make that call?
Yeah. So this is an important thing. This is the last time I've ever talked about this in CNBC, okay? So help me God. Blockchain is real. It's a technology. We use it. It's going to move money. It's going to move data. It's efficient. We've been talking about that for 12 years, too, and it's very small, okay? So I think we've wasted too many words in that. Cryptocurrencies, there are two types. There's a cryptocurrency which might actually do something. Think of a cryptocurrency as an embedded smart contract in it, and then we can use it to buy and sell real estate and move data. That may have value.
The idea of tokenizing things.
Tokenizing things that you do something with. And then there's one which does nothing. I call it the pet rock, the Bitcoin or something like that. And so on the Bitcoin, there's, first of all, and I'm not trying to make a joke here. There are use cases, AML, fraud, anti-money laundering, tax avoidance, sex trafficking. Those are real use cases, and you see it being used for hundreds, maybe 50 or $100 billion a year for that. That is the end use case. Everything else is people train among themselves. So
Speculate.
Yeah. Now, okay. Now, my last statement. The last time I ever talk about Bitcoin is I defend your right to do Bitcoin. I think, it's okay. I don't want to tell you what to do. So my personal advice is you don't get involved. But I don't want to tell any one of you what to do. It's a free country.
What do you make of BlackRock? What do you make of the other firms, the BlackRocks of the world that obviously, and Larry Fink changed his view of this, obviously.
Yeah.
And maybe he changed his view because you think he genuinely believes in Bitcoin, or believed it because he thinks that there's a marketplace for it and he wants to be part of that market. But what do you think of there's about a dozen big financial companies, Fidelity included.
Number one, I don't care. So just please stop talking about this shit. And I don't know what he would say about blockchain versus currencies that do something versus Bitcoin that does nothing. It may be not different than me. But this is what makes a market. People have opinions. This is the last time I'm ever going to state my opinion.
Gold really didn't do anything either.
Yeah, but gold's limited in supply.
So is Bitcoin.
And it's been used. So you think so, huh?
I do.
I think there's a good chance that when we get to that 20 million Bitcoins,
they go to 42.
No, that Satoshi's going to come on there, laugh hysterically, go quiet, all Bitcoin's going to be erased.
I think we have.
How the hell do you know it's going to stop at 21? I've never met one person who told me they know for a fact they take that as...
Mathematically, it can't happen because by the last one will be mined in 2150, and it gets harder and harder every time there's another halving. But Jamie, looking back over,
you guys do what you want, I'll do what I want.
As for gold, you can the 6 characteristics that make gold valuable for 4,000 years. They're all present in Bitcoin. That's all I'll say. And I love you, and I don't want to. And I also don't want to be a.
Joe, you may be right.
Yeah.
I don't own gold either, so okay.
That's what I mean.
Couple of quick final questions.
I like to own things that pay me incomes. It doesn't cost money to carry. Anyway, and it costs money to carry Bitcoin too, by the way.
We've talked a lot about commercial real estate here in Davos. There was a big 60 Minutes piece on Sunday.
Oh yeah, but I think there's another risk to Bitcoin. If you can't solve the bad use cases, the government's probably going to have to close it down. So that
the thing about the money laundering, you can look at, here's the number was 20,000, I think, for U.S. dollars in money laundering, and it was 35 for how much is done with Bitcoin. So at this point, the dominant, I know, but the dominant,
know about.
Historically, the dominant currency for money laundering has been U.S.
I understand.
Okay.
Quickly, commercial real estate.
Yeah.
Do you have a take? We've been talking to a number of investors who've been sitting here talking about what it means to the debt markets, what it means to some of the smaller banks. Obviously, you have a big building going up, by the way, in New York, but the 3-day week, what that's going to mean longer term.
Yeah. So, first of all, I think the value of all financial assets in America is like 140 trillion. Commercial office real estate is like 1.2 trillion.
Okay.
600 billion on bank books. A lot of that is corporate owned and stuff like that. let me divide into three pieces. If we have a soft landing, which is possible, and rates don't go higher, which is possible, it'll be a small problem. If we have a hard landing and rates don't go higher, it'll be a bigger problem. And if we have a hard landing with higher rates, which I still think is possible, it'll be a bigger problem.
Because
That's all.
inflation goes up even with the lower-
Interest rates are like cosmological constant.
Yeah.
Anything which has cash flows is worth less. And obviously, if there's a recession, less need for space and all the things that happen in recession and stuff like that. So, and I don't know how it's going to affect. Work from home is a whole different thing. Our building's unbelievable. If you haven't
Yep.
seen it, walk by.
It's going up quick.
Yeah.
You know what I love about you, Jim, and I've told you this many times. You said one time, I'm just barely a Democrat. Today, all the things you said about MAGA, what you're saying is really to try to help the Democratic Party, because it's tough love is what you're using. You are not MAGA. You're not going to turn into a Republican, I don't think. But you realize...
I always say I have a Democratic heart and a Republican brain.
Exactly.
And I do think more and more the Republicans, that the Democrats have big hearts and very small brains. They should be a little more thoughtful about policy
If
and
on
how
the
things
front
work.
end, if on the front end, all of the things you're doing to try and help people actually on the back end end up hurting them, you need to cop to that someday,
Okay.
eventually, and they don't.
I'll come confess here if that.
No, not you.
No,
I'm saying the
you're talking about you.
Democratic
Oh,
Party.
I
No,
get
I'm not talking about you.
Yeah.
The Democratic Party needs to say, look, we try all these things and we made things worse. So, at least cop to it.
I just also want to point, when I go to DC all the time, remember, we spend a lot of time on, I would call the wing nuts. There are a lot of centrist Republicans, Democrats, who,
Yeah.
if they sat here, you'd have.
It might be a
Why
majority, it
don't
might
they
be
speak-
80%.
why don't they speak
It might be-
louder? I don't understand.
Well, partially, you guys invite the wing nuts on
No,
more.
we
than,
invite the
not
others.
you guys. I'm talking about you. I'm talking about like CNN and
just
Fox
gave you a
and
half
stuff like
hour.
that, yeah. Yeah, I'm gonna start charging you guys. By the way,
Jamie Dimon, thank
20
you
minutes.
very, very much for joining
Thank
us.
you. Enjoyed it.
Right.
Appreciate it. Thank you again.
thank you.
All right, when we come back, Carlisle Group's David Rubenstein will join us. Squawk Box will be back after a quick break.
You're watching Squawk Box live from the World Economic Forum, and this is CNBC.
%50 off.
Time now for today's Aflac trivia question. The World Economic Forum was founded in 1971 by what business professor? The answer when Squawk Box returns.
Confidence.
And now the answer to today's Aflac trivia question. The World Economic Forum was founded in 1971 by what business professor? The answer, Klaus Schwab.
Welcome back to Squawk Box, right here at the World Economic Forum in Davos, Switzerland. Earlier today, I spoke to Palantir co-founder and CEO Alex Karp in a wide-ranging interview. Here's a moment we want to show you from that interview.
We had a movement I think is fading away, largely understood as wokeism, where people said, quite frankly, in public, lots of things that no one believed they believed in private. Now with Israel, most people in positions of authority realize that what happened on October 7th was one of the worst terror attacks the West has ever seen, arguably the worst act of terrorism and sexual barbarism the world has seen in 100 years. And it is incumbent on us to actually not only speak loudly in private, but occasionally show what we mean in public. People want to talk about rebuilding trust, the elite. No one trusts the elite. Yes, but how could you trust the elite if everything you're saying is a half-truth at best?
Let me ask you about what's happening here in Davos, because one of the conversations that we have not seen in large part is one about what's really happening on the ground in Israel, a conversation about anti-Semitism, the same conversation that's happening in institutions all over the world, but it doesn't seem to be here yet. I know the second gentleman is going to be here from the White House tomorrow. There's going to be some conversation about this, but it seems so very limited.
I am living, Davos has an important function. I live on a different planet. The most important issue of our time is war and peace, and the absolute most important metaphor for that is, what do you think about what happened in Israel? And by the way, anti-Semitism as a kind of prejudice has always been the canary in the coal mine for your society isn't working, your university isn't working, you're not providing real growth to your population, and because you're not explaining why it doesn't work, you just go blame the Jews. And so, like, any any enterprise that's about making the world a better place that doesn't deal with these issues is basically saying, I'm not really engaging in the problem.
Alex Karp never one to hold back, and we're going to bring you that full interview with Alex Karp tomorrow right here on Squawk Box. And boy, does he not hold back. He gets into a lot of other topics beyond this. So
Good. I can't wait to see it.
It was. You have to. You look at the way the world's been for 2,000 years, and you remember the hordes that would go from town to town and kill everyone in that town, or take them slaves and rape all the women and cut off heads. That was thousands. That happened. That happened again. That barbarism is just beyond anything we can comprehend. And the reaction to it, as Alex just pointed out on our college campuses, at first it's just hard to figure out, and then it's just disgusting and it makes me sick. So, I mean, and he says those things. And he said it very, very.
Said it very, very eloquently.
Kind of like the woke stuff too. That you're saying things that you really don't. None of it. You actually.
Well, and that was so interesting because he believes that so much of the last couple of years of the public statements that companies said were sort of, as in his mind, half truths.
Yeah.
And so how is it possible they can go down that road? And
Well, the idea of a lack in trust, he's right. He makes a very good point that if you are dealing in half truths at best with everything you say, yes, that's why people don't believe you, because they know that. Up next, folks, Carlisle's David Rubenstein is here. He's going to talk the Fed, the economy, and much more with us. By the way, if you're watching the futures this morning, they've been under some pressure. Dow futures off by 120, the NASDAQ down 55. S&P futures off by 16, and this comes after two sessions in a row of declines. Also, be sure to follow Squawk Pod for special episodes all this week featuring the best of our Davos conversations in audio form. We'll be publishing multiple episodes of Squawk Pod Reports Davos every day. Just hit that follow or subscribe button on your favorite podcast app and you can listen anytime. Squawk Box will be right back.
Back.
Welcome back to Squawk Box, live from the World Economic Forum in Davos, Switzerland.
And now for a look at the Fed's rate path, the investing landscape, and more. Let's welcome David Rubenstein, Carlyle Group co-founder and co-chairman. Carlyle Group is one of the biggest private equity firms in the world, managing $382 billion globally. David, it's good to see you. He's like a media star. You do what we do in your spare time.
I'm trying to learn from you.
Yeah, exactly. Learn what not to do. We did have Jamie on and had we talked about a lot of things, obviously, but I think it really does matter what happens with rates this year,
Right.
because built into the market, it's either 6 or 7, or when some people think there'll be 3, and we actually had the idea broached there could be still be a hike. So we don't know, but it matters because of what's in the market right now.
Nobody really knows, of course, and trying to predict what this Fed's going to do is difficult. But the Fed does generally telegraph what it's going to do pretty much
They
in
don't
advance.
know what the economy is going to do, and that's what we
They're
need
very
to know.
Well, look, Jay Powell says, I'm very data-driven. The Fed is data-driven, so they'll look at what the data says. Right now, it's too early to say.
You need to tell me what the data is going to be.
Well, they're not going to make their next decision until March. So they'll have a meeting in January, but they'll just look at the data and they'll wait until March before they do anything, almost certainly. The concern that I've had is that when you get into a presidential election year, it's very difficult to cut rates when you're right in the middle of a presidential election season, because the party that's out of power will say, well, you're trying to help the party in power.
Right.
Now, Jay Powell is a Republican. Presumably he's not trying to help Biden, but he's trying to do what's right for the country. So if he starts cutting rates significantly in September, October, November, or before the election November, people will say, well, you're helping the Democrats. And I don't think he wants that.
We have a whole Phillips curve. We don't even know whether we believe that anymore. And we just had a conversation. The Fed, maybe if it focused solely on inflation, that'd be one thing. But when it almost seems like they won't feel that they've accomplished their goals unless unemployment goes up, I'm just not sure that that has to be the case. Is it possible to have low inflation and leave unemployment where it is?
Well, the law was changed when I was in government so that the Fed has to worry about not only inflation, but also by unemployment. However, Fed chairs are known in history for what they did on inflation, either getting it up or getting it down. And I think Paul Volcker's famous for not worrying about unemployment, but worrying about inflation rate, and he got it down. I think Jay Powell will go down in history for having done a good job if he gets the inflation rate down to close to 2%.
David, I'm still kicking around in my head something that Jamie just laid out, the 3 case scenarios for the economy. And one of those scenarios he laid out is a hard landing and higher rates, because inflation is still out there and something the Fed says that they have to fight first. How likely of a
There's
scenario?
always possibilities, and predicting what the Fed's going to do or what the economy is going to do 10 months in advance is very difficult to do. Right now, I think most people would say the hard landing scenario is not really something they're worried about. Most people would say that the Fed kind of dodged that reasonably well. Maybe the Fed doesn't deserve all the credit. Most people would say the question is whether it's going to be a soft landing, which is what we're looking like we're having, and whether we're going to have really good growth next year. In 2023, the growth rate is probably going to be about 2.5%. So we're pulling away from the rest of the world. And when COVID occurred, we were all in trouble. Now, China hasn't really pulled away, and Europe hasn't pulled away. But the United States is really growing quite nicely. I like to think it's because private equity people are giving good techniques to business CEOs and so forth.
That's it.
But whatever the reason is, there's no doubt that the U.S. economy is in a league by itself. Now, it won't stay that way forever. And clearly, if inflation becomes much higher than we expect it will be, there will be a problem. But right now, it seems to be on a downward trajectory.
No, we don't want to go there. Do you think that private equity is so important to the health of the country that you guys should get special treatment still? We always get to that.
I didn't say that. I would say, obviously, I say some things that are tongue-in-cheek, but clearly, the revolution of private equity that really changed the U.S. economy beginning in the 1960s, 70s, 80s, which is to pay much more attention to things that people weren't paying attention to in the 40s and 50s. In the 40s and 50s, the business community was much different. It was not as diverse as it is now. It wasn't paying attention to the kind of things that private equity do. And the techniques that private equity develop are used now by CEOs who are not in private equity firms. So I think we deserve some credit.
But there's no doubt. And you'd rather have, if you have to lay off a quarter of employees to keep a company solvent and to be successful and to be here in 5 years, it's sad, but 25 got to go. I wonder about the combination of AI.
That's where I was going to go.
No one might be left.
Well, nobody really knows where AI is taking us, nobody. And therefore, it's like at the beginning of the age of the internet. We don't really know what the internet was going to produce, and look, it produced some companies that are spectacular and some that didn't work as well as people thought. AI will change things dramatically, but we don't know really what it's going to do yet.
Change your business though at all yet?
It has, because we're spending a lot of time on AI. We do a lot on AI with OpenAI, trying to figure out what deals are going to make sense, what things we should do with the companies we buy. For example, AI can really help you figure out whether a company is worth buying or not. Is it likely to fall into a certain trap or not? You know, you have to depend on human brain still, but the AI can be very helpful.
If that's the case, though, is everybody going to be competing? Is it going to make buying companies that much harder if everybody's using that large language model that basically does what your brain does right now?
Well, everybody's been using the same techniques for the last X number of years, so now we'll use a different technique that'll be available to everybody. But you have to make your own judgment. In the end, AI can tell you something. You have your own intuition, your own gut, and you're still going to rely on it. Warren Buffett, your friend, you think he's going to rely on AI to make decisions?
No.
Right. So a lot of the really great investors are not going to look on AI. They might be intrigued by it, but they'll make decisions on their gut, and that's what usually works out pretty well for people like Warren Buffett.
I have to ask. So you know the president, you know him well. Have you talked to him about carried interest? Would he like to get rid of that and raise some revenue? Do you know?
I have never talked to any president of the United States about carried interest.
You never have. Why?
Because I think
See them all the time.
I think they have more important things to worry about.
If you don't bring it up, you hope they won't think about it.
I think they have more important things to worry about. I know carried interest seems important to people on this show,
Right.
but
Can I ask a question
it's
about
not that
Can I
important.
ask a different question? I agree. It's not important in the context of how much money it would raise at all. But given
Optics.
the optics and the trust, talk about public trust. Part of Davos is about restoring trust. Big institutions restoring trust.
Right.
Restoring trust just in the private equity industry. And as somebody who's spent as much money as you have donating your money around the country and trying to build, rebuild the monument, to do all these things to make America better, great again, whatever you want to say. Is there no part of you that says, you know what, from a public trust perspective, if you believe that the tax code is a manifestation of the democracy that we're supposed to have, that, you know what, I should fall on this sword. And not only should I fall on the sword, I should actually say, you know what, we shouldn't have this.
Well, I've structured my affairs. I don't get carried interest myself.
I know, but I'm sure. But your friends don't feel that way.
Well, I look at it this way. There are so many things in the tax code that are egregious and should be changed that, as Jimmy Carter, my former boss, said, the tax code is a disgrace to the human race. He used to say it all the time, but we couldn't get tax code reform really through. The tax code is replete with a lot of problems. If we could get rid of a lot of other problems bigger than the carried interest, and I wouldn't say that's a problem, but there are many things that are much more important to deal with than carried interest in my view. Carried interest affects a relatively small group of people.
Right, but the highest net worth people in the country, and the rest of the country looks upon you.
It picks up no revenue. It picks up virtually no revenue. The reason members don't do anything, it doesn't pick up revenue.
The reason it's being fought, trust me, the reason private equity has been fighting this for a long time. If there wasn't revenue that was going into their pockets, they wouldn't be fighting.
Revenue I'm talking about is the federal government. The federal government gets virtually no revenue out of it because there's not that much revenue there.
Santelli, I got it going. I like it. I did it.
Okay.
David, we got to go. They're playing the music. Thank you.
Okay.
Squawk Box will be right back.
right, welcome back, everybody. Right now, we're going to take a look at the state of the U.S. and global economies, the jobs picture, and much more. For that, we want to welcome Carmine DeCibio. He is EY's CEO and chairman. And Carmine, welcome.
Thank you, Becky. It's great to be here. It's not as cold as the other day, but it's cold.
Yeah, it's cold, but it's okay. We're doing just fine. Hey, Carmine, we've been talking about the economy from a lot of different perspectives all morning long, but you've got a very interesting perspective, and that's from all the companies that you do work with in the United States and around the globe. So, where do you see things right now?
I think things are changing, Becky. You know, what we've been seeing is there's definitely been a slowdown around the world, a slowdown in our own business. So a good way to gauge this is to look at our own business and look at our consulting business in particular. So that has gone through a slowdown. Companies have been spending less. They've been doing less on transformations and so forth. In particular in the U.S., actually in Europe, that has continued, which, you know, to some people that's surprising. But I do think Europe was catching up a little bit on this. So we are seeing more confidence building with our clients in terms of spending, in terms of the economy, but most of them are still waiting in terms of central bank movement and in particular rate cuts.
Well, you, along with some of the other consulting companies, laid off thousands of people as that consulting work slowed down. I always think of consulting and advertising as being two of the things that get cut first when...
Great resignation and so forth. That went down to the single digits very quickly. And so in our business, when that goes down a lot, we end up with more people than we need in the short term. We've been very careful at certainly adjusting our workforce. We also have to adjust our workforce with technology coming forward. But we want to make sure that we're investing in the downturn for when things do come back.
You are spending tons of money on AI and partnering up to do some of these projects. What does that mean when you roll that out to companies? And we're trying to get a feel for what that means for the workforce down the road, because right now it's a really tight labor market. When it's not, and when there's more time to have implemented this AI stuff, what happens?
Yeah, so first of all, I don't think the labor market is as tight as it used to be. But in terms of AI, we look at AI in three different areas. One is, what are we doing with clients? So what we're doing with clients right now is really use cases. Use cases in terms of how do we make their business better? And a lot of that has to do with different sectors. So we're doing a lot in healthcare, a lot in pharma, some in financial services. And a lot of the use cases are either around customer service, where call centers and so forth, using AI, you can be a lot more efficient, you can be better, or logistics. So any companies that have logistics, we're doing a lot of work with a hospital conglomerate in terms of making sure that they're matching their patients with the right doctors and using AI to do that. So there are hundreds of these use cases that we're working on. These are small projects for us, but they have the ability to turn into big projects. That's what we're doing with clients. What we're doing for ourselves is really making our business better, more efficient, better for our clients. We have our own chat box, EYQ, where all our EY employees could ask it questions. It's learning and answering questions about the company overall. And then the third part, which is very important, is we have our leaders around the world working with governments and private companies to make sure that EY is for the good and not the bad.
Carmine, I want to thank you for stopping by and telling us a lot really quickly.
Thank you. It's great to see all of you. Have a great time.
Thank you.
Thank you. Thanks, Carmine. Coming up, former Bain Capital Chair Steve Pagliuca. Squawk Box will be right back.
the app today.
Our next guest has a diverse portfolio of investments from science and innovation to the business of sports. With us now, Steve Pagliuca. He is the former chair of Bain Capital, CEO of PAGS Group, and Boston Celtics co-owner. You get more excited about these new investments than sitting on the floor of the Celtics?
I know it's close. I'd say very lucky, especially this year at the Celtics is fantastic. We're leading the league right now, and we're 20-0 at home. You know, it'll end at some point, but we're really living the dream right now.
I had the Bucks on a recent game, and do you remember that game? What the hell happened?
I've forgotten about that game. That was our 5th game in 7 days, so I think we didn't have a lot of legs in that thing. Our coach is brilliant. He pulled the starters. I've never seen it in our 20 years. He pulled the starters at halftime because we traveled all over the country and played 5 games in 7 days. So it was really, and the Bucks played fantastic.
The arena, this company must be exciting because this is the second time we've talked about it in Davos, and your name was dropped. I think, well, of course it was yesterday. That's when we got here. Tell us about it. Why are you so excited?
Really excited about it. It's basically. I did a bunch of work and done a bunch of biotech investing with scientists, and did a bunch of work on COVID when COVID came in. And in getting to know these guys after COVID ended, we saw that drugs could actually be brought out in a lot faster way. The world's changed. The genome's been mapped for 20 years now, so we have that data. As you know, in Davos here, the big talk is AI, and now GPUs are cheaper than ever. You put all that together, it's kind of a golden age to use AI, bring scientists together. We're trying to create the Bell Labs of biotech. And so we're eliminating all the overhead they have. In universities, they estimate they spend 50% of their time because of government funding on compliance.
Yeah.
They spend another 10% on negotiating licenses, another 10% on raising grant money, and it's very rigid. You can't change the experiment once you start it. So we've tried to take the best demonstrated practices of what they do in universities, what you do in pharmaceutical companies, and put it in an entity like Bell Labs, and we just signed a lease for 50,000 square feet, a state-of-the-art lab in Cambridge, right in the heart of Biotechville. So we think it can do a lot of good for humanity and be good for investors as well.
Kendall Square. No?
Kendall Square.
Kendall Square.
That's where it's at.
Unbelievable.
As you know, Jim Breyer's in it, and Michael Dell, and Michael Chambers.
And it's about getting drugs to patients more quickly, or solutions to patients more quickly.
Absolutely. It's really taking this incredible science that can be done, basic research, a long-term approach with basic research, and then using these tools to translate it much more quicker with a sense of urgency into life-saving drugs. And Stu Schreiber, who's leading the effort, was the co-founder of the Broad. He was a legend at Harvard, and he's trained 50 or 60 of the top people out there. So we think if we put them under one roof, you know, Arena has the symbol as a roof. We put them under one roof, and they work together cooperatively. They share the economics from all the companies. So it's not just one person.
So they are incentivized to share all of their research, because that's a big
problem. Right now,
with the
research is very siloed in universities, because if you give someone your idea, then they get credit for it.
Yeah.
I know we're gonna have
these guys can work together.
I know we're gonna have to go, but I have one NBA question. Valuations of these teams. Do you think we've reached a peak? There's a whole bunch of people who you know have been selling.
There will never
recently.
be a peak.
No, but there's a bunch of people recently have been selling.
Not with gambling.
In large part because they think, or at least suggest, that maybe we're there because of this, the way the cable operators are working in terms of regional sports and the like. What do you think happens here?
Well, I go back to back to 2003 when the Boston Globe, when we announced we were buying the Celtics, it said venture capitalists pay record price for teams. That didn't help us with fundraising. Highest price ever at $360 million. Today values are up around $5 billion. $360 million. So back then they were saying we reached the peak. So I don't know if we've reached the peak. These are unique assets. Adam Silver, I think, is brilliant commissioner in sports. There are 2 global games, soccer/football and basketball. And today's media technology has allowed us. I consume the games over here. When I'm over here, I can see all the games. Just dial it up on the phone or on my computer. So it's reaching billions of people now,
right.
And there's a huge fan base in China, in Europe, everywhere. So I think it's going to keep going.
Does it make sense for the NBA, and now we're hearing reports of the NFL, to make to buy in a stake and have a partnership with ESPN?
Adam will determine that. He's been brilliant in terms of our media relations, and so the NBA has been great at looking at new models. Looking at streaming, looking at partnerships, and if it works out, if he thinks it'll work out, I think we'll back him fully for it.
wherever I go in the United States, I can't bet when I leave New Jersey. So I have to put bets on when I'm in New Jersey. So that's, you got all that potential. It's still,
You're absolutely right about that, Joe. And in Europe, they've been way ahead of that.
Yeah.
You know, you can kind of bet on what time somebody shows up for the game in Europe, and it's like water for ducks back.
begging me, Steve.
The U.S.
to
is
get
going
out.
that direction.
I'd let you go, but we got to go. Thank you. And good luck.
Great to be here.
Maybe this is the year.
We got another big hour ahead right here on Squawk Box in Davos, Switzerland, including the CEO of Uber.
February 31st.
Good morning. Welcome back to the World Economic Forum, where business leaders and world leaders are gathering to debate some of society's most pressing issues. Wow, really? Who wrote that? This hour, some of the corporate world's biggest names, including the CEOs of Uber. That's an interview I love, who's sitting here already. ServiceNow, Blackstone, Goldman Sachs, Coca-Cola will all join us. The final hour of Squawk Box begins right now. Stop publishing.
Good morning. Welcome back to Squawk Box right here on CNBC. We're live at the World Economic Forum in Davos, Switzerland. And I'm Andrew Ross Sorkin, along with Joe Kernan and Becky Quick. And we got so much going on. It's like a parade of all-stars. Want to get to our first all-star, Uber CEO Dara Khosrowshahi. In a new op-ed, he's casting doubt on the company's goal of being emission-free in the U.S., Canada, and many European cities by 2030. And we want to talk about this because he writes the following. The stark reality is that Uber will not reach our zero-emission goals without stronger action from policymakers and businesses. Unfortunately, right at the moment, we need to accelerate through the turn. Many governments and automakers are slowing down. We should also mention a new Axios report this morning that Uber is working with Tesla to encourage drivers to switch to EVs, and we want to talk about all of that. Good morning.
Good morning. Good to see you.
So tell us about what led to this op-ed and the way you're thinking about this issue now.
Well, I think what is absolute is that we are totally committed to electrification of our fleets, right? We talked about by 2030 in the US, Canada, Europe, 2040 all over the world. But what I've always said is that climate is a team sport, There's no individual company or individual person who can drive the climate agenda forward. You need companies, governments, individuals to come together. And for us, we are building out the economic flywheel essentially of incentivizing our drivers to switch to EVs.
Right.
They've got to be affordable. They've got to have great repair kind of profile, and they need charging infrastructure as well. And the charging infrastructure, for example, is something that's vital that governments and cities play a part in. So this is what we've seen is we've gone from a period of excitement to a period of execution. And stories are easier to say than the actions are.
And so now here we are, though, and it appears that there's a lot of folks who are scaling back. I mean, there are a lot of people who made big pledges, big numbers about what they were going to do. Now we see a sort of major pullback. Where do you feel like you're in that pullback?
We continue to lean forward, but we see the pullback. And I think that the key is that for us, we view electrification as good business, right? So when you look at our riders, about 40% of our riders now, for example, in the US, have been in an EV. And they love the product. Their average tips are higher for the driver. So the drivers who got to an EV, our take rate is lower, so they're making more money from us. They're making more money because the tips are higher. And so both drivers and riders love what we're seeing. But then per Tesla, we've got to go out to OEMs and get them to lower prices and make it more and more affordable for drivers to make that switch.
Dara, I would say a lot of the pullback is coming from places where there's not demand. I mean, some of these, like in Hertz, the reason they're getting rid of them is because nobody wanted to rent them. The car makers that are dialing down on it because nobody wants to buy them.
Well, no one wants to buy them, let's say, because it's the right thing to do. They want to buy them if the product is great.
But it doesn't make sense for an urban, it doesn't make sense for an urban dweller who doesn't have somewhere to plug in the vehicle.
Absolutely. And that's why, for example, charging infrastructure, making charging infrastructure available to that urban dweller or to our drivers who might not have their own garage, et cetera, becomes all the more important. So nobody said this was going to be easy, right? This is one of the biggest challenges that humanity is facing, and taking that on isn't going to be easy. And we want to keep pushing forward through this more difficult time, and we're totally committed.
A driver that's driving for you 8 hours a day, 10 hours a day in an electric vehicle, can they make it throughout the whole day on one charge?
They can make it on one charge, and what we do is we help them in terms of what's the right time to charge, for example. The right time is low demand time.
Right.
We'll find you an open charger. The data needs to be good. The charger needs to be not broken.
Right.
And we'll find you what the price is, et cetera. So there's a whole system that you have to build in order to enable all this to come together. But again, there's an infrastructure that we're depending on, and governments need to keep leaning into that infrastructure.
Let me ask you about a separate topic that came up in the news while we've been at Davos. Drizzly, an acquisition that you made, an alcohol delivery company, effectively. You shut it down. You spent $3 billion on it. Was that an acquisition that you now think was a mistake?
Well, we shut down the app. We haven't shut down the service.
Okay.
So what we saw, and we're increasingly seeing, is we talk a lot about the power of the platform. And what does that mean is people like coming to a single app that knows them, knows their identity, payments details, et cetera. And we bought Drizzly, and we essentially started building in alcohol delivery into the Uber Eats platform. Getting all the merchants in place, having all the inventory, building the right catalog, et cetera. There's a lot of detailed work that went into it. And after a while, what we saw is a lot of Drizzly customers who used Uber Eats, the second time around, they used Uber Eats for alcohol delivery. The same thing is true for grocery as well. We had Corner Shop, we shut that down. It is a disciplined thing to do in a market that requires discipline, but more and more, it shows the power of the platform, which is consumers.
But you look at that as a deal.
Did you need that to make the jump to get people to buy Uber Eats? To buy alcohol.
I don't think we necessarily needed it, but it committed us, and it committed us to move faster to build this one app for every delivery need that you need. So it's worked out for us in the end, and alcohol delivery is one of the fastest growing parts of our business. But it wasn't working as a standalone. And that's one of the challenges that a lot of these smaller tech companies that are private who can't get funded anymore is because these small standalone use cases don't justify the returns on capital. But putting these products inside of Uber and Uber Eats that makes a lot of sense.
We keep talking about AI. I mean, you can't get, you can't move without talking about
Third
AI.
question. I can't believe it took that long.
So, how is AI being used in practice today inside of Uber?
So first of all, AI is a big word, but there are many different kinds of AI, right? So we've been using AI to price out your ride, to power your feed on Uber Eats, to figure out the right route, to decide
Will you charge me a different amount than you charge Becky for the exact same ride, same moment? Moment by moment?
Not the same ride, same moment.
No. Let's say you think that it's because you could test this.
Yeah.
Am I a more elastic customer? Will I pay more? Meaning, am I willing to pay a higher premium than maybe Becky is, or maybe Becky's?
Probably not.
I'm the cheapest. I'm the cheapest. Probably not.
We don't price based on individual.
Okay.
But we do price based on routes.
Okay.
So, for example, you're taking a route from the suburb to the city.
Right.
We may know that there aren't that many alternatives, so you might be less elastic in terms of price sensitivity. But we're very, very careful not to take individual kind of pricing into account. Now, with the drivers, for example, some drivers, a promotion might incentivize them to drive more than other drivers. So in promotions, et cetera, it might, but not in terms of pricing. Coming back to AI for a second, the new version of AI, which is generative AI, we're very focused on, for example, productivity measures, helping our developers be more productive in writing code. Our customer service agents provide better service once they, summary of what they're doing, what the rules are, et cetera. So it is very, very early in the path, but I do think that properly used Gen AI will be a huge productivity saver for companies all around the world, not just tech companies.
Derek Khosrowshahi of Uber, the stock's been on the move in a good way. Congratulations.
Thank you.
Thank you.
All right, when we come back, more can't miss interviews, including with Goldman Sachs CEO David Solomon. But next, ServiceNow's Bill McDermott will join us. Squawk Box will be right back.
Welcome back to Squawk Box, live from the World Economic Forum in Davos, Switzerland.
Artificial intelligence on everyone's mind here in Davos. Our next guest is helping other businesses transform how they function using that AI technology. Let's bring in Bill McDermott. He is the chairman, the president, and the CEO of ServiceNow. And Bill, this has been a hot topic here in Davos this year, but I've been kind of amazed reading through what ServiceNow is doing to try and help productivity. I read an interview, I think that you did with David Rubenstein, who was just here earlier, where you said you can take an engineer right now and make them 50% more productive.
Yes.
How? What happens? How does that work?
It's an amazing once-in-a-generation moment where generative AI meets the ServiceNow platform. So we now have engineers texting to actually code. So instead of all the setup work, you can text a blueprint to actually build a net new application to drive innovation in a company. And the cycle time to do that has been reduced dramatically because you're getting right to the coding process. Example.
Yeah, I still don't understand. Dumb it down for me.
Well, let's just say you want to build a employee rewards program. CEO has an idea, I want to make my people happy on Gen AI. You can text the idea of the employee rewards program, and that will create a blueprint right out of a text. Then an engineer actually codes that right to the ServiceNow platform. And you're doing that at a cycle time that's half of what we used to do it at. And what's happening with ServiceNow is we create domain-specific LLMs on the ServiceNow platform. And the benefit of that is we build it for a user in a specific industry. So that use case right out of the gates is ready for productivity. It's ready to help people do their job. We can set up a virtual agent in 15 minutes.
You're kidding. I mean, you think of the productivity gains that you could have with that. It's kind of amazing. But then you think of the other side of that, of what that means for job creation or potentially job losses. It's a replacement of the basic human needs.
It's unbelievable how it generates productivity. And what the CEOs here in Davos are talking about is transformation. How do I take digital transformation and up at one level with generative AI to what I have termed business transformation management? How do I look at my enterprise on an end-to-end basis, from my technology to my people to my customer to those creators that are driving innovation? And how can I do that on a common platform? And Becky, there's 50 years that have been created of siloed applications in every enterprise. And in the era they were bought, they were the best out there. But now, Steve Jobs came up with the iPhone in 2008, and everybody has in their pocket a machine that is 900 million times faster than the Apollo Command Center. And they want to do all their work on that phone, that smartphone. And that changed everything.
Very quickly, just in terms of there being demand for this for companies out there all wanting to figure out AI, how much willingness is there to spend on these initiatives? Because they're not cheap.
I have not had one customer talk price because it's so transformative. If you can improve productivity, we have 15 LLM projects going on in ServiceNow. We're driving 35 to 40% productivity improvement, and that's conservative. We're doing that in 15 different projects on one single platform. If you can do that, the cost is not an issue. You know you're going to get the productivity, you know you're going to get the growth. I want to also, on this jobs thing, I think people have really overplayed this. You know, Time magazine in 1966 said that computers would replace 90% of the jobs, and that states would have to subsidize the workers. 90 million jobs later, we're still going after growth, opportunity, and technology is the driving force behind it all.
Bill McDermott. Bill, I want to thank you for being here.
Thank you very much for having me. I appreciate it.
Great to see you.
Thank you.
Coming up, Blackstone, Steve Schwarzman, going to join us on the private equity landscape in 2024. Got a lot to talk to him about. Squawk Box will be right back. Welcome back. Our next guest private equity firm became the first one to manage $1 trillion in assets. Joining us now is Blackstone Group co-founder, chairman, and CEO Steve Schwarzman. It's good to have you on. As we get to see you here just about every year.
Well, it's good to see you, Joe.
I want to start with there are opportunities in real estate, I think, that you're seeing, and even in commercial real estate. I don't want to hear about around the world. I know you're active too, and with $1 trillion, we look at you. Wherever there's an opportunity, we think you have the people at this point to find things like that. So what are you seeing?
Right now, European real estate is very interesting, which probably is a surprise to people. But what's happening is that interest rates were really, in Europe, were negative. So people could borrow money very cheaply. And now their cost of money is 500 or 600 basis points higher. So people who use debt to own their portfolios really are struggling. And they have to pay down debt. So they have to sell assets. And we're one of the few people in the world who have a lot of money and like to buy things.
So what kind of deals are you getting?
Well, what happens, Becky, is people approach us with portfolios to buy, and we say thank you for the opportunity, but we're actually only interested in buying a few types of real estate. We really want to buy more warehouses, more student loans, one or two other classes. So if you could take this pile of stuff back and just give us what we'd like, we'll buy it all. And so what tends to happen is they go back and they find all of the stuff of the type we'll buy, and they come to sell it, and they often bring their best stuff. So we're able to buy wonderful pieces of real estate at prices that work for us, and they get liquidity. And this is the start of, you would call it, a distress cycle, if you will, for those owners.
But it's not super low prices if you're only taking the premium properties that you want, right? Or am I wrong to assume that?
You're getting them cheaper than market, where you wouldn't buy them.
Right.
So it's turned into a very good opportunity.
Do you think those value plays we're seeing in Europe are going to be coming to the U.S. soon?
Not real fast. We're starting to see other interesting things to buy. Some of the public companies have struggled a bit.
In the U.S., you're talking about?
In the U.S. On prices. So as we look forward to 2024, we think we're going to be a lot more active in 24 than we have been.
Definitely want to talk about politics here, Steve. But I want to talk about China, I think, first. You've had a long, long relationship with China. How has it changed? How do you view everything right now with all the work you've done there, investments in philanthropic things, students, all the things that you've done there? It's more complicated, or is it?
Well, it certainly has been. Over the last 2 to 3 years, this has been a very difficult relationship. I was at the summit time in San Francisco, with President Xi and President Biden. Evidently, they had a pretty good meeting. They don't agree on all things, but the tone of the meeting was good. The Chinese, I think, have decided that they really need to re-engage with the world for their own reasons. Right now, they have a negative foreign direct investment. This is a terrible situation for them. They want to reverse it. So Premier Li, the #2 person in the country, was here at Davos. I was at a lunch with him yesterday. They're very pro-business, trying to get people to come back. I actually had a private meeting with somebody who runs a large company who's told me he's building a plant in Shenzhen in the south. So the Chinese, I believe, really want to lower the temperature for 2024 because it helps them. Their economy is okay, but not strong. And
You say okay, but not strong. Would you say challenged? I mean, one of the reasons I think there's an argument that they're coming here and saying we're open for business, please come do business with us, is because of how challenged the economy is.
well, I think, Andrew, you're right on that. It's still growing. They're used to higher rates of growth. They reported 5.2%, which doesn't sound too bad. I was in Shanghai about 2 months ago, and the party secretary there, who's an old friend of mine, said, Steve, we're growing at 8.2. And I believe him because I know him. It's out of the big cities where the problems are.
We've got a minute left, Steve. So you were early on in the Trump presidency. You were close to President Trump. You obviously fell out of favor. He did with you. And I'm just wondering now, if he's a presumptive nominee, will you be back in the fold? Would you support this man again?
Well, I think we have to see what happens, Joe.
Okay, well let's make some determination. You make all kinds of determinations. That's how smart you are. Let's say he's the nominee. Let's assume that.
Well, I may not be as smart as you think I am, Joe.
I think you are.
And
well, just take it as a hypothetical. Let's say he's the nominee. Is there any way you're back in the fold as a full-on supporter of Donald Trump?
I think we have like an interesting presidential election now.
One word
where there are very high negatives, as you know.
Yes.
For both candidates. That's assuming we know who gets nominated right now. It looks certain on the Democratic side, straight line, because nobody else is running. There's still some other people in the Republican one, although all the experts, say it's going to be, former President Trump. So, I'm in the let's wait and see how this works. I'm not into the hypothetical world yet, as much as you'd like me to be, and we'll see what happens. There are always surprises in these elections.
I was just wondering whether you could see fit, whether it's got so bad in terms of bridges being burned that you could never come back, or whether there's a potential.
I wasn't burned.
No, I'm not saying you were, but you made it was a pretty conscious decision that you made. Well, I don't know whether it was January 6th or what it was, but there was something, and I was wondering whether that made it impossible to go back to that area. And I know you don't want to answer the question, so I'll stop trying to ask. But I know you know what I'm asking.
I'm not into breaking news today for you, but I love you all anyhow.
All right. Well, come on back and we'll break the news later. Appreciate it. Thank you again.
Coming up, more big interviews with the CEOs of Goldman Sachs and Coca-Cola. Squawk Box will be right back.
Welcome back to Squawk Box. Rick Santelli here live on the floor. Well, I wish it was the floor. CME HQ with the breaking news of the morning. These retail sales, expected to be up 0.4, is up 0.6. That's the best since September. If you strip out autos, still twice expectations, up 0.4, best in September as well. If you strip out autos and gas, up 0.6, equaling our last look. And finally, the control group, which is inputted higher up the food economic chain in terms of data points, is up 0.8%, which equals July. You have to go back to January to find a better number. Now let's look at import prices, shall we? On the headline number, month over month for December, much better than expected. We're expecting down 0.5, well, they're unchanged. So I guess better is in your interpretation. Lower prices at this point seem to be deflationary, which lines up with more of our global central banking aspects, but this is higher than expected. And if you strip out petroleum, it's unchanged. Those are month over month. If we take a year over year look, down 1.6% versus down 1.5%. Export prices on a month over month down 0.9%, and finally, year-over-year export prices down 3.2%, and that is about half of our last look, which was down a little over 5%. Interest rates have moved up on the hotter than expected retail sales, and we see that interest rates across the globe are higher. UK inflation jumped in the month of December. Andrew and the gang, back to you. Stay warm.
Hey, Rick, thank you for that. Meantime, Goldman Sachs shares coming off a very positive session. This after the firm posted better than expected fourth quarter results, helped in large part by its asset and wealth management revenue. Fourth quarter earnings jumping more than 50%, though full year profit was down 24%. Joining us right now is Goldman Sachs' CEO, David Solomon, in town here in Davos, Switzerland. Nice to see you, sir.
Good to see all of you guys, and happy to be here again. And
so
it's a warmer day.
So
I'm glad I'm sitting here.
So you were in New York yesterday because you had your earnings report. Let's talk earnings, and then we'll get into some of the broader geopolitical issues and market issues. But you know, one of the things is the market likes this. They like when your asset management and the wealth business go up, because that's where the people will ascribe a higher multiple to the business. So where do you think you are in terms of the transformation at this point of the Goldman Sachs, as they like to say?
Well, we made a lot of progress in 2023. You know, we've made a bunch of strategic decisions over the last few years to really invest and grow that asset and wealth management franchise, get it organized, and I think we've got the firm in a position as we enter 2024 where we have two key businesses where we really are in leadership positions and have a right to win. And the first, obviously, is global banking and markets, where I think we performed very well. And I think one of the things the market liked yesterday was our relative performance in that business, and what's not been a B plus or an A environment. But we've continued to grow the asset wealth management franchise. We had our 23rd, fourth quarter of consecutive long-term fee-based inflows. We highlighted that we met our fundraising target that we set 3.5 years ago on alternatives. We exceeded it. We raised $250 billion of alternatives a year ahead of schedule, and we'll continue to raise more alternative assets as we go forward. I think that we'll probably raise another $40 or $50 billion in 20 to 24. So the franchise is well positioned. We have very strong performance in the funds, and we're growing the management fees. And those management fees over the last 5 years have gone from kind of just under $5 billion to almost a $10 billion run right now. So we're making real progress.
People often talk about the Goldman Sachs' culture as this very unique culture. And historically, it's been a culture around investment bankers and traders. That's been the culture. Now that there's this flip in terms of shift of focus, and you may say that I'm wrong. You may say we're not shifting away from investment banking or trading, and I know that. But has it changed the culture?
You know, I think that we've got a very strong culture that's centered around the fact that for a long time the firm has been able to hire, retain, and get incredibly talented people to work together in a very, very collaborative way. And I think for us to be successful in asset and wealth management, that culture, has to permeate through, and it is permeating through. I think one of the things that has really helped the firm over the course of the last few years is this one GS ethos that we've developed that's really enhanced our culture of cooperation and allowed us to serve our clients in a super collaborative way to really say, what do they need to experience? And I think that's helping in our asset and wealth management business too.
Let's talk broader markets. Jamie Dimon, your peer, was on with us just earlier, talking about what the Fed is going to do, where the markets are going to go. You were talking about it during the commercial break when you first came on. What do you think Jay Powell is actually going to do this year?
I think Jay Powell is going to watch the data, and based on the data, Jay Powell will make decisions. The market's clearly running ahead to a position of many cuts. There's no question we've made a lot of progress on inflation. Depending on how the progress, moves from here, that'll spell the direction of policy. I think it's hard for me to see the market's view of 7 cuts, this year. I do think there's a reasonable possibility of some interest rate cuts and some easing, but it's really going to be dependent on what the data says and how the economy transmits through the year. I see some signs of softness, which would lead you to believe that we're going to see some cuts, but there's a lot going on in the world, and I know you're talking about geopolitics, et cetera, and all of this, can create
0%
balances.
chance of hikes?
I don't say 0% to anything, but it feels like at this point, a bunch of work's done where the chance of hikes is a much smaller distribution than we would have thought, 6 months ago.
If you think the market has gotten ahead of where reality is in terms of the cuts that could come this year, is there a reckoning that comes in market prices? Or
No, there doesn't have to be a reckoning. And by the way, the market's much smarter than I am, so the market may be right. But there doesn't have to be a reckoning. We've gone through it's an uncertain time. There's a lot going on in the world. We've gone through very, very quick transitions over the course of the last couple of years. And so there's been a lot of, shift in view, and I think that shift can continue. It doesn't have to create a reckoning. I'm not looking for a reckoning in markets in 2024. You'd have to see a real exogenous event to have something like that, in my opinion, happen in 2024.
But let me ask you this. Steve Schwartzman was just sitting in your seat, and he said that he thinks he's going to be buying a lot of stuff in this coming year. And when he says that, it suggests that he thinks there's going to be more things on sale in a almost distressed-like way, big multinationals divesting units, things of that sort, than we have seen in the past couple of years.
Well, I do think that the private equity community broadly, and I'm not being specific to Steve's comments, has really been closed for business over the course of the last 18 months. They've sold very few assets. There's an enormous amount of pressure from the LP community on that group to create more realizations. The markets have settled out. Values are values. So I think you're going to start to see more velocity around sales. In addition, private equity firms make money when they can put deals and opportunities together. And I think people have settled in on the reality of the world. And we're starting in our shop to see more activity in that community. So I do think you're going to see more activity. And that's one of the things that's been very favorable for our business as I look forward. One of the reasons I was optimistic on our call yesterday, the investment banking environment has been a really, really crummy investment banking environment for transactions, for M&A, et cetera. It's improving. And private equity is a component of that where we're seeing some signs of improvement.
when you mentioned the exogenous events that could happen, and we all talk about all the risks that are out here, I'm sure you're going to be talking about that this week. Hard to control politics, hard to control any of these geopolitical situations. How do you prepare for it at the bank level?
Well, I think we all, when I'm asked, and I said this yesterday on my earnings call, I'm pretty optimistic that the environment for our business will be better, but we're operating cautiously. There's a lot going on in the world. I think the world's a little bit fragile at the moment. We're going through some big transitions. And, I think you've got to spend a lot of time worrying about the things that probably don't happen, but there's a 2% chance of something happening and just making sure you're prepared. And so when we think about capital, we think about liquidity, we think about risk positions, we always look through a lens of the tail, not the normal, not the large scale distribution that we expect. And I think there's a lot going on in the world that could make things bumpy, and we're watching that stuff carefully. I'm not a good political prognosticator, but there are elections all over the world. That can have impact on economic activity. And so, we watch closely and try to be good risk managers.
And I asked just because Jamie made comments to this effect too. And listening to his view of the world, it's a little more pessimistic than what we hear from most people, most CEOs who are looking at their books, who are looking things through.
Well, you have to live in the moment. And, in the moment, we've navigated better than I expected we would navigate. In fact, I remember sitting here 1 year ago and telling you the direction of travel on monetary policy, in my opinion, most likely would lead to an economic slowdown, and I was wrong. So we've navigated better, the variety of reasons why we've navigated better, and I think the market environment and the tone, what's going on geopolitically in the world, feels better today. And so you have to take that as a base case. We had a meeting yesterday inside the shop where we were looking at our base case economic forecast for our planning and our budgeting. And it's a relatively benign case, but there's some tails that don't look great. So you think about the tails.
You have to believe that there's free lunches. I mean, that's Jamie's point. We had ZERP for 10 years. We got $34 trillion in debt. gosh, rates are coming down. We conquered it. It's a soft landing. Let's spend another 34 trillion, and maybe the market will double from here. I mean, things like that don't happen, David. So, just in general, there's got to be some reason for wondering whether it's too good to be true.
Well, I think you should, and that's why I think you have to be cautious. And I would highlight exactly what you just highlighted, Joe. I'm very concerned about the growing debt, and that's not something that I think is going to come home to roost in 2024 necessarily. But
How
the
can
velocity
rates come down when the government's going to have to borrow so much money for debt service?
Well, that's one of the reasons why I'm more in the camp of, higher rates longer as a general base case as you operate over the next 5 years, because we have to refinance this debt on a different basis than we have. Now, that doesn't mean the policy rate can't go a little bit lower, but ultimately, the burden, we go back to pre-financial crisis, you had $6 or $7 trillion of treasuries, you're now in the low 30s. And by the way, you're in the low 30s with a lot of short-term financing and higher cost financing coming, which obviously grows the treasury stack. So I think that is a big risk issue that we're going to have to deal with and reckon with. It just might not happen in the next 6 months.
We got to run, but how do you think about China? The premier is here. Lots of discussion about what it means to do business in China, given the situation with Taiwan ongoing. They seem to be very open for business. I argue in large part because their economy seems quite challenged, but there's questions about whether companies should be taking TikTok or ByteDance public. We just had Bill Ford on the program yesterday. Shein wants to go public. There's a question mark about whether the SEC will even let that happen in the United States. How are you thinking about China as given where you sit?
Well, I agree with your high-level thesis that the Chinese economy is slow and sluggish right now, and certainly they have an incentive, a strong incentive to try to repair that, but they've got some significant headwinds. The U.S.-China bilateral relationship is probably the most important, bilateral relationship we have, and also the most complicated and the most fraught. I'm encouraged by the fact that there's been more dialogue in the last few months between the administration and the Chinese leadership. I think that's important, but I'm also eyes wide open that we're going into an election cycle where there's going to be an enormous amount of rhetoric that's going to be very, very tough, and I think it's going to be hard to understand the direction of travel on policy from here until we get past the election. We continue to invest in our business. We're very cognizant of the fact that U.S. policy around certain industries is restricting capital flow and investment into China, and so we look at our business with a different lens because of that. But where we can and we will, we'll serve our clients, especially our global clients who operate in China. We have lots of clients who operate in China. We're very committed.
Navigated a couple of rough quarters, and you had a great quarter this time. Are you getting love letters from the board? Are you did you get a new 18-year contract or something? Is it different? Does it feel different?
Unfortunately, I'm an employee at will. I don't get a contract, but
weathered this storm.
What feels good is our team, Joe, did an unbelievable job. It was a tough year, and nobody's happier to get 2023 behind us than me. But I'm really proud of our team. We made some decisions. We executed really well against those decisions. We made progress, and we got the firm really positioned well to serve our clients with excellence and distinction, and also to continue to deliver for shareholders. I like our setup.
It's weird that people weren't really looking very closely at the stock.
What we've done, I feel very good about the fact the stock's up 120, 130% over the last 5 years. We're making good progress, but a lot more to do. Yeah. And as long as we serve our clients, we're going to do just fine.
David Solomon, thank you.
Appreciate it. Great to see you guys.
Thanks.
Absolutely. See you soon.
Up next, Coca-Cola CEO James Quincy will join us live right here on the set in Davos. Stay tuned. We'll be right back. Welcome back, everybody. Our next guest runs one of the world's beverage giants, giving him an inside look at the consumer and at inflation. We want to welcome Coca-Cola CEO James Quincy. And James, pleasure to have you here.
Thank you. Great to be back.
We have so much to talk about, but let's start with those points. Just what's happened with inflation, where things have headed. Consumers have been willing to pay up for quite a while. You took the price hikes when you needed to deal with the inflation, the higher costs that you were dealing with, but you consciously chose to step back from that. How are things going right now?
Things are good. I think you're seeing a little divergence in the inflation story. What I mean by that is the main kind of developed economies, it's moderating substantially, both on the input side and in the marketplace, and it's kind of coming down in expectations towards a landing zone that's much more normal, and we'll be back to our core strategy, which is earning the right to take price with our marketing and innovation. And on the two kind of extremes of the thing, you've still got a number, given we operate everywhere, of very high inflation countries that are not really getting better. And there are some countries where inflation is arguably too low, and they're kind of borderline, need a bit more inflation. But the main story is moderating inflation, coming into the landing zone, back to the classic story of earning the right for pricing.
There has been this big story that's blown up between your competitor Pepsi and Carrefour, where they said, forget it, we're not going to put any Pepsi products on our shelves anymore because we don't like the price hikes that have come through. What do you deal with suppliers? Have you had any of those same kind of pushbacks or issues?
When we deal with our own suppliers, we have a very long-standing approach, which is to go for very long-term relationships. So we like, given our size, we like to get long-term security of supply. That's our number one problem, is getting enough. We get long-term pricing agreements, and then we layer on hedging. So we very much smooth out the cycle. So we don't tend to go up very quickly, and we don't tend to crash back down. And we like the idea of seeing the cycle through. It really helps us stabilize our business. Which is why we're not so spiky on pricing, and it's a deliberate approach.
And as a result, you have not dealt with any of these same sort of situations?
Of course, in different countries, in different environments, there can be a more or less friction with some of our retail partners. But in the end, we come back to our strategy, which is to earn the right to the pricing. And our story to retailers is we can grow the beverage business faster than their total business, and we, given our leadership and our innovation market, will grow faster within that. And that's a positive story for them. They need their economics to work too.
I love how you are using artificial intelligence even with your innovation too. Can you explain to people how you are using it, even when it comes to new tastes and flavors?
Yeah, I think it all falls in the bucket of seeing what sort of cool stuff you can do in 2023. Come on to 2024. We've used artificial intelligence to design a Coke drink, a Coke variant. We had a program called Coke Creations, still have a program called Coke Creations, which is about making flavors that people could engage with, whether it was from space or also Marshmallow the DJ. You thought it was a food, no, it was a DJ. And then artificial intelligence designed a version, which was cool and very engaging for people. I think the challenge now, as we take those sort of applications of drinks, and we had a program at Christmas where you could make a Coke Christmas card with AI. You could tell it what you wanted to be in the picture, and it'd make a Christmas card for you. And we put them on Times Square, thousands of them. Next year, this year, 2024, it's about, can we turn cool ideas into ideas at scale? Can this generative AI really operate at massive scale? I think that's the next.
In terms of creating actual drinks, and the question I was going to ask is, are those drinks so much fundamentally different than something that your team would come up with in a room?
They were different. I'm not sure they're fundamentally different.
Right.
They were engaging, and it was a bit of fun. I think that generative AI needs to demonstrate that it can operate at scale, because it could make a profound difference in the marketing industry as it moves.
But more on marketing than on coming up with the next drink and flavor profile that no one ever thought of, but somehow the AI figured out.
Never say never, but I think it's much more likely to be the marketing than the drinks.
Because you trust your gut when it comes to the actual product?
No, I just think there's less room. I mean, there's more creativity possible when you're creating an image or a story or text than there is on a physical taste profile. Variants tend to be
James, watching over the years, we own bottlers, we don't own bottlers, we got shelf space, we don't. Can't you use AI just to absolutely maximize the profits from logistically on how everything operates? Isn't it a more effective way to do that? Or
absolutely
possible? Yeah.
Absolutely. As you start to get more compute power and more data available. Lots of companies, including ourselves, including big tech companies, they have data in different pockets that are not talking to each other. But with these overlays that take all the dirty data sources that are not standardized, you can now start to layer on really good predictive selling that works out from the consumer back what everything should be in the supply chain. So that optimization is coming and is a big piece of what needs. We see it affect.
I have to have a very selfish question. James knows. I don't even know. I am addicted. I'm an addict of AHA, which is his flavored seltzer water, for lack of a better word, the bubbly water, right? And they were competing against bubbly on the PepsiCo side, and all the other folks that are now doing sparkling water.
Poland Springs.
I love the AHA, the orange grapefruit.
Yes.
You say it's a tough business, the sparkling water business. I thought it would be the greatest, highest margin business you could have, because what is it? It's just the water sparkled up a little bit.
There are some consumers like yourself that love it, unfortunately.
But there's not enough of us.
And it's a very competitive industry.
It's
Yeah.
So what's supposed to happen here?
We're going to keep trying. We're going to keep reinventing. We've pushed more into our Topo Chico flavored waters, bringing some flavor in there. So we will keep innovating. Our modus operandi is not to give up on the first attempt, but to keep iterating and find the space that works for us.
But I think you've been amazing, James, in looking at the portfolio and not being afraid to shut down classics like a Tab. You got rid of Adwala, Zico coconut water, and those were tough decisions. I think you said at the time that you had a lot of hate mail coming your way when you decided to go ahead and phase that out. How do you decide what's worth spending time on and what's
I'm already
not?
starting to write my letter if this AHA goes away.
AI to do it.
Yeah, look, it's about the portfolio and the optimization, and in the end, each can, each drink has to earn its right to be on the shelf. In the end, there is a physical limitation on the shelves and in the coolers, and each one needs to earn its right. And the analysis is there, whether it's the AI or the humans that do it. You can work out what should be in there. And you have to be dispassionate, because in the end, you're reducing not just your own sales, you're reducing the retailer sales, and you're actually not giving the customer, the consumer, the choice they actually wanted. So it's the right thing to do for everyone, to be a bit ruthless. And
you're an engineer and you're very logical. So
I know.
This is where it comes
But I
back.
still get a lot of lobbying on Tab. So for all the Tab lovers out there, there could be a moment with a special run.
If I could get like Steve Schwartzman to go in with me to buy AHA, could we do a deal?
We could always do a deal.
We're willing to divest AHA at this point.
Well, I was going to make a special run for you and Steve.
Okay.
We definitely need Steve Schwartzman to go in with you on that.
Well, it sounds like I might not. I could probably do it on my own, given what he's saying about the business.
Diet Coke is how much bigger than regular Coke? The Coke Classic, how much bigger is it?
No, it's smaller. In the U.S.,
is it still small? I love I love it so much, but it doesn't love me in terms of me being fat.
We've been improving Coke Zero. I'm going to convince you Coke Zero is the way to go.
I know. I've had Coke Zero. I love regular Coke. It's because of the sugar part of it, I think.
But I have both.
And if you don't feel well, you feel a little. I mean, it's like a curative almost. We have to have some
magic elixir.
It is. We have to have some in the house. We have to, because it's like I need a regular, so it's still bigger than Diet. Is it bigger than
Only
Zero?
in a few countries are Coke Zero and Diet bigger than regular Coke, like the UK, for example.
Still, that's amazing.
But a lot of people drink both.
I do. I drink
I don't
Coke.
want them Coke Original all day long. I'll have a Coke Original in the afternoon. I'll have a Coke Zero in the evening. The people dualize. A lot of people dualize.
Can I pivot? You're one of the biggest marketing spenders in the world in terms of just advertising budget. How has that changed? We keep talking about social media here and also AI, in terms of how marketing is going to change. But are you seeing certain platforms working in certain ways and others not working the way that you used to think they were working?
Clearly, over the last 20 years, there's two really big things that have definitely happened. From the point of view of a marketeer of big brands, I'm not trying to sell a car in Minnesota to the people in Minnesota. I'm trying to sell a big brand across a large space. One was the squeeze down of paper advertising that went digital. That was the first big thing over the last 20 years. You look at a mix of advertising, TV was fine, digital eliminated newspaper. Now, streaming social media platforms are squeezing radio and TV. They're not completely done, but it's there. Of course, one of the things that we do as a marketer, it's not just about where are the consumers, but it's what price is being charged. So for us, the trade-off is not just which platform is more effective, but what are they charging me for it? And so they are in a competitive dynamic.
But right now, are you saying that Facebook and Instagram are the game? Do you think that TikTok is the game? Do you think Google is the game? Do you think Amazon, with its new streaming, and now that they're placing advertising on that, is that interesting to you all of a sudden? Peacock, or you know, obviously owned by Comcast, NBC. But how do you think about advertising in these new ways?
I start from who do I want to reach, and what's the most cost-effective way to get there.
So who is the one? Is there one that you go, these guys actually are offering us the greatest rate right now?
No, it's competitive. I mean, they're all bidding and they're all competing against each other in semi.
How about X, Twitter?
It's not. That was not a big platform for us because it was not a big TV platform. It was not a big commercial video type platform. It's more of it was always historically a text platform.
James, something you guys can't control, obviously, Forex moves, but they matter greatly to the company because of all the operations you have outside the United States. What do you see happening in 2024 now that the Fed is probably going to start cutting rates, or at least that's the expectation?
Man, I wish I knew the answer to that one. I'd probably be a lot richer. I could buy the other drinks myself. Look, Forex is very important for us. We make over 75% of the profits outside the US. And as the world economy has grown, the importance of the emerging markets has gone up a lot for us. And so not all these currencies are hedgeable. We certainly do hedge and we start to spread out. I think we're likely at the moment to see a bit more stability in the marketplace. That's certainly what's happened so far this year. Long-term period of dollar strengthening. I think it's all going to be who goes down when on interest rates is going to make a big bit of the difference. But we'll have a hedge program, and you know we've committed to our investors that we'll find a way to grow the earnings of the company while we manage the Forex.
Is that bottle still back there?
Yeah.
Get it out.
Oh wait, it's down here actually.
I mean, it's a beautiful.
It is pretty.
It's
this
a
one has
beautiful
the Swiss
thing. I mean, it really is. It's American and everything. I love it.
No, it's not Swiss. It's got a Swiss.
No, it's American made.
James, thank you very much for being with us today.
Thank
It's
you.
great to see you. We really appreciate your time. James Quincy. All right, very quickly, we'll take a look at where the market stands. We've been looking at the futures in the red all morning long. Continue to be the case. Actually, Dow futures now down by close to 200 points. S&P futures down by 31. The NASDAQ futures off by 142. And of course, this is coming after a couple sessions in a row where we have seen weakness in the markets. So we'll see where things continue as we get closer to the opening bell in just about half an hour's time. That does it for us today. Make sure you join us tomorrow where we will still be right here in Davos. Right now it's time for Squawk on the Street.
Good Wednesday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer, David Faber at Post 9 of the New York Stock Exchange. Stocks do look to extend some losses after the worst day for the Dow in a couple of weeks. Retail sales, best print since September, has the 10-year around 412. That's about a one-month high. Our roadmap begins with Jamie Dimon's economic warning, saying he is cautious for 2024.
Plus, shares of Boeing, they continue to drop. They're down more than 20%. That's just since the beginning of the year. CEO Dave Calhoun heads to Spirit Aerosystems plant today. He's going to try and address quality control issues at that company. Plus, one name that's continuing to rally. Yeah, there it is, AMD. It's hitting close to its highest level highest close since 2021. This on obviously optimism related to its efforts in AI.
Let's begin with the markets. Yields have been elevated today. Central bankers around the world continue to push back on some market pricing, Jim, but this retail sales print control group, best in about a year, is going to impact Q4 GDP.
Yeah, it's funny because we had some month number, a New York number yesterday. It was too weak. And when I saw this number, I said, maybe this is what we need to appease those who think we're about to go into a recession. So we care tremendously about whether we're going to lose the soft landing. But we also, David, as you know, care that the 10-year not go too far above 4. So you've got this kind of push me, pull you. I kind of like the retail sales because it was against the narrative that we're going to have a recession.
Right.
Yeah.
I like it. Sure. I'm a buyer.
That view?
Yeah, sure. That
All right,
works
good.
for me. I think we can end the show now.
Yeah,
What do you think, Carl?
We'll see you tomorrow. Have a good week.
Yeah.
Well, private credit likes my view.
Yeah.
It's private credit's everything.
Private credit is very large.
Yes,
we don't
it is.
talk about it as
Nope,
often.
it's
as
a
perhaps
runaway
we
trade.
should.
Runaway trade.
Private markets have grown dramatically, enormously over these last, 10 years, certainly even the last 3 years.
Right.
And you're right. It's important. People do wonder whether there's something coming there that will
You know, it's,
Yeah, the B of A fund manager survey yesterday, private credit, #1 risk.
it's just incredible because when you meet a younger person now, it's not plastics. It's
What do you want to be? Private credit.
I was with someone the
How
other
do
day.
you mean?
Yeah, I was with someone the other day when I was in Kansas City. I said, "What are you up to?"
Private credit. Well, listen, they will tell you, of course, as we brought any number of the people who run these firms on, that they underwrite extremely well. They're getting paid
8%.
very well. They do not distribute these loans broadly, so there's not broader risk. And that they feel very comfortable with the risk that they are taking and the ownership they have. And the funds just keep coming in, Jim.
I know.
That's to the alternative asset managers. I mean, Blackstone's over $1 trillion now. We know that.
Even though B-REIT was
Apollo is
down
enormous
0.5.
with its insurer, of course, funding so much of that, and it goes on from there. Brookfield, the size of these alternative asset managers is truly stunning.
I mean, I know that's a pivot from retail sales, but
It is.
I wanted to make it the point because when I listen to gold, when I look at the Morgan Stanley quarter or the Schwab quarter, I realize, look, if you're in trading, high-frequency trading wrecks your margins. If you're in investments, even if you're in private equity, private credit has supplanted how you make your money. So you're listening to the CEO of Goldman and you're thinking, well, where's the niche? Well, it's in bagging elephants, wealth management. I mean, they've just been carved up. All the great things that you wanted out of the banks. That's why their multiples are so low.
It's true. No, I mean, listen, Blackstone, $143 billion market value. Steve Schwartzman was a guest on on Squawk Box as well, but it's an argument to be made much more important in many ways than some of these other firms.
So here's the key question, Carl. When you're with a brilliant young person, man, woman, doesn't matter, you say Goldman or Blackstone? Most of them say Blackstone. Really interesting.
It is interesting, having just heard from Solomon on Squawk Box this morning, which we'll get to. The Dow, though, is going to be pulled lower by Boeing this morning, down pre-market, and we got some breaking news on it as well. Let's get to Phil LeBeau. Morning, Phil.
Good morning, Carl. The FAA announcing that it has completed inspections of 40 737 MAX 9 planes that were grounded. Remember, on Friday, the agency said, look, we're going to take 40 of these 171 aircraft that are grounded. We're going to do an inspection of the fuselage door plug on those aircraft, and then we'll take the results and analyze them. Well, the inspections are now done. The FAA says it will now analyze those results. No timeline for when it will announce what came out of these inspections and when we might see those grounded MAX 9s return to service. Remember that today you will see Mike Whitaker, who the FAA administrator, he's going to be along with the chair of the NTSB briefing the Senate Commerce Committee behind closed doors. So we won't get a readout in terms of what he tells them about the current FAA investigation. Meanwhile, you've got Boeing CEO Dave Calhoun in Wichita, Kansas. He will be addressing employees at Spirit Aerosystems along with the CEO of Spirit, Pat Shanahan. This is going to be similar to what we heard when Dave Calhoun was talking with Boeing employees in Renton, Washington last week. So that's where things stand when it comes to the MAX. Guys, I would not expect a decision in terms of here are the inspection protocol process, here's the process, fix them, get them back in the air. I would be surprised if we get that before next week. I think we're looking at next week or the week after, depending on what these results show. If these results are really, really bad, then it's a whole different ballgame.
Wait, so these 40 planes were fixed, so to speak, already? Or they tightened the bolts, or they did whatever they needed to do, and now the FAA takes a look at that?
They inspected them, David. That doesn't mean that they fixed them. So what the FAA will do is say, okay, we wanted to see what's the state of the 171 MAX 9s that are grounded. So they picked these 40 planes, 25 from United, 15 from Alaska, randomly picked them. They wanted a statistical sample that they could say, we're pretty confident this tells us what kind of work was done on the MAX 9 fuselage door plug. Now they will analyze the results. Then they will put out a protocol process protocol, I should just say, just to the airlines for this is what needs to be done in order to ensure that they are safe to fly.
Now, Phil, let me ask you, this is instantly being viewed as positive. Did people expect that the inspections would take much longer? Is that why someone might say, well, this is the good news here, Boeing?
Jim, I think the market is taking this as positive news. That A, it's a step forward in terms of, okay, we have something that's been finished here, even though we don't know the outcome here. And B, I've heard from more than a few investors who have said, look, I think ultimately they're going to realize that this is a manufacturing quality escape that is not widespread, and I'm making a bet on Boeing. That's just conjecture at this point. We don't know if that's the case. We don't know. This might be, look, they might have opened up all 40 planes and said, wow, this is a bigger problem than we thought it was. So at this point, this is investors, I think, perhaps saying, we think this is going to be the near-term bottom for Boeing. Right. Whether or not they're right or wrong, your guess is as good as mine.
Interesting, Phil. Thank you. By the way, B of A today does cut Boeing from the US 1 list. These comments, Jim, from the Ryanair CEO. We have been loud in our complaints about the lack of quality control of Boeing over the last 2 years. It's not acceptable that aircraft get delivered at less than 100%.
Yeah, look, I think it's true. That gentleman's been outspoken, in part, I think, because they just are such a huge client, they can have that ability to say it. David, when you see some sort of a stock bounce like this, that's just people, I think, who are just saying, oh, shoot, maybe the short isn't as good as I thought. And in the end, there's only 2 of these, and Airbus doesn't have any planes, so it's time to start rebuilding a position.
Right.
You know, it's kind of a lesser of situations.
But you can, listening to what Phil said, there is certainly
There's a path.
Yeah, there's a path.
There's now a path. Yeah.
Exactly.
But David, I'm going to reach a conclusion. I think David may actually like this quote. If your company's named Spirit, don't own it.
Don't get involved with anything named
Spirit. It's been a bad month for companies with Spirit.
If it's got Spirit in it, yeah, Spirit in the sky, I'm getting on that one until taking that one down.
Spirit, obviously, the stock of which the discount carrier came down sharply yesterday when a judge said no. Boy, that was a big surprise.
I can't believe it. We went out here over and over again and said Jonathan Kanter's going to win that case. Remember, this is a serious guy. He is in charge of antitrust for the Justice Department, which still is, I'm told, very significant, the Justice Department.
Yeah.
And he's adamant. And that office let everybody know, look, we are tired of airline mergers.
Right.
And the country's tired of airline mergers. But the arbitrageurs were not tired of airline mergers.
No, well, I don't know how many. I think there were plenty who were short Spirit as well, who were believers in the fact that this deal would not be acceptable, both to the antitrust regulators and to the courts. Which has been the case. We'll see what they choose to do. Obviously, JetBlue did go up on this, but Spirit plummeted because it hasn't made money in quite some time. The price was far above what it certainly would command in the market, so there was a large spread there, Jim. And there were not too many risk arbs that were truly involved here, from my understanding. In fact, many may have been the other way, betting that it would get turned down. As we had said numerous times, when they finally pried them away from Frontier, remember, JetBlue,
right,
with the promise of a $400 million reverse break fee.
No, you got that dead right. So the stock shouldn't have been in, anyone who was in that just was defying common sense. I would never flown to West Palm from Newark.
I assume you don't have high hopes for Alaska Hawaiian.
I think that's an ill-conceived situation, because that's about making it so that prices go higher. And the Justice Department, I mean, you cannot, Jonathan Kanter is a serious Paul Weiss attorney who is used to winning cases and only brings cases, I think, that he knows he's got a pretty good chance to win. And I don't think that the judiciary is any different from anybody else. They've seen that the mergers took airfares up in this country. I mean, that's what happened. Take a look at one of the things that's intractable for the Fed, airfares.
That said, is it beneficial if Spirit goes bankrupt?
No, and that's the Rite Aid problem. If Rite Aid goes bankrupt, doesn't Walgreens do even better?
Right. And that certainly seems to be at least a possibility.
It's a possibility, absolutely. And you're right. You represent a
Not
state.
Like we haven't seen airlines go bankrupt plenty of times.
No, Eastern Air. No, you're absolutely right. I just feel
How
like
about Braniff went, what, 4 times? 3 times?
Braniff had that.
Never Braniff.
Doing a little price fix there. But I do think that it's common sense when you say, listen, we're not going to approve any of these deals, and then you go ahead and do a deal. Like, why would you, in the face of Jonathan Kanter, say, you know what, I'm not taking you at your word. I'm going to do the deal anyway. I mean, that's just...
If all that's true, why is Solomon, for example, so gung-ho on the M&A environment right now?
Well, I mean, I think there's a lot of deals that can be like what we have with Synopsys that doesn't hurt anybody.
Yeah, I mean, airlines is challenged in terms of antitrust right from the get-go at this point, because there was so much regret that they allowed the American deal.
Right, well, that's what happened. I mean, I think that...
occurred years ago, whereas I think the risk, Carl, to your point, is still there, both FTC and DOJ, for many deals that perhaps would not have been considered high risk. But as I've said a number of times, that seems to be fading as the key consideration for those who are considering a deal. We're back to sort of the basics of, can we agree on social issues, and can we agree on price, and can we get this thing to the finish line? I don't want to say in any way that regulatory risk is not significant, but CEOs seem much more determined now.
Yeah, well, Bob Bradway, who I spoke to last week, was the CEO of Amgen, and they're merging with they finished a deal with Horizon. Horizon had great drugs, but not a lot of distribution. Amgen's got terrific distribution. It's got a lot of money to be able to make more. And they went in front of the FTC, and the FTC was against the deal. And then they listened to Bradway, and they decided, hey, Bradway's right. We're going to go with the deal. And that was the beginning of the floodgate, was when people realized, well, wait a second, if you approach them with a reasonable proposition.
That said, we've got a couple out there still. And,
What?
I mean, Amazon iRobot, we'll see if that ever can. By the way, the EU doesn't like it. I'm sure, I don't think Amazon, I don't think Amazon likes it either. Remember, they got the price.
They're going to dominate the robot
vacuum cleaner.
Vacuum cleaner, and that is one thing that is unforgivable. I want massive I want competition in that market.
Given what's happened to that company, Amazon, they already cut the price. Amazon might be happy to have them stop.
You know, they've been
and
arguing,
then, of course,
they
the
got
Albertsons deal that we've talked about a lot, which you know, it's unclear when that's going to come up, but there's still a belief the FTC is going to go to court.
We got
there,
Washington State yesterday on that news.
Yeah, I saw that.
Yep.
Jim, really quick, 90 seconds before industrial production. This Waller speech yesterday and his line that we don't necessarily need to cut as rapidly as we have in the past.
Yeah,
Is that what sort of hurt the afternoon?
Yeah, he crushed the market. It was interesting. Both the Dow, which David, of course, will acknowledge is atavistic, and the NASDAQ both went down, but then the Mag 7 went up. The Mag 7, Waller couldn't hurt the Mag 7. He couldn't.
No.
He took a shot and he failed.
Everybody fails.
Everyone fails.
It's like the Van Wyck.
Well, you know,
you can't beat the Van Wyck. You can't.
Van Wyck.
The Van Wyck. It's an old Seinfeld. Have you ever gone to Kennedy Airport? Has there ever not been traffic on the Van Wyck?
The Van Wyck, you can't get past the Van Wyck.
Can't beat the Van Wyck.
But I will say that people are start talking about the Mag 8, but there were only 7 people. AMD.
Oh, really?
Yeah.
Because B of A made note yesterday of Broadcom catching up to Tesla's market cap.
But we're stuck with, they kept that AVGO symbol because Hawk liked the Avogo. He always liked that Avogo.
He did. It's over half a trill. But it's still a ways away from Tesla. It's still got 100 billion,
170 billion.
Yeah. Tesla's doing its best to come down. You're going to meet in between there.
Thanks for that visual.
Yeah.
Meanwhile, we got retail sales under our belt, and we're not done today. A lot of Fed speak and industrial production. Let's get to Rick Santelli. Hey, Rick.
Yes, we are awaiting the industrial production capacity utilization numbers. These are for December, of course, and they are hitting the wires as I speak, up 0.1% on headline industrial production. The mirror image of the down 0.1% we were expecting. And just to put that in perspective, the number that we had in October was the weakest number going back to December last year at -0.9. So we have come up a bit. Now on utilization rates, expecting 78.7, very close to expectations, 78.6. The problem with that is 78.6 is a nice jump from where we were not that many months ago, but 78.6 is still pretty light when you consider we started out last year at 79.6. These numbers have been soft. Manufacturing has been on the soft side. What hasn't been soft is some of the inflation readings we're getting from Europe. We watched UK sovereign debt jump in yield. They've seen some real pops in some of their inflation numbers, which really demonstrates that it isn't necessarily a linear path, which may make many here a bit nervous. Late revisions coming across the wires as last month's up 0.2 on industrial production now becomes unchanged. Squawk on the Street will return after a short break.
Take a look at the pre-market. Some continued weakness after the Dow's worst day since the 3rd of the month. Busy session with industrial production just now. Retail sales, China GDP, dollar 1 month high above the 200-day for the first time since mid-December. We'll get Kramer's Mad Dash and count down to the opening bell in a moment.
Okay. Well, we learned anything today? Good morning, retail traders.
All right, we've got 8 minutes before we get started with trading here on what Jim and I used to call Liz. We got a Wednesday.
Well, it's a synthetic Thursday because we didn't have Monday.
A synthetic Thursday, got it.
That's what they
All
always
right,
said on the desk.
Let's get your mad dash. You want to talk a little Netflix?
Yes. One of the things that's happened so far this year is that when a stock starts going up, the analysts immediately say, "Oh, I've got a winner." So it's kind of like let's.
This is exactly what I want to hear.
And Bank of America are saying that Netflix is going to have better than expected numbers. Key's really key on membership growth. Bank of America's skill. They're talking about international scale, that people want to deal with it. They have it, the other guys don't. So that's just another reason why people want to just follow the crowd here and buy what has now become the favorite of the old Fang.
It is, well, it's, yeah, you hear this a lot now. They won. Netflix won. Now,
They did win.
Right, I mean, okay, so.
I didn't see them in Kansas City.
It's them and everybody else fighting for number 2.
Right.
That's right. Netflix is number 1. And Disney tried to be number 2, but they went too far woke. So let's see what's on my watch list today. Tesla came back down to support. I still think we can pull back a little bit more. I'm not all gun-ho about this yet. Some are saying it's time, but I'm not ready yet. I think I did call 210. Ain't that right, Linzoid? That was when we were at the high, so I need to get more involved in some of these puts. I feel real putty. And there's the banks. JP Morgan is my only bank that I'm satisfied with. And it had irrational exuberance remember the guy calling it out to 220, and I think that's kind of what Jim was talking about. When they think they got a winner, you know, and they break that high, and then all of a sudden you get upgrades of 50, 60, 70 bucks, and I'm going, no, you can't believe that. I'd rather wait for the pullback when 9 out of 10 times I'd rather wait when an analyst calls something out like that. So we might have had our little correction first thing this morning for a scalp on the SPY. It's now 4 more minutes. We have Mara on here. Mara's down, had 1670 on the 20-day support. And I do see some big buys coming in here. NVIDIA broke out yesterday. I'd like to see it come back to the triple top, somewhere around 551, 552. We'll set an alert right up here on top of this here mountain for triple top. See if I can get a put. I really took my eye off Eli Lilly yesterday. I would have definitely, I've done it before, the put deal. So what's going on here? 551.50, 60. I'll make it 60. Always overestimate it instead of try to be so exact. Many times it'll come pull back and it'll just barely miss your idea. Know what those is? How'd that get small? Oh, it's never mind. I should have typed in triple top. Apple Sophie, I'm waiting for just a little bit more. Google can pull back to the 200 on the 20-day. Netflix earnings are coming out soon. We had 3 black crows yesterday, so if we pull back to this here support level, I think we can take it. And that's at 482.40, 50. Let's make it 50. Jamie Dimon's on. They're on vacation in Switzerland. Everybody goes there. Even the leader of Ukraine's over there begging for money to rebuild this country. I just think he's a leech. But Biden made plenty off of him. See, a lot of these politicians are going to get involved in probably the rebuild of that. That's why they're so interested in it. We'll pull back on Microsoft first thing this morning. They were pumping AMD yesterday, and we're getting ready to be open here. So we'll see what we start off at. I'm not in no hurry. See if we double bottom at 47.47 here on the SPX, but probably go down lower than that. The spreads are huge, so I'm going to try to really pinpoint it today. I see y'all trying to figure out the SPY. Go straight to your weekly. I want to hug the 9 on the weekly is where my support is, and that's, yep, here we go. We got a 1, 2, 3 at open. Bitcoin BTF skyrockets after 10 billion, surpassing Elon Musk buy Tesla stock for voting rights. Yeah, we broke way below it. So watch the SPX right it open here. Where's my platforms? I got one up. What the heck? There's the other one. /ES. What the fuck? Come on. Don't be one of them mornings. Okay, I'm looking at 47.24.58. And I got 47.04. Tesla's hit support. We got NVIDIA coming back a little bit. I got 551.60 for NVIDIA. What'd I say? NVIDIA, 551.60. Smart trade. Got more buyers in right now than we have sellers on the SPY. Come on. I hate, Jimmy doesn't like it when things don't go his way. Chess is dropping a little bit more. See what happens at 210. They got it so wrong. CNB did, yeah, I can't even say it. CNBC. Okay, we got 3 crows here on the SPY. Yeah, Jim platform. SPX. I'd like to get a little bit cheaper. They're very expensive right now for some reason, the calls. Am I on the right date? 17, yeah. 18 for the SPY, January 18. The 473 strike. Let's see what they got to say about
Top-selling
Tesla.
automobile in the world. Period. Right?
Yes.
Oh, why? Yeah.
In the United States, remember when we had Stephen Sherman from Hearst, it's #1 seller, so therefore he felt he had to have a lot of them. David, is it too early to buy Fisker?
Yes. Yes, I wouldn't advise that. By the way, it still may be too early to buy Rivian and too early to buy Lucid, both of which are, and I keep an eye on those, both of which are down over 5%. So
I have to.
they are not beneficiaries of this price.
There was a day when Lucid came public, and David doesn't make these calls, but he was askance. His arms were akimbo when we saw that Lucid at 50.
That's a
Rivian
huge
does
dip.
get cut today over at Deutsche. They go to hold. They take their target down to 19.
Oh, I thought that was too harsh.
Khosrowshahi was on Squawk this morning in Davos and did talk about the slowdown in EVs, which he says they do notice. Take a listen.
We continue to lean forward, but we see the pullback. And I think that the key is that for us, we view electrification as good business, right? So when you look at our riders, about 40% of our riders now, for example, in the US, have been in an EV. And they love the product. Their average tips are higher for the drivers. So the drivers who got to an EV, our take rate is lower, so they're making more money from us. They're making more money because the tips are higher.
45
and so
50s.
Both drivers and riders
47
love
50s.
what we're seeing. But then, per Tesla, we've got to go out to OEMs and get them to lower prices and make it more and more affordable for drivers to make that switch.
Meanwhile, there's the drizzling news, which we didn't get to yesterday. And then this wolf note that thinks that Uber and Cart might actually get together.
Oh, but that note, I mean, okay, so this note about David, they want, everyone wants to be in the food business. Like Josh President didn't throw in just say like Amazon wants to buy them too. But Instacart, we know, has not been all that well received. Is there something you get a little M&A juice going? And yeah, people will certainly go for that because people are looking.
I think we've had a good enough sell-off to consolidate.
What do you think about playing M&A, playing back?
I don't remember where Cart went public.
I would have thrown in Amazon just to really get it going.
Get my scalp out of the way.
$42.95 was the day number one high.
High. Yeah, on Cart. You can see $25.
They do mention, says, competitive risks are rising as Dash, Uber, and Amazon are rapidly closing the product. I mean, look, when you do this stuff, which just says that somebody's going to merge with somebody else, David, there's no problem. You can just say it, and it doesn't happen. Nothing happens.
This really
And if you
sucks
get it right,
today,
then
his
suddenly,
platform.
You've got Zach Morris, you being a brilliant man.
That's true.
I didn't know Zach until...
Right.
Zach Morris?
Properly predicted the merger of Uber and Cart, which, of course, we're kidding here. We don't have any. I've never.
I'm surprised they didn't believe that.
Drizzly was interesting because I went to them on Drizzly. Drizzly was a very good.
There must be another Zach Morris out there.
Those of us, my wife's in the slinger business, and Drizzly was the way that people would order Phosphoro. Right. But so much for that. And I thought that 1.1, I couldn't believe that they closed it so fast, but apparently they never integrated it that well anyway.
Yeah. Again, just it seems unlikely that.
I'm sure I swore I've heard what he said.
Why did this person do this? So that we could mention his name?
That it's a possibility. It worked.
Yeah, he used the actual Maple Bear name. I always thought that.
I know, the old Maple Bear.
Well, there you go. We just did that guy a total
Well,
solid.
Maple Bear is up 4% on his. Guys, shares of Disney are up. It's worth reminding people that there is a proxy fight underway at that company. Of course, they put out their 12 directors yesterday at Disney, and they did not include, as we knew, both Nelson Peltz and Jay Rasulo, who are trying to get seated on that board through said proxy fight. You know, we may know as soon as late
Well,
March,
that's
early
real good
April, we're gonna
news.
get a meeting here at which we're going to see what the vote is. Some strong language in the proxy from Disney as to why they are not willing to consider either Peltz or Rasulo. On Peltz, they say, listen, we don't want him, but we certainly are open to having chats with him anytime he wants to talk. And they said the board has an open door and an open mind if he were willing to present his ideas to the board, not as a board member, but simply as an important shareholder. He hasn't taken them up on that. And then they kind of go after Rasulo here. Remember, he'd been the CFO, he'd run the parks. It's some time back, but they point out that after leaving Disney 8 years earlier, the media business, the impact of technology, and the competitive universe has radically changed, rendering his, meaning Jay Rasulo's, perspective on Disney stale and not relevant to the challenges of today.
Cheap shot.
Make sure you get out with some profit.
Relationship with Perlmutter. Remember, much of the stake that Trian is working with here is actually Perlmutter's ownership. And they go on to point out.
I knew Zach when he had $1,000 bucks.
With Perlmutter, coupled with him having been passed over in 2015 to become CEO. Or CEO.
He's hiding right now. You don't know the story? No.
I wonder whether Nelson Peltz is happy with that salary package of Bob Iger.
Yeah, we'll talk about it later.
Mostly stock.
Yeah.
Mostly stock.
Right, that's
Not in the chat.
So he gets it. Right. You have to account for it now, but it's on the come. But yeah, it was twice what he had last year.
Right. Well,
31.5 million is what it's valued at.
Probably working harder.
He's working hard, maybe harder than he thought he would have to.
Yeah.
Yeah.
But
He's got a couple of years to go. We'll see.
But remember, apropos of the Maple Bear merging with DoorDash, merging with Uber and put DoorDash into this NFL story. Keep it alive, David, that Disney may be doing some deal with the NFL, or is that just fatuous?
No, there are those who sort of try to understand it from the perspective of why the NFL as a league would want to own one, or at least part of one of its distributors. Does that in some way impact its ability to negotiate with other distributors for its product? That said, if you can contribute the NFL network instead of cash and get some sort of value for it into ESPN and then own something there, maybe it makes some sense. These talks overall for a strategic investor in ESPN do continue. I've heard of the leagues. I think I've.
Okay, we're going to retest here.
Another name that's come up a lot. We'll see.
Now, if this doesn't hold here, this is the retest. So we need to break out after this next move, or we go down.
Carl, by saying, on a speakerphone to the board.
I'm going to get back in it here.
I mean, if you're in the room, you can make change. I think if you're just talking, well, that's.
We've got to hold his support.
There's a lot of issues around that. Box office and studio resurgence is one. AFC Jim, new all-time low, 413.
Yep, that's the one right there. It's got to hold that.
Domestic box office forecast for the year.
Yeah, I think that ship really sailed now. But remember, Adam Aaron, who went to Abington High School, Galloping Ghost, now maybe just Ghost, with Schwartzman and Jeff Sonnenfeld, did make it very clear when he
Lily?
sold stock that he sold it because.
See if Lily holds my support here.
You know how you say it when it's for.
Watching the video.
Diversification purposes.
But it was good time to sell.
It was always a good time, right? The meme stock craze, though.
I'm going to put AMD on this one here. I don't have it on that list.
The ability to sell stock at market and just continue to sell stock. Not to mention, I mean, obviously they took on a lot of debt.
We're getting near the anniversary of that farce. Remember?
Say again?
We're getting near the anniversary of the
farce
of GameStop and AMC. We're almost there.
Oh.
Maybe you do a little kind of jig or something, a little dance.
I don't.
I'm going to set an alert off the 200 on the 5 minute. I got to start learning how to trade with this here.
NFTs.
Yeah,
5 minute.
Ryan Cohen.
Ryan Cohen has not done as well.
No.
He was able to do that
who did
really
he
clever.
bag? He bagged on Bed Bath, right?
Yeah, no, he didn't bag anyone. What he did was made a move that was really good for him.
Not that it's all part of the same silo.
Guys, just quit gossiping. Sometimes I just get... Now, here we go with the Davos. Davos. I'm looking to see what kind of reversal candle we're going to have here. It's important that I keep an eye on that candle. I'm going to go put on my... warm up the heater in here. I got 63. What the heck? Don't try to be a hero today. We got a triple bottom at 468. Who got that number right? 468 on the SPY. 468, maybe a little bit above it. You can be hero then. Yes. I keep going back to Lilly. The way they pumped that thing and then they overdid it. Now they're not talking about it. BITO moving up nicely. Okay. I looked at BITO this morning. Yeah, I've got some issues with this platform today. Damn it. Jimmy doesn't like to be slowed down. Three white soldiers. We got to see if we hold this first one. Gold is down. We got a double bottom on /GC with a 1, 2, 3. We break the 9 on the SPX, we'll double top right here. So I'm really watching it close on the 1 minute. We do have to cross the 21. It could be some kind of bridge there. That's up about $3. So watch it right here. I really want to grab one, and I think I will just for fun here. I'm going to take small risk. Come on now. Let me see. $3. Can I get it cheaper? I'll go for one, $3. Now what's this? Entry point not found. I don't know. It'll be peace. Let's make it. Or break it. Oh man, I just got me a... I'm gonna write that down for my new song. That sounds pretty cool. Oh, come on. Break it. There's my hammer. Or long leg doji.
With Jim in just a moment.
They called my name. We'll be with Jim in just a moment. Break it. Yeah, there we go. I'm impressed. Okay, profit. You take profit. What happened here? Woo! Yeah. Boing. Nailed it. That is beautiful. Sometimes Mama says it bees like that. We'll see how. I'm going to tell you exactly why I took that trade and how. So we came down and we had what you call doji. Long leg doji. And she broke out, and then she came back out and retested it with a higher low. We had a hammer, and then this another hammer right here. So right there, man, boom, that big engulfing candle, and you hit that resistance line, you got to get out. I'd like a grade on that one, magnificent. A good grade. The only room that grades the moderator. Bingo. You're only up 54 times. You got to do better than that. UNH moving by the lunch lady. Uber is making some negotiations with Tesla on charging stations. They're going to be on the, I think they're going to get promoted here soon, March or April or something. June. Have a different listing.
BlackRock, we're going to analyze the kind of protection that you really get on this fund and whether it's as safe as you think. You know, now I'm going to ask Jamie Dimon about it because right? Didn't he say he wants more inquiries about that?
Yes, apparently he's very enthusiastic about talking about it.
Well, if he curses, my numbers will go up.
Yes.
I'll just try to get him to say.
Boeing had a nice little bounce here.
No.
I guess we beep him out now.
The late George Carlin was great, wasn't he? I'm going to try to get him to say all seven.
I had 196.27. We hit 197.80.
Take it back immediately?
$1.60 off.
Jim, we'll see you tonight. Week's just heating up here. Mad Money, 6 p.m. Eastern Time. When we come back, David's got an exclusive with PayPal's new chief, Alex Chris, when we return.
Alex Christ. I'm thinking we're going to, I don't know. I was able to get out of this at 4. Maybe get back in it again. This will be my third trade. We have a 1, 2, 3 bits. I would say this is going to be the last chance for it to break out. And we do have a wedge. Not really. We have looks like a slanted Darvis box. I gotta turn this heater up and get warm. I'm gonna jump in this trade, I think. One more shot for a good breakout. Back in at 3. Set a tight stop just in case it doesn't hold this, but I think we've consolidated long enough here in the morning. The bulls are oh, here we go. Drop. I'll add one more right here. Got an alert. Google pulled back and hit my alert. 140.75 Google. Yep, this is it. I can't go any lower than this right here, so I'm going to add one.
Ambitious.
Ah.
Good Wednesday morning, guys. Welcome to now I'm all thrown out. Welcome to another hour of Squawk in the Street. I'm Carl Quintanilla with David Faber, Leslie Picker, live at Post 9 of the New York Stock Exchange. Sarah Eisen's on assignment. Market's still proving that they are susceptible to rising yields.
I'm glad she's on assignment.
About a 1-month high on some better than expected retail sales results. Has stocks down, Dow's down 100 plus.
All right, let's get to some economic data that's just crossing the tape. And for that, we'll get to Rick Santelli. Rick.
Hi, David. Yes, business inventories. Now, these are a November read. We're expecting down 0.1%, and that's exactly what we ended up with, down 0.1%. I guess what's notable here is, of course, these are fourth quarter numbers, and this is a back-to-back drop in business inventories. So we're not building, so that has GDP ramifications. We saw that December retail sales was pretty strong, and we know supply chains were an issue. And all of a sudden, tensions in the Middle East are making it an issue once again. So we want to monitor business inventories quite closely moving ahead. And National Association of Home Builders Housing Market Index hitting the wires for January. And to cover that, we'll head east and move towards Diana.
I can't understand.
Well, Rick, a big beat on home builder sentiment in January. It jumped 7 points to 44 on the NAHB's monthly index. The street was looking for a 2-point gain. Anything below 50 is still considered negative, but it has now moved 10 points higher in the last 2 months and is now at the highest level since September. Now that coincides with a big drop in mortgage interest rates from the high 7% range to the 6% range, and builders in the report point squarely to that, and of course the effect on affordability for growing confidence. They do still note headwinds in building costs, labor, and available lots. Now,
340.
Three components. Current sales conditions increased 7 points to 48. Sales expectations in the next 6 months jumped 12 points to 57. And the buyer traffic rose 5 points to 29. Regionally, on a 3-month moving average, builder confidence increased the most in the Northeast into positive territory. It was flat in the Midwest. Now, tomorrow we'll get a read on how all this new confidence is playing into housing starts and building permits.
Pew!
Quite a significant beat there. We're 30 minutes into the trading session. Here are some stock movers we are watching at this hour. Boeing is one of them. The FAA just announcing it's completed its inspections of 737 MAX 9 planes from a number of airlines, as CEO Dave Calhoun gets set to speak in
that's awful fast.
for a town hall with employees at a supplier, Spirit Aerosystems plant. We'll bring you the latest this hour. For now, Boeing is up about 1%.
Spies moving.
About 1% as well. A few bullish calls on Netflix. KeyBank raising its price target on the name to $5.45
We
a
broke
share,
the VWAP.
while Bank of America and Wells reiterate their outperform ratings ahead of results next week. And fresh results this morning from the financials: Charles Schwab, U.S. Bancorp, and Citizens Financial. You can see a mixed picture there. Schwab down about 4.5% right now, while Citizens up about 2.5%. We'll break down the numbers with Citizens CEO later this hour.
Oh, yeah.
Everybody hit with those FDIC special assessment charges, seeing some pressure on net interest income. A lot of interesting dynamics as a result of the pivot that we saw in the fourth quarter and how that's shaping up at various banks depending on their businesses. Obviously, that was difficult for Morgan Stanley. They saw some downgrades today, 2 downgrades of that stock, because their wealth management division not bringing in the net new assets figure that analysts are used to, that the street is used to for what's been a very steady growth.
What a strange day with this platform to be screwing up.
In the quarter, because investors are still doing this kind of cash equivalent trade, and they're not putting their money with areas that they could be generating higher yields, because they see safety in treasuries, they see safety in money market funds. So Morgan Stanley,
which is strange.
It can be alluring when you're getting 4 or even 4.5, whatever the number may be, in a money market fund at this point. Leslie, let's talk a little about Schwab as well. We mentioned in the last hour the stock of which was down as much as 6% after reporting earnings, and obviously they cite the pressure they've been under for these same reasons as rates rose during 2023, and revenues declined, some 8% or so year over year.
Yeah, the movements caused Schwab's balance sheet to shrink by $59 billion, or 11%, from the year-end 2022 level. And that's because, as they say, clients took advantage of the highest yields in nearly 2 decades, increasing their allocations to investment cash and fixed income alternatives. It's known as cash sorting, and we're seeing the impact play out across wealth management. Jim was mentioning last hour that Goldman did see a nice jump in that division, but that's largely due to the types of clients that they serve. And they're not
With my platform messing up like this, I have a feeling we're going to have a little bounce today.
With rates expected to, having declined already to a certain extent, obviously take a look at the 10-year and or
maybe it could be a blessing
as
because
this year goes on.
I should have got out, but I'm going to wait.
That's the key question, because they've been
see if we get this double top.
in a lower interest rate environment as clients sought new ways to generate alpha, and so they were pursuing asset management and wealth management and the sound advice of professionals, and so that had been a boon to their business. Now, whether 6 interest rate cuts is enough to really kind of swing that pendulum back in their favor in a meaningful way, I think, is the key question. But there's also more competition that's arisen over the last year that they're contending with as well. So there are a whole host of factors that are playing a role here. But the growth numbers that the street is used to just really are difficult in the current environment. And so, we heard from some bank CEOs. We heard from Solomon this morning. He seemed pretty upbeat, especially as it pertains to the M&A environment, to the reintroduction.
I'm going to take 470 here,
and sponsors
maybe
into M&A and IPOs and so forth. He basically said if there isn't some sort of major cataclysmic event.
Damn, man, this really sucks.
Should be a decent year.
Yeah, we can take a listen.
Oh, good. We're going to listen.
It's an uncertain time. There's a lot going on in the world. We've gone through very, very quick transitions over the course of the last couple of years. And so there's been a lot of, shift in view.
I just got to get out.
Shift can continue. It doesn't have to create a reckoning. I'm not looking for a reckoning in markets in 2024. You'd have to see a real exogenous event to have something like that.
Jamie Dimon didn't sound quite as... Now, by the way, that was not the most positive of his comments that we just used there from Solomon, because he was constructive. He was as well on the conference call yesterday also, wasn't he, on the Goldman earnings call?
Yeah, kind of a similar tone, this idea that, we think things are fine, barring some kind of...
Let's make this straight. These guys called it wrong last year. It was in the news. Their little meeting at Davos, Switzerland. They didn't expect to have the run that we had last year because they were looking for a recession. So whatever you do, to always take this with a grain of salt. Whatever they say. They're going to be talking about a lot of predictions and mergers and blah, blah, blah. But they were way off last year. And we had one of the best runs we ever had in the market. They didn't call the bottom. They the year before that. We did. And we also called the resistance. So I got out of this at 460. Now we got to retest this resistance line, the 1 Tibbets and the freebie. We might go a little bit below that line, somewhere around 47.31. It's just real slow today. I just can't stand it when it's like this. And it's cold too. It might have something to do with my internet. So I got my alert set for 47.31. This is some good news out of Boeing. We could get a nice little bounce on this now. Back to that 420. I mean 220 area. We got to break resistance. Right now we're at a head and shoulders. We're at the shoulder line. Yeah, this is really a pain in the ass. Oh, your dog. Man, what a deal here. I'd say it's a joke. There's BlackRock, idiot. I think.
If you don't, because had the retail sales numbers come in weaker than expected, I think people would have been worried that, oh no, we are headed for a harder landing. Now that they came in slightly stronger than expected, people are worried that inflation will remain a concern and that the Fed will be cutting rates a little later. But that's pretty much what we have been embracing for a while.
Speaking of inflation, Sam, we continue to see tensions ratchet higher in the Middle East. How concerned are you that that could kind of bring back inflation in a meaningful way?
Well, that certainly is a wild card, Leslie. When we look at oil price forecasts for all of 2024, our expectations
I'm having
is we're
huge
going
problems
to be moving
today.
back toward the mid $80 per barrel area. So certainly a lot of weakness that we've seen so far with oil prices, and quite frankly, we're scratching our heads wondering if the oil price decline is really a forecast of what global economic trends are likely to be. But our feeling, again, is that while Germany has missed a recession, that we could end up seeing a little stronger and better GDP growth forecasts globally for the entire year.
So, Sam, given your target for year-end, what parts of the market do you want to emphasize?
Well, history tells us that that following an up year, you want to let your winners ride. So we have maintained our outlook for communication services, consumer discretionary, and tech. We have added to this group the financials because our belief is that this sector is trading at a 15% discount to its average relative PE over the last 20 years. We were looking for sequential earnings growth over the coming year and believe that with the Fed starting to cut rates, that will be beneficial to the sector. I think that the market will have a hard time, however, breaking through the 4,900 and then 5,000 level without a lot of attempts at that. And that's why my forecast is a little below that 5,000 threshold.
Yeah, well, certainly same dynamics happening with 4,800 lately, Sam. We'll see where we get as we move further into the year. Thanks, as always, good to see you. Sam Stovall.
Thank you.
As we head to break, here's our roadmap for the rest of the hour. NVIDIA pushing to new all-time highs. Other chip makers following suit. We'll speak with the number one semis analyst on the street about where these names go from here.
Plus, we're going to have an exclusive with PayPal's new CEO, Alex Chriss. He's going to join me right here at Post 9, lay out his plan for innovation at that company.
And shares of Citizens dropping on the back of its earnings. The bank CEO joins us to give us his outlook. Big show still ahead. Squawk on the Street is back after this.
This is a continuation pattern. We did pull back and hit my alert. So this platform starts speeding up a little bit. Yours is also? Oh, there's an echo? Shouldn't be. Is there an echo, YouTubers? It probably... How do I sound on you in the room? Pause one of your TVs, Jim. There's an echo on CNBC.
Oh, no.
I think I only got one on.
Dating back to its IPO in January of '99. Our next guest is the #1 chips analyst on the street. Believes NVIDIA is, quote, the cheapest and safest way.
And I'm just having
to
all
play
kinds of
AI.
problems today. I think it's got something to do with my toss. I'll turn it off for a bit. NVIDIA trading all-time highs. Okay, SPX is now retesting. We had 3 black crows here. This got a hold. For it to stay bullish. Yeah, just bummer for me. $47.50s at, oh, I got the 47.10 on here. I typed that wrong number in. Yeah, this sucks. Well, my trading platform ain't screwing up. I have sang Freebird before. That's a tough song. I've been to 2 Leonard Skinner concerts. Trying to figure out my favorite concert. It's hard to say. Probably just underground music. We got to be a little extra careful here today. This news on Boeing could be good. Tempting to shut this down and reboot it, but then might not even come back. Okay, let's go. Break it. I'm going to either get out even here. We're at 46360. If we break the 1, 2, 3, but I got to go with my rules. So I'm going to sell 2 contracts at 450 and leave 1 hanging. Damn this thing, man. I just can't. They do it to us on what? I bet you there's a lot of people calling these people up. I ain't going to even think about trading on this platform today. Come on. We haven't hardly moved anything today. We're staying within the channel, which means that we're consolidating. PayPal Holdings, they're pumping PayPal today.
I will take all of that feedback and we'll shock the world.
Yeah, you think you're going to shock the world. How are you going to do that?
We've got an Innovation Day coming out on the 25th, where from the first week that I got there, this was not about trying to figure out what to go do. It is very clear what we need to do. 24 will be a transition year for us, but it'll be all about execution, and it starts with innovation. So on the 25th, we're going to come out. We have very clear customer-backed innovation that we will be rolling out for consumers, for our merchants, for Venmo, and I think it'll be a good start to this year.
Anything you can tell us at this point? Obviously, I don't want you to ruin the rollout, so to speak, but when you say you sort of have a very clear idea of what you have to do, and then you say innovation, any specifics you can provide?
Well, look, PayPal hasn't delivered the value proposition to its consumers or its merchants over the last few years that I think we're capable of. We have more data. We see exactly what people are purchasing around the world. So we need to make a better value proposition for consumers, put more money in their pockets. For our merchants, we have the ability to leverage AI to deliver an incredible improvement in their conversion rates. And then we have to let our small businesses and our consumers connect, leveraging AI-driven personalization.
And you believe that, for example, using the data more effectively for particularly the merchant side can bring, what, higher profit margins? I mean, how does this translate?
Well, look, we have over 35 million merchants that are using PayPal. When we improve their conversion rate, it improves their business, it improves our bottom line.
Come on, man.
We're kicking things off on the 25th.
I mean, you do have an awful lot of
Okay,
data.
Boeing's got a
Just selling
nice
it or
little
working with
flag
others
here.
as well to sort of pool that data in some effective way?
The data is our customers'
It's
data.
kind of like
It's our
that guy
consumers'
said
data and our
yesterday
small businesses'
on
data.
Boeing.
What
He
we need
says-
to do is leverage AI to make it better for them to be able to grow their businesses. Small businesses are under a ton of pressure right now. It is hard to be a small business in good times. It's not good times right now. We can give them an advantage. Advertising costs have gone up 2x over the last few years. We need to be able to give them the opportunity to leverage the data that they have and improve their business.
Right. All right. When you speak to investors now, and it also is encapsulated to a certain extent in some of these analyst reports as well, competition comes to mind. Your lack of significant profit margin expansion and/or actually lack of profit margin. Apple Pay, buy now, pay later. Do you have an answer to these? You talk about what is a still relatively dominant position, but at the same time, it seems as though you've taken on a lot of business that doesn't really have a margin associated with it.
Yeah, I think we have done too many acquisitions over the last few years, and we've been defocused. It was one of the things I noticed when I came in 100 days ago. We've got a lot of priorities. We've narrowed those down, 5 key priorities, all focused on profitable growth. And so I think you'll see us start to move away from some businesses.
Am I still getting echo on
really focus our energy and our efforts on
this
building
platform?
profitable growth going forward. This is going to be a lot of fun.
But you did use the word transition year to describe 2024. What does that mean? What are you transitioning from and what are you transitioning to?
Yeah, the company's been focused on gross revenue and growing our business. That's been a good start. We now need to transition to profitable growth. We brought in new leaders. I've remade the entire leadership team in the first 100 days. We've organized around our customers, so we are now focused on consumers, small businesses, and enterprise. We're having conversations with our partners and customers around ensuring that we are
And Lily's
working
coming
towards
back down to
profitable growth. That's going to take time. It's not going to happen overnight. This is a year where we are focused on execution, though, and I think by the time we get towards the end of the year, you're going to see a totally different PayPal.
Totally different.
SPX got an alert say they're going up.
What does that mean?
Look at the
And
size
SPY.
the reason I'm here is you look at the size of the network effect that we have. Over 400 million consumers, over 35 million merchants around the world, a quarter of the world's
Yeah, that's
e-commerce.
what makes me want to give
We have
up.
not taken advantage of the network effect that's there. This is about innovation. It's about delighting customers. It's
See
about
how-
creating a value
how it's
proposition.
screwing me
and
up
it's
here?
all about execution this year. We are not trying to figure out what to do. We are executing on what we know we need to do.
Right. I mean, listen, you have brand loyalty, and now obviously everybody knows PayPal. Venmo seemed to be ascendant for some period of time, but that's a perfect example, I think, of someone who would say, what happened? What did happen there? You have the Zelle competitor that's got a growth rate that's above that of Venmo. It feels as though it's fallen behind.
Yeah, I would say Venmo is still the leader of the pack. It is the verb. You talk to any Gen Z or Gen X out there, they are using Venmo. We have not focused again on profitable growth there. And that's the opportunity for us going forward. How do we innovate, give our merchants, our small businesses, and our consumers the opportunity to continue to interact? Venmo is the leader. There is opportunity proven in the market of how to monetize.
I was talking to one investor who, and he cited a statistic. I don't know if it's true, but he said over the pandemic, your head count CAGR'd at about 18%, compound annual growth rate. That's a lot of people you added. Did PayPal add too many people? You have about 29,000 employees right now.
You know, we did a lot of acquisitions over the pandemic. I said on the last earnings call that our size was slowing us down, something that we're looking at right now. But really, it's about automation. Our ability to take a lot of manual process. When you grow very fast like we did over the pandemic, you just throw bodies.
I'm going to shut this down and see if rebooting helps, because I can't take
automate,
this.
Create a single platform for PayPal, and I think we'll right-size the business.
Right, so what does that involve AI in a more significant way than you're using it right now?
We have been using AI for over a decade
Come on.
to ensure that our risk and privacy works well for our customers.
Cancel.
We've not been leveraging it to enable our customers to grow their business. That is a huge opportunity for us, something you'll start to see on the 25th.
Up and away. Yeah, it's going to take forever to shut down. Shut down. Probably take 5 minutes for it to shut down. Trading on my phone. It's always on a good day. Anybody else having trouble with it? Ameritrade? Zoom out on the SPY. Give me a second here. I'm waiting for this platform to shut down. I think we still need a couple more weeks before we break out. The bank earnings were real bad, in my opinion. And we got that shipping. We're going to have shipping issues. Remember how bad it was when with Russia, supply issues. Maybe we know how to respond to it better now, but 15% of the shipping goes through the Red Sea. And this could be prolonged for a while, so the market's going to get used to it. It's just hard to, with a Jeep, I mean, something really bad could happen. And we'd be in a full-blown war, but I don't know if we could even do that under the Biden regime. I'll just let it ferment. And we're definitely at a hard resistance. This is the resistance on this chart. $476.59, and the support, and we haven't really gone down to it, so your new support's right there. $467.85, and I'm still waiting for this platform to shut down. I wonder what it's going to be like when it gets back up. I'm having real bad issues with Ameritrade. I've been sitting here for what, 5 minutes? I'm going to make some coffee. Still waiting. My other platforms ain't doing too bad. We're at a vertical support on the SPX. If it wants to reverse. You got an inverse head and shoulders here on the 5-minute with a double top. So resistance, that's your resistance right there. Man, 10, 15 minutes for this thing to shut down. I'll go get my coffee ready. By the time I get that, do 150 push-ups. Definitely on a solid, what is that time frame? I bet you that's a minute. Yeah, that's a 1 minute. So we did hit the double top. Jimmy said we'd do that. We'd come back and go to the opening price. And right now we've got an ascending triangle breakout. See the triangle? Okay, it's down now. Let's see if I can get it back up. That took 20 minutes. I don't think I have that much on it. Much better so far. Very good. We're going to know if we're going to break out. Let's do it. We still have one contract.
The economy is holding up better than anticipated, and therefore yields might find a higher equilibrium, and trying to figure out what that means for stocks. I'm slightly encouraged that the market has firmed up since the lows, though I do think that this has been an...
And one thing they leave out when they say the market's doing very well, it's because we printed $6 trillion in 3 years. $6 trillion. The market loves that money being printed. They hardly ever talk about the cost of something like that. But that's why they're always involved in talking about the government and what they're spending. And the government seems like, or at least the liberals, don't quite understand how the private sector works. I guarantee it, if they didn't do all that spending, the private sector would have came out and spent it. But instead, it's free money to them. That's how it works. $6 trillion. We did that in took 8 years under Obama. It only took 3 under Biden. And that was pumping $85 billion a year back then, compared to just a big lump sum check for $6 trillion. So you know, the big companies are going to really benefit from that. It's called trickle-down economics. I heard that Disney CEO got $32 million last year. We're broke out. So I'm up $200 on that other one. So the new resistance is going to be off this old snake that we called out yesterday. And I expect a pullback at 47.39. 26, somewhere in that area. If I kept it, I got one at least. I continued the run. This is what Time told me. He says, well, don't sell them all. At least hold one of them. Boeing didn't do nothing. We got a lot of Fed speakers today. I don't know if that's going to make a difference or not.
Believe that we should be overweight equity in our highest overweight since before the Fed started in March.
So then, given the gap between what the market is pricing in and what your expectations, how are you allocating? And where do you see value given that prognosis?
Yeah, so first of all, we believe that
Someday I want someone to explain me what they mean by the market pricing in. I never could. I just don't get it. They priced in, I've even heard 7 rate cuts. Are you? I guess you just got to be at their intellect to understand that, not me. All I know is we hit a double top. That's enough. Did the market price in the pullback? I don't think so. They never mentioned that. So I'm going to go over my watch list, try to get into a better mood here. Tesla at 214. And we got to break the 200 for it to run on the 1 minute. So we do have kind of a trend. Mira. NVIDIA held my support level at 451. So they inspected them planes pretty fast. So that, you know what that tells me? It tells me they didn't go through the whole plane. They went to all of them. They got that many employees. Something seemed fishy about the whole thing. I think from now on, I'm going to do what Linzoid said and Delta. That reminds me, we need to look at Dow. Should be a possible start to rebound on that one. PG. I got to change the time frame on here. So they had a price increase yesterday by RBC PC to 156 from 154. Barclays maintains overweight at 160. Will they get earnings or something? All of a sudden they're upgrading this stock? I don't get that either. Do. Where's my charts? Where'd it go? There it is. Got the alert on Google, it bounced up. Not much, we're at the 200. So we do have some resistance there. QCOM. Oh man, QCOM had a good knife. This is a good stock they've been pumping. We had a tweezer bottom on it. Well, that's way below that. Never mind. We got a 1, 2, 3 on QCOM. If you're a QCOM trader. Coins holding up on 130. This is my solid support. 50% pullback from the top on the Fibbies. The TSM. That's a tough one to call after the election. Got to figure out what China's going to do. That's TSM. What about AMD? Sarah's on assignment, huh? Yeah.
from the regionals. Take a look at Pinnacle Financial Partners' miss on both net and non-interest income, weighing on the stock this morning, down about 1.3% despite posting an earnings beat, issuing bullish loan and deposit growth guidance for fiscal 24 and announcing plans to expand into Florida. Joining us now is CNBC exclusive Pinnacle Financial Partners CEO Terry Turner. He oversees roughly 150 locations across the Southeast U.S. Thank you, Terry, for being here. So it appears that it was the expense guidance in particular that spooked the markets a bit. Can you share some more color on your expectations there?
Yeah, I think one of the things that's really hard for analysts that are less familiar with our company to understand is we run a incentive plan here that's different than every bank I know. Specifically, 100% of the salary-based associates are included in that incentive plan. And so when we give guidance, we include that incentive payout. The way that incentive gets paid is based on us hitting revenue targets and EPS targets. Otherwise, the incentive expense is reduced to bring earnings in line. And so, honestly, it seems like every year as we come out of the gates, we give the expense guidance. People will take and include 100% of a targeted incentive payout. They may account for less revenue growth, and so it's sometimes confusing to people. But generally, we prevail over the first quarter or two to get people to understand how that plan works.
Is it possible to generate positive operating leverage given kind of that dynamic?
Yes. Again, there's the plan would be to have positive operating leverage to grow EPS in an industry where I think peers are projected not to grow EPS. It's our belief we will grow EPS. I think, again, one of the dynamics there, Leslie, is just to illustrate how it works. 2023 is a difficult year for banks. We reduced our incentives by 38% this year, and so that ends up being harvested into the earnings stream of the company. And so, assuming we hit our targets next year and you pay it 100%, you have to get that lift from 62% up to 100%. But all that said, the only way that incentive gets paid is if we've generated positive operating leverage, if we've hit our revenue targets, and if we've hit our EPS targets.
Terry, you know, when the analyst community starts parsing financials these days, a lot of it is about
nice little rebound on AMD. Got the
real estate on the book.
snake
they argue that you do have a little bit higher
inverse head and shoulders to the 200.
Is that a fair argument?
So we're at resistance on AMD now. Really, called this one out this morning.
For regional banks, we're pretty well in line.
I'm going to turn him down.
Use a guideline of 100% of risk-based capital.
You got a loud voice.
Construction credit, 300% of risk-based capital to total commercial real estate. We're well underneath all those guidelines. I think the more important thing is exactly what gets financed, where it's financed, and how it performs. And all I mean by that is I watch commercial real estate reports all over the country. The markets that we operate here in the Southeast are significantly different than what I see in San Francisco or New England or some of these other markets. And so I jokingly tell our investors, hey, you need to turn the television off and come to Nashville, Tennessee, come to Raleigh, North Carolina, come to Charleston, come to Charlotte, come to Jacksonville, come to some of these other markets that we operate in. We've enjoyed really strong rent growth since 2020, which is a very different dynamic. And
back to $5 on my SPX.
Yeah, it's interesting that you mentioned that because the analysts at Piper say that your updated guidance implies basically no worsening of credit conditions. So is that a function of just the locations
we got
by which you're exposed
47, 47, 26 coming.
Large avoided a severe economic
Let's break the
scenario?
double top.
Yeah, I think our internal main scenario would be that we're headed for a soft landing, perhaps a modest recession, but we're not looking for a serious recession. So that certainly.
So this is a double top. This is an exit idea.
To understand these southeastern markets, I think a lot of people are familiar with population migration trends. If you divide the country into 4 quadrants, 3 of the 4 have negative net growth or out migration. 1 quadrant has positive growth, and that's the Southeast. And so, again, these large urban markets that we operate in are extraordinarily healthy, both in terms of size and growth dynamics and general health measures like unemployment rates and so forth.
Fascinating. When we now have two bank CEOs on our air telling viewers to get out of their bubbles and go travel the country, with Jamie Dimon saying that earlier today, and now Terry Turner. Really appreciate it.
I just now seen the 200 here on the 1 minute. So what was I looking at over here?
Time from Hollywood to healthcare. 2023 was a big year.
Oh
for
shit! I'm gonna get out of the trade.
We're going to break down whether that momentum continues in 2024.
Plus, shares of Instacart on the rise today. Wolf updated
Instacart.
several paths for shares to outperform, including a merger with Uber, which they say
Oh.
will create significant financial
What?
synergies on revenue and cost.
That's a good idea.
$35 target on the name. We're back in a moment.
How much? That's real good news for Uber, for Cart. This one here hadn't been doing very well. Maple Bear shares are trading higher after Wolf Research upgraded it. Wolf Research upgrades Instacart to outperform with a price target of $35. So let's find a good idea entry for this. $26 to a double top. That's a hard to say chart. I'm going to say this here has to break. We'll get right there. Where's the news on Uber? Military Family Advisory Network partner to provide nutrient food. Instacart and Military Families Advisory Network partnered to provide nutritious food for and free grocery delivery to military families following base transition. I don't see the Uber deal.
European markets falling again on this hawkish commentary from ECB officials. Lagarde telling Bloomberg that while the central bank is on track to get inflation under 2, that, quote, victory has not yet been won. And Dutch central bank chief Klaas Knot telling CNBC markets are getting ahead of themselves when it comes to monetary easing. The economic data supporting Knot's view with headline euro area CPI up 50 basis points year on year in December. Ex-food and energy core inflation did fall to 3.4. That's the lowest level since March of 22. Bank of England also having to deal with some higher inflation, with CPI rising on an annual basis for the first time in 10 months in December. It was at 3.9 prior, back to 4, feeding that conversation about last mile inflation being more arduous, so to speak.
Exactly, and that risk of kind of declaring victory too early and the risk of it rearing its ugly head again. We're about 2 hours into trading. Let's go post to post with Bob Pisani for a look at what is moving today. Bob.
Leslie, not a lot of buying interest. That's a bit of a problem. We're coming off of the lows. Dow is almost ready to go positive, but we need a little more energy in buying interest. We're getting some of the earnings to come in. We've been talking about the regional banks. Leslie's been covering a lot of this stuff here. What matters to these regional banks are basically interest income and the loan growth. That's the first thing, and then the non-interest income. So U.S. Bancorp basically reported revenues and earnings in line with expectations. The loans were up 3.6%.
I can't understand why.
That's what really mattered, and that's actually pretty good, better than a lot of the other ones here. Net interest income was down, though. Remember, they're paying more to depositors, so this kind of gets all offset. With provisions for loan losses about in line with expectations. Non-interest income was up. This is the fees, overdraft protection everybody charges. People pay no attention to these non-interest income, but what happens is
People pay no attention?
30% of a lot of these regional banks' revenues, all these fees they charge when you go to an ATM machine, and they keep pushing them up, people don't notice it that much. So overall, Leslie's been talking about this, I think these bank earnings reports are okay, not great. They're not terribly exciting, they're also not terribly bad. Loan loss provisions are not dramatically increasing. That's a really important thing here. Let me just want to note something. Look what finally is up. Boeing. You thought this thing only went down. Finally, this is the first day in ages it actually went up here. January, at the end of December, this was 260. I remember doing something on it. Look at that, 202 in a few weeks here. This is why the Dow Jones Industrial Average is underperforming the S&P 500. That thing is moving 400, 450 points on the Dow.
Meta hit the 200 today. That would have been a good trade.
And that's a major, major problem. Finally, a bounce here, a little bit of stability.
I really got to emphasize how good that alert is.
The mean reversion trade. A lot of these consumers stay
on the 20-day 1 hour. That 200-day SMA acts like a. If I had any moving average on here, I was wanting to buy a stock at a support, I would always look for that 200 SMA on the 1 hour time frame. All the other ones don't mean nothing to me. But the 200, I mean, just even looking at the meta here, resistance, resistance, support, support, support. So I learned something very valuable last year about using moving averages. Find the time frame that works best for you, and then find the moving average that respects that time frame. In other words, find one that shows a pivot point. And a lot of times, all you got to do is and a lot of traders, they use the 200 on all different kinds of time frames. I've never heard them use it on the 1 minute like I do. And I haven't really quite seen it work out on the 5 either. But I've always seen it work out on the 1 hour and the 1 minute and the daily and the weekly. And some traders use a 30-minute. Create a little head and shoulders on it on a 30-minute, but on the 1 hour, right on top of it. So Facebook, here we go. Here they go. This is one I like to call bullshit. Piper Sandler maintains overweight on Meta platforms, raises price target to $4.15. The only way I'll call it bullshit is if I see an all-time high of $4.15. If not, I'll just take it with a grain of salt. So here you go, pumping a double top resistance. We went from $88 all the way to 370 something in 1 year. A year and a month or two. So you know what I'm going to say. And they pump it up to 415 from 355. Kramer just got through talking about that. That's why I think these price upgrades need to be investigated. Maybe next year we could hit it. Maybe in a couple of weeks we might break a double top. What? Meta CEO Mark Zuckerberg summoned to court in Texas over alleged misuse of fiscal recognition. Factual recognition. Oh, yeah. Here we go again. It's political year. I don't know if anybody remember what happened a couple years ago when they brought what's his name from Twitter that has Square now. What's his name? I used to make fun of him. Jack. I've played around for an hour on this stupid platform. Could have been a lot better if I didn't. Just shut it down and start over. Jack Dorsey. Well, no, we never did that. I used to call him Jack Dorky. AMC took another fall. We're almost hit my employee number at 401. This could be a possible reversal. We're 1 penny off my old famous employee number, 401.
Now, and this note that follows that points out the fact that it can be very distracting to have to deal with such a high-profile proxy battle. So that's one thing.
470, 220.
But then also there's the fact that they're in the process of trying to sell some of their Indian assets. You have that in the works. You also have the fact that they have to figure out what to do with the NBA and renew those rights. So a lot of different moving pieces here, and including, of course, investing in prioritizing the studio and getting that back on track.
Meantime, Julia, I will get to this Netflix call, but it's just striking the commentary qualitatively between what's going on at Disney and the fires they have to put out, and the way in which the market is really moving Netflix's way, meaning the third-party content means they need to take fewer big swings when it comes to originals.
Yeah, it's interesting because Barclays also had a note of concern about Netflix, the idea that things are too optimistic
going into earnings. Netflix is always, of course, the first big media name to report earnings. So a little bit of concern there from Barclays about the fact that the stock has moved up so dramatically since its last earnings. I mean, take a look at that stock chart. It's up 47% in 1 year, and a lot of that run up has just been since the last earnings 3 months ago. But then you have Bank of America raising its price target at Netflix to $585. You also have KeyBank also raising its Netflix price target to $545. And a lot of this
It just doesn't make any sense, man.
Ongoing monetization of the crackdown on password sharing. The fact that this paid sharing model that Netflix has been doing actually seems to be working quite well and has more runway ahead. And then also the fact that they think that the ad business is going to be successful for Netflix. There's some concerns.
I mean, we were at
maybe
360.
that Amazon is
Now it's at
accelerating its ad
500.
plans. Maybe
I
that
mean,
could end up hurting Netflix.
I can't fall
but
for this.
Ultimately, the fact that they have this new revenue stream is seen as a positive for
New
Netflix.
revenue stream. What is
We're
that?
already got Stranger Things 5 in production. I know there's been some chatter about Wednesday coming up. The title of this Jessica Reif Ehrlich note, Julia, Crowning the King in Streaming, kind of makes you wonder whether the headlines we're seeing about, for example, gaming, means the company's already thinking about their next chapter on their own.
Yes, I think the idea here is that Netflix was the first mover and they have a first mover advantage. Jessica Reif Ehrlich talking a lot about the fact that they are way ahead of everyone else. And now as these other streamers maybe pull back on their streaming investments and focus more on profitability, Netflix has the advantage of being able to license more content from the other studios and take fewer risks itself. And that advantage of being the biggest, the most global, will really position themselves to better navigate this next phase where everyone else is being far more cautious about not wanting to lose money on streaming anymore.
It's pretty remarkable, Julia, because we're still talking about Netflix's first mover advantage. I mean, this is a company that was founded in '97. Obviously, they weren't streaming at that time. They started that several years later, but still have maintained that advantage for quite some time. As we think about kind of when they get to the other side of the password sharing kind of fallout, do you think that they will still have this advantage that they've been able to garner? And can they do that in a standalone strategy, or will they need to be part of some sort of M&A or bundling like we've talked about with so many of their peers?
Well, I think to a certain extent, the long-term play for Netflix depends on how successful the ad-supported business is. Because having the ad-supported option for streamers enables them to lower the cost and have incredibly low-cost offerings elsewhere around the world. Here, the U.S. market is very saturated, but the place where they're going to be adding subscribers is internationally. It is overseas. So that's a real key piece of this. And then the other question, Leslie, is how do they fit into this streaming landscape? If you see everyone else pull back, Netflix can continue to be the dominant place, the go-to, sort of the must-have, as maybe people will be pulling back on the overall number of streaming options they have. So we're going to be really looking forward to hearing what they say in their earnings, which is just next week. And of course, that guidance is always what I hone in on for Netflix.
Absolutely. Julia, thanks so much. Coming up, Shan's path to going public is hitting a new roadblock.
Oh, it can bounce up, but I mean,
scrutinize how the company handles its data. We have that story after this quick break.
not much. That's in 1 minute. Nah. $500. Look at the calls. Jim, are you using this trend line on SPX? Yes. It's a rising wedge. We're getting ready to squeeze. Support's going to be this previous candle at 473912. Oh yeah. Why don't you post a bigger chart of it? where you put them fibs. Let me see how you put the fibs on there. It's pretty tough. I would almost call that an ascending triangle.
I'm a member.
China's internet police now reviewing how Shein handles data. A potential setback as the fast fashion giant plans for an IPO. Our Deirdre Bose is watching that in today's Tech Check. Hey, Dee.
Hey, good morning, Carl. So one of the most anticipated IPOs of the year risks not happening at all. A source familiar confirms that Shein, which confidentially filed to go public in the U.S. last November, is facing a security review in China, adding that the review centers on its supply chain presence in the country, and it could impact the planned listing in a few different ways. One, this kind of high-level review by Beijing has derailed IPOs in the past. It all began with Chinese ride-hailing company Didi. Just days after it went public on the New York Stock Exchange, Beijing launched a similar probe, ultimately destroying billions of dollars in value and leading to its delisting within 1 year. After that, all Chinese companies seeking an IPO were subject to a security review and approval from the government, including TikTok parent ByteDance shelved or scrapped IPO plans altogether. But perhaps more importantly, this review itself draws attention to Shein as a Chinese company after it has gone through great lengths to position itself as non-Chinese. The startup moved its headquarters to Singapore and is diversifying its supply chain. Here is Shein's Group Vice Chair Marcelo Clare.
One of the misconceptions is that we do most of our manufacturing in China. And what I love about this company is probably this is the most global company I've ever seen, I've been engaged with.
Now, U.S. lawmakers are already skeptical. A bipartisan group of 22 Congress members is demanding greater scrutiny before the SEC approves the U.S. listing. But Beijing's review could be just as tough and far less transparent. Someone described it to me as a black box. Now, this delay could also have broader implications for our IPO market at large, last valued at $66 billion in the private market. Shein is the highest profile and most highly valued IPO candidate this year. If those plans are thrown off, we may not have that sort of. Shein itself is an important indicator of investor reception to new listings.
Yeah, is there a sense that Shein needs to go public? Given their business model, are they cash flow positive? Like, do they need the actual fundraising from an IPO, or can they kind of sit back, battle these forces for a while, and then go public when they get the necessary green lights?
Well, Leslie, we don't know because its financials are not public and it filed confidentially, so we don't have them. But I mean, you can only sort of think that if it is pursuing a U.S. listing, it maybe needs the capital to do so. One of the other Chinese companies that we talk about a lot that has made itself a huge presence here in the U.S. is Temu, right? But that is owned by Chinese company Pinduoduo, which is already public. So there is this idea that perhaps they need the capital. And remember, too, that this business model rests on really bargain basement, dirt cheap prices. And what we've seen in the past from these kinds of business models is that they subsidize for a long time just to try and acquire these customers, bring them into the fold, and then they slowly start to raise. So it's possible that they're burning cash now, but looking to become profitable. That's sort of been the business model.
It's just amazing that the phrase regulatory
We got
crackdown
1, 2, 3
never
coming
really
up on the
got far away when
SPX.
some of these China giants deep.
And we got to see if that support's going to hold.
It just raises
See
some
that, Mike?
questions. Don't forget as well, sort of the golden shares, right, that were implemented after the Alibaba fiasco, after the Didi fiasco. A lot has changed and changed Chinese companies and investors' minds over the last few years.
Yep.
Great look at an important story.
Same way with America.
In the months to come. David Bosa this morning with Tech.
We're all commies.
Still to come, Redfin's chief economist will join us. She'll discuss why 2024 could be the year that home buyers finally catch a break when Money Movers continues.
SPX hit the 200 on the 1 minute. So here we go. This is it. It's got to hold here. Let me see. 360. $4,740. Nope. Nope. Jimmy will show you. We have to move to a different trend. Ubits, 2B, and freebie. If this doesn't hold, I think we'll drop down and not hold this support. So that has to hold there. 10-4. Right now, we just triggered it. Secondary support. Where's my option? I don't know. I don't like the fact that we didn't hold this one right here. So that was major. Now this is your third support. If not, we're going to knife pretty good. Dang, I should have got me a put. I still expect a lot of volatility. Here's your next one right here. Maybe that area. 4732. Where's all my spies at? There. We got the VWAP on the SPY
7 points this morning,
at 471.91.
10 points higher in the past 2 months and is at its highest level since September. The move on the back of falling mortgage rates, the 30-year fixed rate is now at a 3-week low. That's leading to a more than 10% jump in mortgage demand week on week. Let's bring in Redfin's chief economist, Daryl Fairweather. Daryl, thanks for being here. So do you think that this moves the needle at all for homebuyer affordability?
Any little improvement in rates does move the needle. It moves it for home buyers, for builders. Rates haven't come down all that much, though, compared to where they were a year ago. So I think we still need rates to fall more for home buyers and builders to feel confident again.
So what you know, we teased this this segment as saying that you believe
She got a freckle right on her nose. Or does she?
This year.
No,
A
she.
lot of that,
Yes, she
as we've
does.
discussed, kind of is incumbent upon what happens with the supply of homes. How do you see that dynamic
That's a three-eyed chick.
shifting in 2024 that would yield kind of some loosening of the current situation?
This girl used
that
to be a
would make
boxer.
homes more affordable for
I can
people
tell
out
by her
there?
nose it's been broke.
We're seeing some early signs that there will be more new listings
Well, that's one hell of
this
a
year
place to have a
compared last
mole.
year. And that means more options for home buyers, and that gives home buyers more negotiating power to get a lower price. And at the same time, rates have come down from where they were in the fall. So both those things combined mean that home buyers should have a slightly easier time this year compared to last year. But from a historical perspective, it's still not a great time to be a home buyer.
What does it mean for housing prices overall if you're seeing more negotiations take place in these conversations for homes for sale? What does that mean for the values of homes that are already occupied?
I don't think a
BYDDF.
homeowner will be guaranteed an increase in equity this year.
Damn, I'm glad I didn't swing that thing.
Places that are gaining home buyers, Sacramento and Central California, for example. But other places where people are leaving, those home values may continue to fall, and at the very least, people can't be guaranteed an increase in their home values.
I was born in
Are
Sacramento.
you surprised at the some of the high frequency data that looks at, say, asking rents down 5 months in a row, down year on year, not feeding into shelter components of CPI? When do you think that really starts to happen in force?
It should happen. The way that CPI measures the cost of housing, you know, it's a bit indirect. It's a survey, and the survey respondents, they might be paying attention to what's happened to them personally. Like, has their rent gone up since the last time they got their lease renewed, which may have been 2 years ago. So I think that the current data that we see is going to start showing up eventually, but there may be months where it doesn't look like it's improving.
As you look at the kind of the mortgage lock-in rate, given the current dynamics of interest rates and the potential for a pivot, maybe in the second half of this year, depending on how things go, 89% of people with mortgages have an interest rate below 6%, and that's actually down from 93% in 2022. How does that dynamic shift consumer behavior as it pertains to their willingness to move out of their homes and or stay put?
We are still feeling the consequences of the loose monetary policy we had during the pandemic. When mortgage rates were at 3%, so many people, anybody rational, would go out and get a 3% mortgage at that rate, at a 30-year fixed rate they can hold on to for decades. But that locks people in place. We're seeing some more new listings pop on because life happens and people need to move on, and that mortgage rate may not be enough for them to stay. It's really just a financial decision. Are they better off staying where they are with that low mortgage payment, or are they better off moving and perhaps having a better job opportunity or better life opportunities in general? We're starting to see more people decide that it's time to move.
Yeah, and that's why your point about just the idiosyncratic markets is important. Daryl, thank you. Appreciate it.
Thank you.
After a big year for workers' rights in 2023, we're already seeing the momentum continue this year with Wells Fargo.
I was just looking at Tesla.
Unionize a second branch. So where else might union activity pick up? Our Kate Rogers has been following the story closely. Hi, Kate.
Hey, Leslie. Well, 2023, of course, was a banner year for the U.S. labor movement with grassroots efforts from workers in entertainment, airlines, healthcare, and more. Labor analysts project that momentum and public support for unions near all-time highs will bolster similar optimism in the year to come. Now, overall, union petitions only rose 3% in fiscal year 2023. That's according to the National Labor Relations Board. But according to Cornell's strike tracker, the number of workers on strike essentially doubled from 2022 to 2023 to nearly 500,000. And the workers that were on strike got big results from Hollywood to Detroit.
God, they're leaving it out the reason why they went on strike. Because of inflation. That's why it went up so much. I wish I had someone to represent me, but I got the federal government. That's not. If I go ask for a raise for my clients, you know what they'll tell me? We're going to go shop around a little bit, see what we can do. I've never raised the rates on any of my customers for 20 years. When I had my frame shop, I'd always had a surcharge or something.
During the pandemic, right? It really became a workers' market, and people were kind of gearing up for these fights and battles with their employers, saying that we want better working
Starbucks resisting unionized. Well, that's funny.
On that momentum, and I think you see the boldness in the labor market just with the number of workers willing to go on strike last year, right? Nearly 500,000 workers, doubling from the year prior, and seeing big gains. So they're feeling confident that they do have the power for these battles with their employers rather, and they're.
That's like free advertisement there.
Starbucks over a decision that was made by a lower circuit court saying that Starbucks had to hire back a group of workers known as the Memphis 7. They say that they want a uniform set of criteria for decisions like that in the future. So they took the challenge to the Supreme Court, and that will be another thing to watch this spring.
It's been pretty interesting. Feels like Fight for 15K was not that long ago, but 15 doesn't make as much sense in this inflation-adjusted world, you might argue. Kay Rogers, appreciate that very much. Thanks.
Thank you.
Speaking of the consumer and incomes, real incomes are growing, and that certainly feeds the retail sales number today, along with some of the capital gains we've had in the last few months.
Real income's growing, credit is growing, and we're seeing that back at levels, that we've seen kind of 2 years prior. Obviously, the market reacting to that today with the NASDAQ coming off of its lows, but still down about 0.8%. The S&P down about 0.5%, and the Dow essentially flat today. So it's really the growthier names that are taking some profits off the table today.
Meantime, Fed swaps implying maybe 50% chance of a cut in March. That was
DWAC
100% at the last part of last year. So those expectations have been reined in. You got the VIX back below 15, where it was above earlier today. And oil's been interesting to watch it defend 60 or so this morning, coming off of those lows.
That's been kind of range bound over the last few weeks, despite the ratcheting up of tensions in the Middle East.
Right, and that folds right into the deflationary story that we continue to get out of China. The judge at Post 9, let's get to the half.
Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. The state of the markets is more evidence of a resilient economy. Well, that sends rates rising, and stocks are trying to make sense of all of that. We'll debate it with the investment committee. Joining me for the hour today, Joe Terranova, Jenny Harrington, Jim Leventhal, Rob Sechin. Let's check the markets because we are red across the board. There you go. Dow's off the lows. Most of the major averages are. NASDAQ is weak today, though. Down right now by about, just shy of 1%. Feels like to me, Rob, the market is struggling to figure out, like, what retail sales today, what all of it means for Fed policy. You see, the March expectations coming down a bit on that strong number. So we're twisted trying to figure out exactly what the road ahead is going to look like for Fed policy because we've built in a lot of expectations.
No question. I think the way to think about it is let's realize in 23 we came in short, bearish, and expecting the worst, and in 24 we came in long, bullish, and expecting the best. And I think what's happening right now is that markets are pushing back against that narrative, as are we. I think there's going to be a lot of opportunity this year. We can talk about the playbook in a little bit, but there is a wide range of outcomes that could happen with equities. I mean, you can see a scenario where the Fed engineers a soft landing and we get to the 5,200 that Tom Lee's talking about. That's nirvana. Has to be near perfection.
That's kind of the top end of your range, too, in the best case scenario for your outlook for this year, right?
That is. And everything has to go right in that scenario. We suspect, though, that we're going to be challenged throughout the year. I think what we say is we're data dependent. So we're hanging on really every word, every data point to be able to see opportunities at the lower end of the range. So what we would tell our clients is that we want to be mindful buyers if the market gives us that opportunity to do so. And we want to be pausers because we're long-term investors. There's no question about it. We're not selling when the market gets to the upper end of the range. We're undulating the accelerator and reacting accordingly. And I think now's the time to pause and see if it's a pause that refreshes. You know, the bond market's sending a lot of various signals, right? The 2 years specifically, and is it one of worry? Truth is, we don't know that yet.
I like that you bring it up that way. We don't know because, you know, does the strong economy, Jimmy, mean the Fed's going to cut less? Well, what if you don't believe the economy is as strong as a retail number would lead you to believe? Because some of the other data hasn't been all that strong at all. Then we start to think about, well, what about a policy mistake? Fed stays too tight for too long. It leads you to what Waller said yesterday. And remember, he's sort of emerged as this person within the Fed that, you know, he arguably caused this whole rally from the end of October until the end of the year. And he now seems to have put a little cold water on the rally over the last couple of days and caused this move higher in interest rates, where he says that policy is set properly. Those are quotes. That the Fed should lower rates, quote, methodically and carefully. No reason for the Fed to move rapidly as in prior easing cycles. It goes to where I started. We're not really sure what's exactly happening and how the Fed's going to react to it. But the market has priced a lot of stuff in.
Yeah, and I think it's safe to say that we're not sure. I'm not waking up in the middle of the night worrying about the markets right now. I will acknowledge to everyone watching that this is a heavy tape right now. I mean, no question about it. This is a heavy tape. And I think that this is just simply an adjustment to the idea that we're not getting a rate cut in March. And we shouldn't have gotten a rate cut in March, but we're very likely to get one in May. And I think the market just simply got ahead of itself. But I do still commit to my overarching belief that this is a year in which earnings matter far more than the Fed. We're talking about when the Fed's
Always
gonna
clean
cut,
as Jim.
not if they're going to cut. We're talking about the Fed cutting, not how high are they going to continue to raise rates. And that's a complete tone change in which news like today about retail sales and industrial production coming in better than expected is good news. It pushes off further the idea that we're going to have a recession or a hard landing, both of which, or excuse me, they're both the same way of saying that that would impact earnings, which again is critical, because if you want the rally to 5,100, Tom's at 5,200, but I'm at 5,100, you have to get that 12% earnings growth this year. So to the extent you got retail sales that says consumption's strong, employment is strong, that's what I'm looking for. I'm not worried about the market adjusting to the Fed now moving in May instead of March.
Yeah, but Ginny, one of the key issues, certainly one of the key questions is whether sentiment and valuation are offsides. On the sentiment issue, where, you know, as Rob perfectly laid it out, how we came into last year and now how we've come into this year all bulled up on everything, right? Inflation's coming down, earnings are going to be good, economy's going to be strong, stock market's going to be good. Jamie Dimon was a little, maybe he said there was too much optimism in Davos. Let's listen.
I think it's a mistake to assume that everything's hunky-dory. And, you know, and when stock markets are up, it's kind of like this little drug we all feel. Like, it's just great, you know. But remember, we've had so much fiscal and monetary stimulation, so I'm a little more on the cautious side, that we are facing a lot of things in 24 or 25.
Is there too much optimism?
Yeah, I think so. And I don't think that it means we're in for a big crash or a huge retraction. So here's kind of the way my math works out on that. When you say, you know, has that sentiment, has that enthusiasm pushed valuations off sides? So the way I look at it is, if we can get to consensus earnings, which is $247 a share, that's assuming 11% growth over last year. You put a 20 times multiple on that, that gets you to 4,900. You put a 18 times multiple on that, that gets you to 4,400. So I look at it like a range. If we can have Rob's perfect scenario, right? Everything goes great. I think we get to 4,900. That's up 4% and change from here. If we're kind of in, you know, valuations not being totally offsides, hovering at 18 times, that's down 7% from here. So I think it's offsides, but I think the magnitude this year should be more tame than what we've seen in the past 2 years. I mean, we're coming off of some crazy emotional swings, right? Thinking about 2022 with the market being down 18, last year with it being up 26. I kind of like where we are right now, because we can point to anything, we can point to everything, anything, but I think the reality is we just need time to digest, and I think it's a pretty healthy, I would be thrilled if we end this year flat after a plus 26% year. So I think it's a healthy place to be in, where we're not getting crazy with overly robust expectations.
What do you think about what Diamond said?
I think there are always concerns, whether it's geopolitical or economic. I think in 2024, yes, we have
I mean,
concerns.
this
And I think one of those
DWAC really got
concerns
some good
is what you
news.
cited before, and that is ultimately what the direction of monetary policy is going to be. Are they going
Trump
to
media.
stay too long? I think that's the
I meant
risk,
that
they do stay
TUP.
too long. I also think when you take the totality of the first 17 calendar days of January,
No, that's Tupperware.
what's
What was that
missing
other one?
clearly to me is follow through. Follow
Dang,
through
Gummer.
from where we were on Wednesday, December 27th.
I can't remember that old
when the
stock.
10-year Treasury was 378.
Unless it was just
and we were
DWAC,
talking about a 10-year
but I don't think
Treasury
it was.
to 3.50. You never got that follow through. And Scott, because you didn't get the follow through, once again, you're seeing that capital is frozen. You've talked to a lot of people in the asset management industry. They will tell you that a lot of the money that was in motion at the end of the year is once again frozen because you're challenged by a 10-year Treasury above 10%, and people are still sitting in those cash yielding equivalents.
Maybe you're challenged by valuation because you're trying in your own mind to justify the valuation of the market when you look at where we are today versus the 10-year average. The Dow, for example, 17.5 times today, 16.5 times is the 10-year, Rob. S&P 500 today, 19.5 times.
Things are just
10-year
flipping
average,
out on my
17.8.
computer.
NASDAQ 100 today's 25. The 10-year historical average is 21.7. So we had the Dean evaluation from NYU. Aswat Damodaran on Closing Bell with me yesterday, and he said, yeah, it's extended. Listen to what he said.
I think right now the market is overvalued. I mean, my estimate is about 9–10%. And part of the reason I think is the expectations game has turned against the market. I mean, if you remember at the start of last year, and recession was almost guaranteed, rates were going to go up, inflation was out of control. And every strategist that you had essentially said it was going to be a terrible year for stocks. the exact opposite. Everything turned out to work in the opposite
This guy's
direction.
smart.
My fear is that we've moved too much in the other direction. Now people assume there's no.
Who is this guy? I got to
inflation
follow
under
him.
Control and everything's going to be okay. So I think this year, good news is going to require a lot more than it did last year, and that to me is why I think stocks are in a dangerous place right now.
Darren?
I think he's right, at least in the short run, because even if you look out 2 years,
I said
you
it
go to
too.
25, and you assume that the earnings deliver, and you're at 270, you're still at 17.5 times. It's still a very frothy market from a valuation perspective, and that's why
Anybody with common sense knows that these guys are pumping this frickin' market, and they won't shut up. I mean, I've been trading this market for 20 years, okay? I'm serious. And I've seen breakouts, but there's always been a reason. And they have not been right. They've been up at the Fed was wrong from day one when Biden took office, said it was just, what do they call it? Centristic or whatever it is. That didn't work out. Then you got $6 trillion printed in 3 years. And this run that we've had, and they just won't stop at the 52 all-time high, the double. They don't want the market to consolidate. And they're giving these outlandish upgrades. NVIDIA, 1250, 650 when it was at 400. JP Morgan, 220. Just crazy 52-week high, double tops. All-time, these stocks are like at all-time double tops. And they're upgrading them 100, 120 bucks above their Lilly. Look at, I mean, anybody with common sense, just look at that chart, would go, are you serious? They got real complacent with the good run we've had. And that guy is just spot on. They're never right. And they priced in 6 rate cuts. And now we're getting like this news, like we'll be lucky to get 3, and the first one will be in March. You can't put 6 rate cuts in from March to the end of the year. It's just impossible. And you can't do it during an election year. That's another thing that got me. Can you... Okay, they say that Pow Pow's a Republican, which I don't think they should have any kind of political affiliation at all. They should just keep their mouth shut, not even vote. But there's just you sum it up, it's just crazy. 178 all the way to 650 in 3 years. They're wanting to run this up. Netflix the same way. I don't know nobody that has Netflix, but people I hang with don't watch TV. They play music. We used to sit around 2 or 3 nights a week in a circle and just jam for years. Raises price target to $5.85. See, here's a $100 price increase from B&A that came out today. $5.85, and we're at $4.80. Just nuts. I mean, well, they got we run it to 700 during COVID. I guess that could happen. I bet you we'd knife on earnings. I'm not going to buy a put, nor am I going to buy a call. If I was to buy, I mean, we're set up for 1, 2, 3-bus to come up to the upside and hit it for the third time. I'm not going to call that wick. Well, on a daily, I'm not going to call that wick a resistance level, but it is an all-time high. I mean, for the year. But man, to hear that guy say that on CNBC, you guys got it wrong.
Around 2.2%, margins improving. I've said this for a long time. You look at the PPI so far below CPI, that equates to margin improvements. It is likely to get that earnings growth. What we're not talking about is all the other stuff, and there's a lot of it. Okay, the Middle East is this close to blowing up. One stupid thing on the northern border of Israel, and that's partly what the market's worried about. It's also worried about politics here in the U.S. and elections across the globe. My point on this is not to say that there hasn't been a rotation of quality. There has been. My point is to say that outside of that quality, if we're talking about valuation in the markets and being overvalued, it's in those bang quality names. It is not in the small caps at 15 times this year's earnings.
Yeah, I think we're kind of all over the place. I agree with Jimmy when you're talking about valuation. Small caps are not overvalued, but your point is well taken, and your point is at the end of the year, you saw capital going into the neglected areas of the market.
Where?
And it's because of what I identified at the top of the show and what Rob just also mentioned. And it's because rates looked like they were going to move significantly lower. And they have not. And there's an effect of rates moving higher on the balance sheets of companies that are not as profitable as the mega caps. So really what has not unfolded so far this year as rates have risen is that people have begun to shed their exposure to these quality names and move into the areas of the market that were neglected last year and are reliant on what the cost of capital is. And that process isn't going to unfold unless you see yields begin to retreat. If yields stay elevated, this is the formation we're going to have. And I think you're going to have this formation through the first quarter.
I don't think Jimmy's argument that all these other stocks are cheap or undervalued
You got it right again.
is the argument. There is no argument to that. Yes, they are cheaper, okay? They're cheaper. There's a lack of confidence to buy those names. It has nothing to do with the valuation of those stocks. It has everything to do with the confidence on the direction of where we're going and what the Fed's going to do. Period. End of story.
Can I ask Joe a question?
The other 493
ties into this. Let me do this to you. What happens if the yield curve uninverts? What happens to the market?
The yield curve looked like it was going to uninvert.
Yeah, now it's reinverting.
Yesterday,
Now
we
it's
were sitting
reinverting.
on the
By what, 25 basis points?
So?
I mean, we were talking 125
So?
basis points 6 months ago.
Okay.
My point being is that's an indication of economic strength.
Okay. Yesterday, the yield curve, 2 to 10, was negative 15 basis points. Okay, we were coming very close to getting back to disinverting. Today, we're seeing a dramatic move in the 2-year. Now the disinversion is lost. It's inverting. It's deepening. It's minus 25 basis points.
Oh
so I think, no, but Jimmy, I think the right word to use, okay, is tell me if the 7 stocks, forget the other 493, because in the other 493,
you asking me?
you can find opportunities. I completely agree with you.
Are you talking to
JP
me?
Morgan being one of them, we know the list. But what you have to acknowledge is those 7 stocks are incredibly attractive in the type of environment that we are in right now.
All 7, Joe?
And profitability.
All 7?
Take out Tesla. Profitability is being prioritized. What your margins are. You're seeing when companies are missing, like Morgan Stanley yesterday. It was a margin miss. When you're missing on the margin, the market is punishing you for that miss. And I think that's incredibly important. We're back to a place where the fundamental metrics are going to matter. And you can't tell me that you're going to find better fundamental metrics than you could find with Microsoft, Alphabet, Apple, and Amazon.
Let's talk some others in quotes. Interactive brokers. Since we're talking about earnings.
See it? We got a market that's only running on 7 stocks. And looks like we got a ready squeeze here on the SPX. I'm going to do a video tonight on the market makers. Google's not been hit yet. Well, it has too. Google can go up more. It's the one that's been shy. At least fill up this resistance level at 145. He kept asking Jimmy questions.
Shares were down a lot. Now, let's take a look at a real-time look at Schwab, because they seem to have paired some of the losses. So they have, in fact, done that as we've worked to noon here in the East. What's your take here?
So they reported earnings, and like top line EPS came in 6% ahead. But once you took out taxes, you realize it was down by 3%. And I think that kind of jarred, I don't know, the algorithmic trading programs, because again, no one with a brain would have read these earnings and said, boy, the stock should be down 7 or 8%. So then people actually started listening, thinking about what was going on. And what they saw was that total client assets are up 21% year over year. There's a lot of noise in here. There's still the TD acquisition sorting through. They're seeing the end of cash sorting. But once you step back, here's what you have. You have a company that's trading at 17 times earnings, and you've got earnings growth of 17%, 28%.
So let me go over my top stocks on my watch list. The DWACS really had a good day here today. I thought there was another one that had to do with Trump. Something about a pipe deal. Trump links back to Digital World. Hardly got any alerts today. What is that? What is that? Oh, that's a different chart. You're looking for a possible bounce at 47.2806. Well, the way these guys are arguing on CNBC, we might see another daily double bottom. Don't you think, Carlox? We should have shorted it. We had the 1, 2, 3 bits. And we were right here when I said we were going to hit the VWAP. And we got an RSI crossover. Thinking about going in there and making my lunch and coming right back and doing some killer trades. What'd you have, Mike? 4728. I got 472805. You got 472806. So we'll go with your number. I'm 1 penny off. So go with Mike's number. What do you got, DWAC at 24? Vegas called this one out. She said she won a contest. I got 2244. $24.79. I see your 24. Actually, right in here, 24.33. I like that spot. Someone said alert off the 200. $200 SMA. What am I thinking here? Ooh, fireworks factory explodes.
Kicking in on the crypto craze, most of the new spot Bitcoin ETFs are trading lower. And we're going to find out what's driving that action in today's ETF Edge. Bob Pisani has it next.
Okay, we're at my support here at the 200 SMA.
BC.
Bob Pisani has today's ETF Edge, and we're talking some of those crypto ETFs.
We are indeed, Scotty. Bitcoin ETFs launched last week with big volume. So how are they trading now? And what's next? Let's ask Catherine Clay. She's the Executive Vice President, Global Head of Derivatives at Cboe Global Markets. Catherine, thanks for joining us. Cboe launched 6 spot Bitcoin ETF products last week. Tell us, how are the products trading relative to Bitcoin? Are they tracking?
Yeah, the products came out with a bang, obviously. We saw good inflows into all 6 ETFs that are listed on the Cboe markets. And they continue to track closely with Bitcoin as expected. But the good news is that we're actually here, Bob, talking about the price movement of Bitcoin spot ETFs, which is long in coming, obviously. So celebrating the fact that we get to have this conversation.
Yeah, it's been 10 years, actually. So it seems like the next logical step is options on spot Bitcoin ETFs. What can you tell us about that process? How far along is Cboe with all of that?
We couldn't agree more that options are the next logical step on these ETFs. We really believe in an asset like crypto, and Bitcoin in particular, that options add exactly that utility that are really important for risk mitigation and additional opportunities for investors and traders to add to their portfolio. We filed with the SEC for permission to list options on Bitcoin ETFs last week. And so we're really in this holding pattern of waiting to see what the regulators will do with our filing and other exchanges' filings as well.
I know this is a new product, but how long would you anticipate it would take? Normally, it would be a couple months for a typical product, but I know that it's a new product. Will we see something before the end of the year?
It's really difficult to know even if we will see approval. So I want to stress that approval is not guaranteed, and certainly visibility into the timeline is difficult. I think for viewers, it's important to point out why these ETFs are a bit more nuanced than a traditional filing for options on an ETF, and that really comes to the fact that this ETF is based on spot Bitcoin. And so these are different than the historical ETFs you might list on other securities. And so there's more complexity in our rules around these types of filings. It also requires our Options Clearing Corporation to do similar filings with the SEC and the CFTC.
You know, I can't help but notice that Bitcoin's 2-year peak in price occurred the day the ETFs went public last Thursday. So there's this inclusion effect. We had a nice run-up in Bitcoin going into it, and it's been down since then. Any thoughts on that?
Well, as a trader myself, I remember the old adage, you know, buy the rumor, sell the news. I think there was a lot of anticipation running into this announcement with the approved Bitcoin ETFs. There's no explaining day-to-day price movements of any security, let alone this one. I think right now we're in a little bit of a risk-off pattern if you look across the markets today, so it's hard to speculate on just day-to-day price movements.
Okay, thank you, Catherine. We're going to have a lot more on the next steps for Bitcoin ETFs coming up on ETF Edge. That's 1:10 p.m. Eastern Time. Catherine's going to be joined by Dave Noddick. He is the financial futurist at Verify. Then we switch gears and talk to climate change. We talk about energy transformation and infrastructure. Jennifer Grancio will be joining us. She's head of global wealth for TCW. They recently bought Engine Number One. That was the company, remember? They became famous for winning 3 seats on the board of Exxon with a demand to take climate change more seriously. We'll get an update on their Transform Systems ETFs focused on energy transformation and infrastructure, and what the website described as brown to green companies. All that coming up. ETF Edge.
I'm not confident in any of these right yet.
Back to you.
All right, Bob, appreciate the update there. Thank you, Bob Pisani. Coming up, more
The
contrarian
only 2
ideas
that I
for
like are
2024.
GBTC
Today, an unloved sector,
and
he
BITO.
says, has some serious opportunities in this new year.
Maybe this
We'll make the case next.
IBIT, these top 4. Okay. We've got a snake here. Let's draw it out. I'm going to set alert down here where we had this pullback right first thing this morning.
washboardjim.com.
We're back. We continue our series of contrarian ideas for the new year. Rob Sechin, of course, is here today. Hasn't given his yet. So what do you think?
Biotech, IBB, if you want the ETF. Why is it hated? It's relative performance.
Yeah,
I mean,
it's been
it's been an absolute stinker. Underperforming the S&P by 20% last year, which is the largest since the 90s, and by 40% since 2020. And this is despite what's happening in the healthcare space. So why do we like it? Reasonable valuations, returns to earnings growth, low expectations, slightly improving sentiment. You've had some people talk about it on the show this year and all across the network.
Bunch of deals in the space.
They always call them at a resistance.
M&A is another one. And you know, when we look at this, we mainly own it through securities in our portfolios.
Amgen, Gilead, Vertex, Regeneron, those are the
all of the above. You have incredible visibility into what we're doing there.
Well,
Scott.
I mean, we sort of demand transparency on this program in case you haven't noticed that up until this point.
I do notice, but if I was somebody that wanted to put it on easily, those names represents 30% of that ETF. Yep. I just use that ETF as a way to get that exposure, and then you can rent it. You don't have to own it long term in case the thesis doesn't play out.
Got some owners. I got some owners. I'm sorry, right, Jimmy? You have Vertex.
Thing's been a beauty. I mean, just a great story of a company that had a one-trick pony in its cystic fibrosis business, but now has managed to really expand into things like sickle cell anemia and pain medication. That's just a great specific story. I happen to agree with you on the overall call, but I do find it better to actually pick stocks than go with the index.
No, and that's what we've done, but I'm talking about for the viewers that want to.
The problem with the index and the industry in general is there's a lot of rolls of the dice in here, right? There's a lot of companies that are waiting for a drug to be approved. They're waiting for trials to come through, and it's totally digital. They either hit it or they don't, and that's always left me a little scary. So that's why I like to pick stocks in that sector.
Of course. I mean, biotechs are always a bit speculative. I mean, that's sort of, you know what you're getting into when you get into it. Regeneron's yours?
Right, and so that's been a home run for us. It's actually to the point where it's been such a home run that we're thinking about, at 20 times earnings and a 4% free cash flow yield, does it still make sense? Does it still have the earnings growth ahead? But I think the more important point is what Jim said, which is within the biotech, which I think it kind of, again, it goes back to small cap, mid cap, whatever it is. Just go in, dig down, do the work, and choose. Like, each of these areas have really great opportunities.
That's going to lead you to the more mega biotech names, though, right? I mean, that's where we're all going to be because of the quality associated with those.
But my point is, like, there's pockets out there where there's opportunity available, and like biotech is rich with opportunity because the entire thing's been thrown out. So sort through, and you're going to find gems out there. So yeah, Regeneron's been fantastic.
We also own Regeneron. We own Vertex, and then keep in mind Eli Lilly is trading like a
can't do
biotech.
this.
1 point on biotechs overall. Let's remember, as rates rise, that's a little bit of a challenging environment for them.
All right, coming up, we are going to trade more stocks on the move today. Got 2 big winners, 2 big losers in today's trade. But first, Mike Santoli, his midday word is next.
I just can't do with him. The 9 and the 21 are about to meet. When we get that crossover, we're in it. I say even if we break out of the channel here, get your order ready. The 47.40 strike. $47.40 strike. January 17, 2024, the 4740 strike. I'll get 3 of them, or 2. We've got resistance at 4732.17, so we're going to come back and retest and hit that trend line. The 9s, was pointed out in the room to me by Mike. He's one of our good traders in here. It's 9 crosses the 21, 9 EMA over the 21 SMA. There's a scalp right there.
There is senior markets commentator Mike Santoli with his midday word.
TGM trend
really
starting to cross
like
over.
The market's not really sure now what to make of the retail sales and
Ready, set, go is set up.
Put Waller into the stew, and I'm not sure what you put in the bowl.
Well, I think, Scott, first of all, the backdrop is we're 3 weeks into this kind of internal pullback, payback mode we've been in for a bit, and it's really evident in the breadth numbers. Very weak again today. So you're seeing some of the kind of reset happening below the surface of the indexes. And yes, because the 2-month rally got everybody exceedingly confident about both legs of the soft landing hypothesis, the lower inflation, immaculate disinflation, plus resilient economy, you're getting tested, I think, to some degree on both sides of that. I happen to think a better economy with maybe delayed rate cuts or fewer rate cuts is the preferable path. But at the moment, you have to kind of sort through the idea that neither one gets satisfaction for a little while. I was sort of sympathetic last week. HSBC came out downgrading to kind of a neutral or underweight in risk assets temporarily, saying there's a reverse Goldilocks period we might be entering. I don't know if that's what we're in or not, or we just have to have a routine pullback. But it seems like the market's a little bit unsettled. VIX at 15. See, just some signs out there that because of this expiration week, mechanically
we had our
a little bit
pullback.
fragile, but so far not a lot of damage at the index level.
Yeah, no, Nasdaq's down about 1% right now, and as far as the everything else idea of the market, there's just a bit of a lack of confidence. You can feel it that the buyers are going to come in right now for those other names.
People wanted it too bad. They took credit for it. They applauded it. It was a 2-month respite. We'll see if that was all it was.
Yeah, we'll do. I'll see you in a couple hours on Closing Bell. It's Mike Santoli coming up. 2 big winners, 2 big losers. Trade them next.
Are you following the Halftime Report podcast? What are you waiting for? Look for us in your favorite podcasting app. Follow the Halftime Podcast now.
I gotta see if I get my retest. If we go ahead and break out of this here, I'm in the trade. If we pull back and hit that, I'm in the trade. But I can't get in until we break. Now. Boom, baby. Good call, Mike. Got 3 white soldiers breaking out.
impossible.
It's impossible.
Welcome back. Joe, we're talking about Monster Beverage for a minute
Go
because
ahead.
it was reiterated a buy at Goldman Sachs today. Price target 68 from 62. You own it. We just didn't get to it earlier, so let's do it now.
Absolutely agree with the call. This is a consumer staple company that grows its revenue 15% over the last 3 years. Think about a consumer
really made a
staple
bad
company
entry on
with
that
the
one.
ability to do that. Recently, it's pulled back slightly. I still think this is going to get above $60. Monster Beverage is clearly in the sweet spot with their business, and they've diversified their products tremendously over the last several years.
Okay, so let's highlight two big winners today, two big losers that we didn't get to. Humana's up today, was up 3%. We can take a look and see where it is now. DraftKings was up as well. On reports, the NBA is in talks to take a stake in ESPN, possibly other betting platforms as well. And then on the loser side, Jenny, one of your stocks is on this list. XPO is down 5.5%, or at least it was earlier. What's up?
Well, I think I would take that loser and turn it into a winner. It's actually up 120% in the last 52 weeks. So what's happening right here is we see things like JB Hunt getting ready to report, and there's concern out there that shipping may be weak. But when you look at XPO versus, say, Old Dominion, you've got XPO still trading at 10 times EBITDA, where Old Dominion trades at 18 times. So you've got a stock that's up 120% over the last 52 weeks. A little bit of concern coming in there, which gives us a little bit of pause. But then you step back and you say, okay, but the valuation is still really, really compelling. Earnings growth should still grow 24% next year. So we're holding on to it. This 5% after a year like that, I'm completely unfazed. To me, it's not even on the radar.
Okay. Jimmy, Wynn Resorts today was down more than 3%.
Yeah, it's still being held hostage by any news out of China, as that may affect their Macau gross gaming revenue. Having said that, for all the worries about China's growth over the last year and a half, Macau gross gaming revenue has grown by leaps and bounds, so I think the market is really getting that wrong. Additionally, this should be as much a Las Vegas play as a Macau
Go,
play.
baby.
Bottom line is this, it's undervalued, they're likely to report earnings and more share buybacks in a month, so just hang on to it.
No one else owns any other casino names, right? You look at any of these things?
Casinos?
Yeah.
No, casinos is not something that I invest in.
Dinosaurs in the desert, is that what people call them?
Yes, I've correctly called them that.
You have?
Yes, I have.
That's what I thought it was you. All right, Jimmy.
You were so apoplectic. Casinos?
What's this stock? What did it do last year?
Not good. Not well.
Why?
All China concerns. All entirely China concerns. And I'm going to make this point again. We know what happened in China. That's not what happened in Macau. Look, you can look up gross gaming revenues in Macau, and you can see that month after month they are increasing and increasing nicely. Cash flows are going to be great at when they're going to buy back shares.
The stock looks like it's been decreasing and decreasing.
Yeah. Well,
It's actually flat.
Yeah, it's kind of Jimmy's
From
way.
October.
It's kind of
Okay.
flat.
You
That
know,
was Jimmy's way of saying I was right in our argument a couple of years ago.
Listen. I've held this for about.
Wish you'd keep my name out of it.
Months. It's outperformed the S&P 500. That being said, last year was not good. Was not good.
Kind of flat? What do you mean, Jenny? It didn't do anything until December.
Okay, but I'm just saying over the last 52 weeks, it's only down 7%. It's
By
kind
the
of
way,
flat.
it
It's not-
was
it's
up
not
about
terrible last year.
15% from mid-December till about 2 weeks ago, a week ago. It's just, it gets knocked down, and it doesn't have to be on these stupid China news.
All right, we'll do finals next.
Doesn't strike me as a Jimmy.
Thank you, Mike. $60. We're at the VWAP on SPY. Whippoorwill.
fashion.
You can't do that. It's retesting.
Today. Of course, I'll see you in a couple hours of closing bell, but I want to remind you as well, on Friday, we're going to be out in the Coachella Valley for the American Express PGA Tour event. It's the old Bob Hope. We're going to have interviews with several CEOs and special guests. I hope you will join me. Our coverage begins at 8 a.m. Eastern Time. Steve Squarey, he's the MXC.
The intro to The Good, Bad, and Ugly by Clint Eastwood. Let's break it.
What he says may surprise
I'm going to
you.
go make my
And
latte.
Chanel
When I
launching
get
its
back,
first
this
ever
thing better be
deal
up.
Barometer, and they are sharing the results exclusively with us this hour. But we begin with today's markets and Dom Chu covering the numbers for us. Dom.
So Tyler, we're in the red, fractionally so, with the underperformance in that kind of tech-heavier NASDAQ trade.
That's a buy right there. They're coming in.
1% that equates to 100 points to the downside, 37,258 the last trade there.
Come on, Mr.
The S&P
Chu.
500's at 4733, off about 2/3 of 1% or 32 points to the downside. And the NASDAQ composite currently stands at 14,809, just about 135 points to the downside, or down roughly 1 full percent. One piece to keep a close eye on, Tyler mentioned those stronger than expected retail sales data out this morning. What that has done and gone and done is pushed interest rates higher. People selling off government bonds on the U.S. Treasury side, pushing yields to 4.09%. We were close to just around 4.12% at the session high so far today. And what this does do is put us at the highest yield levels for the 10-year going back to just roughly December 13th. It's not, again, near the 5% mark that we saw at the cycle high so far, but this move higher off the lows has a lot of investors paying some attention. And where that's playing out a lot more is in valuations, specifically with regard to growth-oriented and technology stocks. If you take a look at the biggest stocks in the NASDAQ composite and the S&P 500 for weighting, it's that mega cap technology trade. Microsoft down about 0.2%, Apple down 0.75%, and north of 1% losses for NVIDIA, Alphabet, Amazon as well. So keep an eye on those moves there in big technology. Interest rates are part of that story. We'll see if that trend continues. It's a rocky start to the year in 2024, Ty.
All right, Dom, thank you very much. We'll see you in a little bit. Let's start with the consumer, and the latest retail sales numbers came in stronger than expected, up 0.6% in December. Now, you couple that with the continued strength in the labor market, and the Fed may be in, well, no rush to lower interest rates, something J.P. Morgan Chase's CEO Jamie Dimon touched on earlier today, especially the implications for commercial real estate.
If we have a soft landing, which is possible, and rates don't go higher, which is possible, it'll be a small problem. If we have a hard landing and rates don't go higher, it'll be a bigger problem. And if we have a hard land with higher rates, which I still think is possible, it'll be a bigger problem.
Because inflation goes up even
Jamie Dimon don't sound too confident.
Logical constants. Yeah. Anything which has cash flows is worth less.
All right, our next guest agrees that this is probably as good as it gets for the economy, and while the odds have steadily improved, he still sees a 25% chance of a recession next year, or this year, excuse me. Let's explore why with Mark Zandi, chief economist at Moody's Analytics, along with CNBC senior economics reporter Steve Leisman. Welcome to both of you. Mark, let me begin with you. If the economy's performance is about as good as it gets, why do you say that recession risks are still elevated at 25%? Down from the 50% you thought was likely last year. Didn't happen. But why
when
do
I
you
saw
think
this
recession
candle
risks
appear,
are still elevated?
that kind of got me a little excited.
Well?
This one right here.
Tyler, I don't think we can feel entirely comfortable about the economic outlook.
We had a tweezer bottom.
The Fed starts lowering interest rates. I mean, they're close.
And then this big hammer.
They're forecasting 3 rate cuts.
And that hammer didn't take too long to get up there.
So we're
it was like,
almost there, but until that happens, it's hard to declare the coast is
China.
The coast is clear here. With rates this high, the yield curve is inverted as it is. That puts a lot of pressure on the financial system, banking system, and so things can go off the rails. So I'm feeling pretty good about the economy. All the trend lines.
I mean, if you got in with us and it's at 440,
I even think there's some.
I got in at 370
for the economy as well. But until the Fed starts cutting rates, I don't think we can declare victory.
What would an upside risk be? What would it look like?
What we got in 2023, I mean, it looks like GDP growth in 23 is going to come in at 2.5%, which is really very good above.
No, it is not.
Most estimates of the economy's potential.
It's below average.
Because we got a lot of growth.
3 is very good.
And labor productivity growth was also
GDP.
very strong. And that could continue into 2024. And if it does,
Who's
there's
this
more
guy?
room to run. We could get more growth without having any pickup in inflation, and the Fed can cut rates. That's an upside scenario.
Steve, what do you make of what Mark has said here? Elevated risk of a recession at about 25%. I guess normal is something in the 15% percentage rate. What do you say?
Well, I've been reporting through our Fed survey, Tyler, that the recession
cut
rates
out.
were as high as 60% last year, and now in the December survey we did, they went down to 41%. So if Mark tells me 25%, I'll take that as a victory and a really good sign. I understand why there's something of an elevated chance. You want to go back to normal, which would be about 15%. But Tyler, I want to lay out for you what I've been thinking about here, which is I think the Fed can cut 3 times here beginning in May, which is not what the market's after, but it gives it a little more time. Can do it 3 times, May and then July. And July I like because it's just before the silly season when it comes to the elections, and it's not a factor there. And then again in November, because that November meeting happens 2 days after the election, and then it has an option if it needs to or wants to do a 4th one in December. So that's my latest thinking, Tyler, that the Fed can pencil in 3, and there's been some precedent here for Powell liking to do things every other meeting. And one of the things that's interesting to me is the Fed's concern about a resurgence of inflation, what I call its fear of the Twin Peaks. And you see that when you look back.
I'll be right back with my mocha.
1970s, you can see the 2 Alpian peaks there when it comes to inflation. And then you see we got the 1 peak now, and it's you know that between those 2 peaks in the 70s, the Fed cut interest rates. And that's why I think the Fed's going to be careful here, and more careful than the market is projecting.
All right, we're going to take a quick pause here, and I'm going to ask you both to stand by as we go out to Rick Santelli, who's tracking the action in 20-year bonds. Rick.
Yes, Tyler, we just had an auction, a reopening of 20s, the tune of $13 billion. The auction just buttoned up. The grade D is in dog. This was not a pretty auction. I will hit the highlights. If you look at the bid to cover, 2.53, it equals March, but you have to go back to October to find a lower number. And indirect bidders and dealers are at the worst level since Nova of 21. Let me explain. Indirect bidders, those are, some of the most important bidders, foreign entities. They were definitely not showing up for this auction. Dealers ended up taking 17.3%. Their 10 auction average is 11%. Like I said, worse since November of 21. And as you look at the chart going back to the second week in D, should we close here? It will be a 5-week high yield close, just like 10s and 30s. And as you look at the intraday and the 2-day, what is notable here is that we are trading above yesterday's high yield.
Caca.
He is in dog. Tyler, back to you.
D as in dog from Rick Santelli. Thank you, Rick. Gentlemen, stick around. We're going to
Okay.
Diana Olick with the latest housing market.
We're on the teeter-totter here.
Well, Tyler, you were talking about consumers, and two sets of data out this morning show consumers are getting back into the housing market thanks to the recent drop in mortgage interest rates. Mortgage applications to buy a home jumped 9% last week compared with the previous week, according to the Mortgage Bankers Association. They were still 20% lower than the same week 1 year ago, but they have been rising steadily for the past few weeks. Mortgage rates last topped out around 8% in October and are now back in the 6% range, although they did make a move higher this week and today, now to 6.88%, the highest since December 13th. Now, in addition, we saw a big beat on home builder sentiment in January. It jumped 7 points to 44 on the NAHB's monthly index.
Damn it.
The street was looking for just a 2-point gain. Anything below 50 is still considered negative, but it has now moved 10 points higher in the last 2 months, and it is now at
What the
highest
heck?
level since September. Builders say, again, it's all about lower interest rates. And of the index's 3 components, current sales conditions rose 7 points to 48. Sales expectations in the next 6 months up 12 points to 57. That's back in positive territory. And buyer traffic rose 5 points to 29. Fewer builders also are cutting home prices, 31% in January, down from 36% in the previous 2 months, and that is the
I might have screwed
lowest
myself on
since
this one.
last August. Tomorrow we'll get a read on how all this new confidence is playing into housing starts and building permits. Tyler?
So Diana, these more sprightly numbers, I guess, have to do with
Okay, here we go
where
for a
rates
double.
were in October, how they have receded a little bit. And that seems to be enough to have changed the sort of mindset among buyers and sellers. They're not as high as they were. They're certainly not as low as they have been for the past decade, but enough to get them feeling better about buying, selling, and building.
Yeah, we all know, Tyler, that home buying is a very emotional process. It's not just about being able to afford it, but it's like feeling that you should be able to afford it. And that 8% handle really had buyers out of the market. Even 7% was too high. But on this 6% range, as you said, we're twice as high as we were in the first 2 years of the pandemic. We had more than a dozen record lows in that rate. But buyers are, we know there's a lot of pent-up demand out there and not a lot of homes for sale. So still people coming back to the market thinking that the 6% range perhaps is now doable. But again, some people are now qualifying for loans that they didn't in the 7% range. But we still have to talk that affordability. Home prices are still rising and very overheated. So it remains to be seen how much of those applications, how much of that interest really translates into sales.
All right, Di, thanks very much, Diana Oleg. Let's get back now to Steve and Mark and talk economy. Mark, my question for you, and I don't mean to be an apologist at all for the administration here, but you say that the economy, in your view, is about as good as it gets. But it sure doesn't seem to feel that way to the American public who quote, blame the Biden administration for whatever economic woes are that they sense. Why do you think that the administration has not been able to tell a positive message about the economy and point out
Just because he said as good as it can get doesn't mean it's great.
taken place on Biden's watch that is really not good, which is inflation, had really less to do with his policies and more to do with monetary policy over which he had no control and fiscal policy, which put large slugs of stimulus into the system, most especially in 2020 when he was not in office, and then again in 2021 when he was.
Yeah, Tyler, I think Americans still feel the sting of the high inflation that we were suffering a year or two ago. I mean, prices for many things are much higher today than back a couple, 3 years ago. In particular, for staples, things that people just, have to buy.
Eggs and milk and laundry detergent. It's all outrageously higher, it seems to me, than it was 2 years ago.
Any person I talk to, I say, hey, how do you feel about the economy? They say, I don't feel so good. I go, why? They go, well, I'm paying more for stuff. And I go, well, what stuff? And it's, it's kombucha tea, it's ramen noodles. Everyone's got their ramen noodles. And I think, it's just going to take time for people to feel better, as their incomes continue to improve. I mean, the job market's great. We're getting a lot of wage growth, plenty of...
Okay. It's different when you're a millionaire. You don't feel it, but it's like I've been posting the cost of my meat. 3 weeks ago, 3 pounds of hamburger would have cost me $22. I go in a week later, and it's 12. I go in a week later, and it's back to 22. And I'm going, how in the heck can this fluctuate like this? They do got a new owner, and here we go. I got to set a stop here. I'm going to lose a lot of money. A tomato, almost $3. A good looking tomato, sliced tomato. I mean, it's a good tomato. A bag of potatoes was $8, 5-pound bag, red potatoes. Head of lettuce, $5. Trash bags up almost 90%. I can just keep going and going and going and going. I went out to buy a car. Unbelievable how much they've changed in 3 years. When I bought my Equinox, the same car today would cost me about $18,000. When back then I only paid $13,000. Same year, same brand, same everything. Used car up more than 30%. Gasoline up $1.20 a gallon. So it's the essentials, that we have to pay. Rent up $200 in 3 years. That's the kind of stuff that no matter how low they get these inflation numbers, it's hard to mark down prices. I'm telling you. I had a frame shop for 15 years, picture frame shop, during the Clinton years, during the Bush years. I bet you a case of glass today would probably cost me $80. Back then it was 25. Probably wouldn't hurt to look. I thought about getting back in the framing business, but so right now I'm down about 300. We're at the double bottom red line right here, so it can't go any lower than this. If it does, I'm definitely going to get out. Daily double bottom on the SPX. We've been here before. That's right. She about all she wrote, I think. Soft landing versus recession. How many years have we heard this? 2 years now? 3? I think that was the most said word last year. Soft landing. Randy. Yeah, it's up about $70 on that trade. Contract. Time to play the double bottom, baby. Come on. Ah, fuck. Yep. It's all for nothing now. My last resort. Damn, Jim. We get this thing cheap enough, I'll buy 10 of them.
There's a much larger piece of this, which is Section 199A, which is a 20% pass-through deduction, and that's critical for small businesses like plumbers and electricians and things like that. There is some movement on that, but that's going to be a bigger problem, because if you take away some of that pass-through deduction and increase taxes on small business at the same time they're paying higher interest rates, that's going to hit the service side of the economy pretty hard. Mm-hmm. So that's something we need to get fixed, and get fixed quickly, because if we sunset and put everything back in the ordinary income tax rates for many of these service providers, it's going to change the job outlook. You'd reduce their profitability, you reduce the ability for them and the capacity to hire or keep current staff at certain levels. Yeah. So that's really important. I'm hoping that it will work itself out. I do see some movement on the Democrats' side. This was largely, the pass-through deduction was largely from the Republicans, but the Democrats seem very, very interested in getting this done. So hopefully we may get, some of the, bigger pieces. We have the SALT deduction that is really a problem for the Northeast, in particular for lawmakers in the Northeast trying to get reelected. So I'm not sure how that one will work. Yeah. But on the pass-through deduction that actually affects the economy, I think we have a decent chance of getting that done. But if it doesn't, and we continue to have these, even this week, we have a CR, another government shutdown potential. We're just going to be rolling through these all year long. And that, to me, is way more important than monetary policy, because the Fed's told us what they're going to do. They're going to lower rates a couple times this year. They're not going to raise them any further. It's very unlikely they'll do so. That's a pretty good operating environment for investors. So that's why I think fiscal policy is way more important now.
All right, Jamie, thanks very much. We'll see you again soon, probably on a Fed day. That's my guess. Jamie Cox, we appreciate it. Coming up, Bank of America is crowning the king in streaming, saying Netflix has won the so-called streaming wars, game, set, match, and between password crackdowns and advertising opportunities. This might just be the beginning for the media monarch. The analyst behind that call will join us next. Plus, China just passed Japan to become the world's largest auto exporter. Can you believe that? So are they a serious threat now to American automakers, not to mention the Japanese, the Koreans? We will look at whether the West should be worried when the exchange returns.
Heck yeah, you should be worried.
This is the
Our car industry is going down the tubes. There you go, man. We got 47.0460 next. Actually, I don't know if that's a good number or not. I'm going to call it one. 47.05. Gotta do some real smart playing right here. That got me thinking we're below the 200 now on the 1 hour. Been like that all day. We just couldn't break it.
All right, Peacock made its move in the streaming wars over the weekend with the exclusive rights to the Chiefs-Dolphins-Taylor Swift game. But our next guest says the streaming war is already over and that Netflix is the clear winner here. She's got a buy on the stock, just up to price target from $525 to $585, a 20% upside from current levels. Joining us now, Jessica Reif-Ehrlich, B of A Securities Analyst. Jessica, nice to see you again. How have you been?
Great. Thank you for having me.
Oh, we're so glad you could be with us. So, game, set, and match. I guess I can't quarrel with your conclusion here. If I were cutting the cord and I said, okay, now what do I do? My number one default choice would be Netflix. Easy.
No way, it's 30 degrees outside.
I mean, Netflix is what the old bundle was, all in one service. So it has something for everybody. It cuts across every demographic. And there really are very significant growth drivers, including, what you're intimating, which is their engagement is so strong.
Yeah, their engagement is strong. How is the crackdown on password sharing going? I'm asking for a friend here.
Well, it's interesting. They've had really good growth since they started cracking down, the password sharing crackdown. But it feels like there's a long way to go. They've said several quarters. Most people, anecdotally, that we speak to haven't been touched yet. So it does feel like there's still a fairly decent runway from password sharing crackdown. There's also a runway. I mean, just think about how many broadband homes there are in the world and how many connected TVs there are. There's a very long runway for subscriber growth, and they have the content.
A couple of years ago, there was, as I'm recalling, you can correct me on this if I'm incorrect, there was a concern that Netflix was spending so much on new content generation, some of which has paid off beautifully, but some of which, it's a hit or miss business. But now, its top 10 list has been dominated, you say, by third-party content, which can't cost them as much as original content generation. How does this play into their current?
I got the 4740 at 4 different price levels.
Excellent point.
So if I go below $1, I'm going to stop out.
In the media and entertainment sector are all really positive for Netflix. For one, viewers continue to move from linear to streaming, so that's a positive. They do dominate. Their own content for television viewing is actually doing very well. But if you look at the third-party acquisitions they have in film in particular, it's amazing. Their just engagement is really strong, and they dominate most of the streaming charts. So the trend, for years, a lot of the studios, the traditional studios, pulled back content and only kept it in their own walled garden, wouldn't sell to Netflix or anyone else. That's opening up. It just didn't work. Warner Brothers Discovery has way too much content to put on Max. And Universal is selling movies, Sony's selling movies. So
the ability to get third-party content, yes, it's lower cost,
This
but it's
computer's
also
acting
quicker to
strange.
get onto the schedule. You don't have all of that production time, and it's known content, so you don't have to market it that much. So it's like a win-win. It's a win for the studios because they're selling content, but clearly a win for Netflix because they're getting access to top-quality content at lower prices than it would cost for them to produce on their own.
One of the numbers, oh, by the way, I was watching Netflix last night. Weirdest movie I think I've ever seen. Ethan Hawke and Julia Roberts were in it. I have no idea what the name of it was, but it had the weirdest ending I've ever seen. One of the numbers that I was drawn to is forecasts for profitability and gross margin increasing from 2023 to 2024 and again into 2025. How are they doing that?
This is just the beginning. They are the only profitable streaming service, but now the leverage will start to kick in because they are scaled. They're almost 250 million subs, probably over when they report next week on a global basis. But the drivers are, as you had already mentioned, the password sharing crackdown, and as I said, continued growth in subs worldwide. But also they have AVOD or advertising video on demand, and given the change in pricing, where they're I don't want to say pushing, but really like if you're worried about budgets and spending too much money, then it's really a great offer. You get 4 to 5 minutes of advertising targeted, so it's interesting to you, in premium content. So the advertising platform is just beginning. This is a 3 to 5 year growth driver. Then there are price increases. They surprised the market with a price increase last quarter, and we'll see what the churn is, but maybe not that high. And then there's bundling, which is really interesting because what we're starting to see are things like Verizon offering Netflix and Max together for $10 with advertising. That's a bargain for consumers, but it's great for Netflix and Warner Brothers Discovery because it decreases churn, decreases SAC or marketing, and increases the customer lifetime value. So there's just a lot to like here.
All right, Jessica, it's always great to see
What's
you.
that?
What was the name of that movie again, AJ?
Thank you so much.
Leave the World Behind was the movie. All right, go look it up.
Yes.
Jessica, it's always great to see you. Nice to have you back.
Okay.
Fantastic.
Thank you so much.
Oh, you're welcome. Coming up, EY unveiling its first ever deal barometer looking at the state of M&A in 2024. The sectors they are watching and how the Fed could end the entire deal-making environment ahead.
Just a little bit.
Boeing CEO Dave Calhoun in Kansas speaking to workers and the CEO Aero Systems, which built that MAX 9 fuselage that had the door plugged.
Pop out. We'll tell you what he's telling them and what Boeing's next steps are. The Exchange is back in 2.
Oh. It's the first red trade I've had in a while. Let you get a nice little bounce on this to 150 and I'll be very, 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 very happy.
to the Exchange. I'm Julia Borston with your CNBC News update. Colon cancer is now the deadliest cancer for men under 50 and the second deadliest after breast cancer for women under 50. That's according to a new study from the American Cancer Society. Rates for colon cancer have been rising for 20 years, though it's unclear why. It's become more common in younger people. Some experts believe increasing obesity rates and unhealthy diets could be major factors. The UN World Food Program said it was working with Zimbabwe to provide food to its rural population as El Nino threatens to worsen the country's drought crisis. The agency said today that the food
Tesla has a new low.
2.7 million people, almost 20% of the population,
Mara went up a little
at risk
bit.
for hunger because of poor harvests from drought. And discount grocery retailer Aldi announced plastic bags are out at its 2,300 stores. The company said the decision was made to help reduce costs and to be more sustainable by preventing almost 9 million pounds of plastic from entering circulation. Aldi will have reusable bags available for purchase. Back over to you.
All right, thank you very much.
Very smart.
And coming up, China surpassing Japan
China.
as the world's largest auto exporter, and that is worrying some automakers in the West and elsewhere. We will look at how real the threat is and who's most at risk. Next.
I think a lot of these new cars have too much technology in them. Way too much. Like the keyless entry. Or the keyless start. I don't like that one bit. It scares me. I got one. I bet you they went back to some of the traditional ways, but you know, still had the good gas mileage. I bet you they'd sell these things like hotcakes. Rivian's down pretty good. It had real bad news there on inventory. I'm still in this sucker over here, so we're going to see. Probably going to take a loss and get over with it. What am I doing? The 20-day 1 hour. Yeah, Rivian. I got down here right around 1375 and 1532, so I'm going to raise that up a little bit. 1375. Apple, got to keep that 180. We called this out last time and it hit the 200. So we've got snake breakout, pullback, higher low. And Sophie, I got a little under 7. Now there's some price in here where the millionaire starts to buying this stuff up. China, K-Web. Pfizer has a 2.5 week pullback. PayPal was in the news today on CNBC. A little green. Market's not happy. SPY has a new low. Boeing might have found a bottom, but I'm not quite sure yet. Google hit support today and bounced up off of it. It needs to hold this head and shoulders. Google. I think AMC can pull back more, but got to watch the tape on that one, see how many big orders are coming in. Anything over 5,000 will show a serious buyer. 1,000 would be okay if it's in a bunch of thousands. Citibank, we're waiting for. Oh, that's a pretty good little spot right there. 41.13, 51.13. It's a really nice spot. TSM can drop more. Test that. Put an alert on Meta. It went 361.19 or 20. That ain't gonna work. Yeah, well. Coin held my 130. JP Morgan, triple bottom coming to hold. Jamie Dimon says it's a mistake to assume everything is hunky-dory. That is true. You know Jamie's got to have the inside scoop. Oh gosh, Baidu's took a pretty good beating in the past 3 days. So we got the 3-day rule working on Baidu now. China missed GDP. Beige book coming up by Miss Sweet Hey Sue. I've got too much in this one now. If Lily doesn't hold this support, I'm going to go long in puts. We're at a support level. Oh, well. Do I got anything green on here at all? Oh, damn. UNH. And Humana. They both took a tumble. BITX. Oh, yeah, 2X. And I didn't go and look at them cyber stocks either that I had. Well, I got to get me a nice little bounce here. I took a pretty good loss. Now watch it bounce. I always hate it when I sell it because right at that time I go, shit. Oh, darn, it's more than I thought.
And long-range guidance, though, Tyler, we have seen this before with Boeing. If they're in the midst of an issue like this, they will say, we're pulling guidance. We're not going to give guidance until we have greater clarity. So we'll see if that happens in 2 weeks when we get the Q4.
Well, if that happens, the stock will drop.
Phil LeBeau, thank you very much. We appreciate it. Coming up, Ernst & Young just launched its first ever deal barometer, and this, they say, is the sector to watch for M&A this year. A TV exclusive. Look at what else and we'll look at what else it is forecasting. That is next.
BlackRock took a pullback today. 20-day low. That's kind of fishy. We're definitely into fat cats are back from lunch. Come on, baby, bounce back.
Welcome back to the exchange.
Staying glued to this desk.
On a great year for deals after a relatively dismal 2023. EY's first ever deal barometer shows M&A activity will rise about 12% this year, returning to pre-pandemic levels. According to the data, deals started to pick up in the last quarter, and that momentum may well persist. Joining us now is Mitch Berlin, Vice Chair of Strategy and Transactions at EY Americas. Mitch, welcome. Good to have you with us. So a 12% overall expansion in deal activity this year is what your baseline forecast is. There are different kinds of deals. There are the PE deals that became so famous over the past couple of decades, and then there are more strategic deals, which we've begun to see in energy, we've begun to see them in pharma, and so
I just got screwed on that last trade.
Split go? It's 12%
On my own
overall,
doing.
but is one going to be more dominant in terms of growth than the other?
They're pretty close. So we would expect about a 12% increase in corporate and a 13% increase in private equity. So not too far away.
So not too far away. And where, to the extent that you're able to look ahead, would you expect the deals of the strategic sort, the strategic combinations, to be sort of more prevalent? What sectors?
So the sectors that they're more prevalent in are the ones where the multiples have gone down because the cost of capital is still high. So you can't have high cost of capital and high multiples and expect M&A activity. The three
So not tech, not the big tech necessarily.
Well, tech multiples actually have gone down a little bit year over year, so we are seeing a pickup. I mean, tech is behind, but they're still the most dominant player from a sector perspective. So we'd expect a small pickup in tech, but we're expecting a pickup in life sciences as well as in energy.
Jamie Dimon's a little fear, he always throws a little fear in the market.
Granddaddies of them all, Chevron have been active. Exxon, of course.
He's the only honest one out there.
In the Permian area. Let's talk a little bit about cost of capital. How critical is it that
he did it back in 2022. Nobody believed him, and the market tanked.
In order for your forecast of 12-13% growth to come true.
So for our baseline scenario assumes that the cost of capital will come down a point and a half. If it doesn't, then I think we're looking at less of a growth in M&A.
Come on.
So it's critical because again the multiples aren't coming down that significantly, so the cost of capital has to come down to see a reemergence of M&A.
So the strategic combinations you see are in bio and life sciences, maybe in energy. How about the PE area? Would it sort of track the same? You expect the PE firms, the Blackstones, the the KKRs, the Carlyles to be active in that same area or in other ones?
In the same area, a lot of tech. There's a lot of PE activity in tech and in healthcare as well.
And where in tech specifically are you seeing it? I mean, obviously the big tend to get bigger in these circumstances.
Right. A lot around AI, trying to get in earlier around Gen AI and the fronts of there.
Yeah. So AI would be the area to look at. Who will be the active buyers? Let's talk about tech most specifically. Will it be the big whales in the business, the Metas, the Alphabets, the Amazons, the Microsofts, or whom?
I think it will be the big ones. The big ones still have a very robust M&A pipeline. Whether or not they're acting on it right now doesn't necessarily indicate that the pipeline isn't there. So there is still an active pipeline that they will act upon when the environment is right.
So the big guys will be the acquirers. Virtually anybody could be the acquiree in this case. And I assume, I don't know this to be the case. I assume if you're looking at life sciences,
I can't believe I didn't buy that down there.
not only at large pharma that may be
That's what happens when you hold a
pipeline,
grudge.
Dearth, trouble in there, but don't have enough, so they're buying drugs. But it could be other companies as well, couldn't it?
Well, they're definitely looking to build. You know, there's patent cliffs coming, so they need new R&D. So a lot of it is buying new R&D, but they can also be looking into med tech and other areas like that.
Yeah. So the med tech area could be an area. Is there a sleeper sector here that you haven't mentioned where there might be a fair amount of? We mentioned energy. We bear down on life sciences. Are there other? And you said tech. Are there others that could be out there as well?
I don't think there's sleepers, but we do see, if you look at like the secondary level of heavy M&A activity, a lot in consumer products. We've seen some big retail
Ready, set,
deals
go, baby.
last year, particularly around brands, and so we would expect to see a continuation of that.
All right. Mitch, thank you very much. I appreciate it.
Thanks for having me.
Yeah, Mitch, thanks a lot.
Thank you.
Fantastic. All right. Is that the exchange? We're going to do some markets.
Damn,
We're going to look
who's
at some
that?
markets, shall we? Let's do that. The Dow Industrial's off about 187 points, continuing its somewhat rocky start to the year so far.
We're at
The
45
mixed
cents
also
now.
Modestly lower today as we get off on a sort of back foot for 2024. That'll do it for the exchange. Coming up on Power Lunch, the latest read on the economy with the Beige Book.
He's a
In
gangster
just
through
couple
and through.
minutes, plus, we'll talk to one of the DOJ's top antitrust lawyers. Well, maybe I should have asked Mitch about that blocked merger between JetBlue and Spirit Airlines. I'll join Dom Chu on the other side of
I will hang out with you soon. Right now, I'm hanging out with this. Jimmy's about made back his loss. I should get out here and be happy. Viva Las Vegas. Don't make me pull out my ukulele. I got a ukulele. I've got a one-string weed eater bass. I got a mandolin. I got a banjo. I got two guitars. I got a washboard. And I think that's it. I think that's it. Oh, good. 165. I turned my head and I'm up 15 cents. Okay, we have a hard resistance right here.
You have ownership.
What?
Welcome to Power Lunch. much, everybody. Alongside Dominic Chu, I'm Tyler Matheson. Coming up, the Fed releasing the beige book. Steve Leisman is poring over it for a read on the strength of the economy, getting forecasts from districts around the country.
Of course, it's going to be outstanding.
And that is sending stocks lower today. Fears the Fed won't be so quick to cut interest rates if the consumer and the broader economy remain strong. So here's where the markets do stand right now. You can see right now the S&P 500 down about 1%. The Dow Industrial's down 0.5%. The Nasdaq Composite pacing the losses, down almost 1.25% as well. Software names dragging the Nasdaq, including CrowdStrike, Zscaler, Fortinet, which was hit with its third downgrade from analysts over the past 2 days. Chip names also lower. On Semiconductor, NXPI, Intel among the names getting hit, as you can see there, right across the screen, across the board, for the biggest chip names out there, Tyler.
All righty, and demonstrating this interest rate theme, the worst performing sector in the S&P 500 today is real estate, down 2.5% as a group, and there are some of the names in that group. One group gaining today would be health insurance, including United Health, which is
this ought to be a good lesson to everybody. Never give up. I mean, if you have the extra capital. Out at 190. Wait for that bottomless pit and keep your eye on it. That just made my day. Jimmy called the RSI crossover down here. That was a tough one. Let's look at this trade for a second. I mean, I really didn't have nothing to go by except this here little green candle and this RSI. So once we broke resistance, that was the time to jump in. We had this little bullish candle. It's important that you watch them. We had a good one there too. We had a good one there too. And we also had a good one there also. So we had a good one here. Every one of them let out with a hammer. I think this one here is the one I like because of the three black crows. But that'd have been a tough one. I would have probably took that trade. I might have took that one. It's hard to say if I'd have took that one, but I for sure took that one. I've seen many people, they get in a bad trade and they sell and they walk away and they get mad and then they don't come back for a couple of days. And then they don't come back at all sometimes. They say, I can't do this. If I'd have held on to it, I'd probably save me about $400. The first one. Just added that to this one. So it seems like it never hurt. Always, every time I sell, I get hurt. I still would have been hurt in this one, but not as bad. Because I went in at the double bottom and then added right there and then took out right there and then boom. All the way back up to almost my entry level. So I would have made it out green, a couple hundred. But by this time you're talking almost $2,200 in the trade. I don't know what I'm missing on here. Volume oscillator. I didn't even pay attention to my finish here. Said I had to get out. Oh man, I didn't type that thing in.
A bit of a win against inflation, which would argue, I guess, for rate reduction sooner rather than later.
Oh, there's certainly two implications there. The one is what's going to happen with rates. The second is what happens with margins and earnings. And as Steve said, yes, there are wage increases. They're maybe not as high as they were, but the ability to get price is coming down. So I think margins are more likely to be under pressure, whereas the market's assuming the broader index and the broader economy and companies are going to get margin gains in 2024. To me, that's the big disconnect. I'd expect more margin pressure on corporate America.
All right, Jim, thank you very much. Appreciate it. Jim Tierney, thanks again.
So we've got the beige book on top of this morning's retail sales data, and let's get to Rick Santelli to digest it all for us and how it's playing out in the bond market, in the bond report. Hi, Rick.
Hi, Tyler. Indeed, we saw strong retail sales, but there was another aspect. As you heard Steve discuss the beige book, once again, manufacturing underscored being weak. Utilization rates today were basically the lowest in over 2 years. And we also had a 20-year bond auction, a reopening, and it was very weak. Investors did not show up. Look at a 2-day of 20-year. And all long maturities are very similar. The reason I draw attention to this chart, other than the fact that rates have gone up since the auction ended, is the fact that as we sit at 443 in a 20-year, yesterday's high in that security was 443. Now, let's look at a short maturity. Look at 2-year for 2 days. Yesterday's high was 4.25. It's currently trading 436. It's 11 basis points above yesterday's high yield. That speaks volumes about what's going on today. Short maturities after retail sales was strong have been leading rates higher. It makes sense. We're kind of pulling back on when the Fed is going to ease. It's all about the Fed and short maturities today. 10s, 20s, and 30s are on pace, as the next chart shows, to close at 5-week high yields. And finally, we could talk about inflation like the last guest, or what Steve was discussing regarding disinflationary pressures. But let's learn a lesson from the UK. So many similar comments coming out, except for today, we see that their CPI and their PPI pop higher. It's not linear. There's a lesson to be learned. Look at a 2-day of 10-year gilts. They closed at 398 today, almost got to 4%. They were up 20 basis points.
Mike, do a China for me.
Dominic, back to you.
Rick, one quick follow-up here as we watch the context of
China.
bond auctions.
Very good.
Is there an indication
China.
how, given break-even rates and inflation expectations, that we are seeing a bit of a bounce, that the expectations are ticking slightly higher? And if
That's
so,
what I wanted.
what's the driving force behind the uptick that we're seeing, modest as it is in the beginning right now, for some of those so-called break-even rates?
Well, I think that there is some sticky inflation, and whether it's break-even rates or how much it's going to cost to service our debt, or the fact that it's...
Oh, God. Tell that to the government. Okay. So we're going to see if we're close to my support on this SPY. Damn, I didn't want to erase that. Let's go back to the weekly. I really want to touch this 9. If we touch the 9 on the weekly, I think that's as low as we're going to go. Maybe. And that's another $3. $465.74.
Let's indict the motherfucker. Let's indict.
San Francisco reports economic activity was stable overall. Labor improved, wages and price pressures eased. Do.
Athletics.com.
Welcome back to Power Lunch. Shares of JetBlue and Spirit Airlines are sharply lower again today following yesterday's ruling by the Department of Justice to block their proposed merger. A federal judge said the deal would have hindered competition and led to higher airfares. So here to discuss that,
I don't believe that one bit.
Antitrust is Doha Mekki, Principal Deputy Assistant Attorney General for the Antitrust Division of the Department of Justice. And of course, our own airlines reporter, Philip Bose, joining us for the conversation as well. Thank you both for being here. Doha, I wonder if you might maybe just entertain us for a moment here with regard to some late-breaking news that we're having. It says, according to a Bloomberg report, that Apple is going to face U.S. antitrust scrutiny and a possible lawsuit as soon as the month of March. This, according to sources familiar within the particular moves of the DOJ. I wonder if you could tell us a little bit about what exactly the Department of Justice is looking towards with regard to Apple specifically and maybe big tech in general.
Well, Dom, I appreciate your having me and I appreciate the question, but as a Justice Department official, I can neither confirm nor deny the existence of any investigation, and so unfortunately I won't be able to talk to you about those reports today.
All right, one quick follow-up on that. Is there a sense right now that the Department of Justice is taking more of an interest right now in those big technology companies, given some of the headlines that we've seen over the course of the last year with regard to artificial intelligence and everything else?
It's a great question, and I appreciate it. So certainly this administration has prioritized restoring competition to markets across the entire U.S. economy, including big tech. As you know, we just finished a trial late last year involving Google Search and Google Search advertising markets, and we filed a case in early 2023 alleging that Google maintained its monopoly illegally in certain digital advertising technologies. So certainly we're active on that beat, but we're active across the entire US economy, and I think Google Search is the most important case about the internet since the advent of the internet. And I think it's really a case about the future, including foundation models and other interesting products and services in the artificial intelligence space.
All right, Doha, let's pivot you back to the news that is of the record, on the record, and at hand here, and that's the airline industry. What exactly was the main thrust behind why the Justice Department really wanted to oppose this? I ask because there's a narrative out there among analysts that Spirit Airlines, if it were to stay economically viable, could help that story that the DOJ is putting forth. But what happens if some of these airlines no longer exist in the future? What exactly does that do to the competitive landscape, especially for airfares and consumer prices?
God.
This case was really about the fact that competition between JetBlue and Spirit is
This might be a
meaningful,
good trade
and I think
here
that's
soon.
reflected in the judge's opinion. In addition to that competition, the court amply found evidence that Spirit helps competition across the board and brings airline prices down for the entire industry. And so that means that the existence of Spirit and its effect on the market helps all consumers in the United States, regardless of whether you fly Spirit or not. I'm aware of reports around the continued financial viability of Spirit. And ultimately, I think that's up to Spirit. But I will say that the companies made those arguments in federal court, and ultimately, our judge did not find that persuasive. Instead, he found that Spirit is a product that helps families who otherwise wouldn't be able to go on vacation. It helps the college student who wouldn't be able to come home but for Spirit's prices. And ultimately, this victory is about all of them. This is about the American consumer and the ways that they benefit from vibrant and open markets, including in the airline industry.
And so the judge was not persuaded, and the argument was made at in the pleadings that the cure might result in the death of the patient, i.e. Spirit Airlines.
Also, again, I think ultimately that's up to Spirit, but I think rockiness in the airline industry is just a fact of life. Certainly there are exogenous factors and macro trends that all of the airlines are experiencing collectively. And so, in any potential merger, we're always thinking about the facts that are relevant to that merger and applying the law to those facts. And here, the fact was that Spirit was still exerting competitive pressure on JetBlue and other airlines.
I want to bring in our airline expert, Phil LeBeau, for a question or two. Phil?
My question for you is, what does this say about the proposed merger between or the acquisition of Hawaiian Airlines by Alaska Airlines? Are you reviewing that right now, and when do you expect the DOJ to say, yeah, we're going to fight this, or we got no issue?
I appreciate the question, but again, I can't confirm or deny the existence of any investigation. And I would say, without talking about any particular company, for every merger that comes before us, we're always thinking about what is the competition at stake in that particular merger, and we do a sober assessment of the facts, and again, apply the law to those facts.
Well, let me ask a question that everybody on Wall Street seems to be asking. When it comes to airlines, we're not talking about other mergers, but we're talking about airlines. Joe Biden's administration has zero interest in seeing any more consolidation. Is that an accurate statement?
I think that those sweeping statements are more emotional than fact-based, but it is true that the president is a champion of competition and markets and issued an executive order in July 2021 that declared that it was the policy of the Biden administration to vigorously defend competition across all industries. And so, again, we're going to think about the facts and the law in every single merger that comes before us, but thinking about airlines more broadly, there's no question that airline consolidation has been a challenge. We've seen prices go up, and so I would remind everyone that JetBlue itself has complained about consolidation in this industry for a very long time, and as we noted when we announced
Joe Biden can't even wipe his ass. Don't you just say Obama? Very interesting. Well, if it gets bad, Apple can see 160, and that'll be a strong buy. Right now, 180 has to hold. We hit 180.30 today. That's a double bottom with a higher low. Higher low by 7 cents. Well, GBTC is definitely at a support level off the 200 on the 1 hour time frame. Magnificent, are you an Intel? Nope. Like, you remember what my last support was on that I gave you? I don't remember. I know we're getting close. It had to have been this shoulder line. I don't think I can't find my chart. Somewhere around there. 44.50. Another buck down. Got an hour and a half left.
And so a lot of that demand.
Oh, here's SunPower.
Last year, and so looking forward, their sales environment is less certain. Also, they traditionally specialized in a loan versus lease model. And when you have higher rates, the lease model is much more favorable than the loan model, and so customers were potentially more likely to go to one of their competitors that have potentially a better rate.
Lease.
All right, Pippa, thanks very much. Pippa Stevens. Let's get to Julia Borston now.
Oh, God,
for
look at
CNBC
that.
News update. Julia.
Hi, Tyler. A New York judge is threatening to throw Donald Trump out of the courtroom in his defamation trial. The warning came after he ignored warnings to stay quiet during writer E. Jean Carroll's testimony. The jury is deciding how much the former president will be ordered to pay Carroll for remarks he made about her after she came forward accusing him of sexual abuse. Chinese researchers reportedly isolated and mapped the virus that causes COVID-19 in December of 2019. At least 2 weeks before Beijing first went public with details of the deadly virus. According to the Wall Street Journal report, the researchers uploaded a nearly complete sequence of the virus on a U.S.-run database at the same time Chinese officials called the outbreak a viral pneumonia of unknown cause. And California Governor Gavin Newsom says he won't sign off on a ban on tackle football for kids 12 and under. A Democratic lawmaker introduced the proposal over safety concerns about concussions. It hasn't passed the state assembly yet, but Governor Newsom said he would veto it if it ends up on his desk.
Look at that kid right there, boy.
Too far. Back over to you.
I think he should outlaw ball or have a.
Alrighty, after the break,
That's a big
Samsung
kid.
promising a new AI phone.
See that kid? I mean, he was twice the size of the other ones with the ball. He's running back. I'd like to know who that kid is.
Sponsored by Grayscale.
He's about twice as big. This SunPower, I've been wanting to trade this forever. I mean, look at how cheap it is. It's cheap. Solar stocks are having another bad day. It's more than just a downgrade, Barron says. What about green energy? SunPower said it expects to incur restructuring charges totaling approximately $12 million. That's not good. First Solar would be the one to go to. We got a 1, 2. Ooh, we got a 1, 2, 3. We hit it today. Actually, it's wrong. I've tried it. It's probably done on a different time frame. Let's remove. Put it right on the body of that candle there. Oh, this is perfect. This is perfect. Got to think about First Solar. They lowered the price target to 187. Wells Fargo. Downgrades. These are the kind of stocks you want to look at the beginning of the year. I mean, after winter's over, spring. And Seed is one of them that I used to trade. And we're at that spot. Nice little bounce there. Nice little bounce there. Nice little bounce here. Couple 100%er, I bet. Seed is from China. At least I think it is.
China.
Let me see here. What am I doing, Chisel? You know, a very smart woman quoted something to me today. Patience will pay off. Stay focused. Stay focused. Patience will pay off. Stay focused. Yes, she did. She did say that. Okay. How did I get this up here? Seed. That's what. I was going to look at seed. I don't like how they've done this. We switched my Wahoo around. The Russell's down. What is it about politicians and ice cream? Does it make them feel like they're American? Especially oh, the revenue was up big time. Seed. Check prizes in your profile. Checking sheet.
Ian Peacock.
Welcome back to Power Lunch. New York City is beginning to crack down on secret real estate purchases. Robert Frank joins us now to explain what is secret about them and why would you want to keep it secret.
Yeah, Dom, this is a big change. New York's governor signing a law that would shine more light on secret LLCs that are used in real estate. The new law requires LLCs in New York to report the true state of their owners, their dates of birth, their business address, and all that information. The law is aimed at curbing the use of anonymous LLCs to hide the true ownership of real estate, often used for money laundering or tax evasion. An estimated 37% of all the apartments in Manhattan are owned or purchased by LLCs. They will now have to disclose their true owners. Now, the real estate lobby, not surprisingly, they fought hard against this law, saying it jeopardized the safety and the identity of wealthy property owners. The governor granted a major concession to them, so rather than making these names public, they will only be available to law enforcement. Now, the change mirrors a new federal law that took effect on January 1st. That's called the Corporate Transparency Act. It requires every LLC, limited partnership, or other private entity in the U.S. to disclose their true ownership to Treasury. More than 30 million businesses and partnerships will have to file this to Treasury, including family offices. Now, the fine for not complying could be up to $10,000 or 2 years of jail time. So a lot of work here for the attorneys and the accountants, making sure people comply. 30 million returns.
How were nefarious owners using real estate to launder money? That's number one. And will this approach work?
So in Miami, for instance, they discovered that a lot of Venezuelan fraudsters, corruption beneficiaries were basically buying Miami real estate in some secret name and moving money illegally offshore into the U.S. to save it, basically. And no one knew who they were. They couldn't
So the money would be moved into the LLC, into an LLC account.
That's right. And you could never figure out who. In New York, we had a lot of Russians buying real estate. It turned out they were using it to avoid sanctions because you couldn't figure out who the real owner was. So
will this work? Will this take care of it?
The precedent is not good. So in 2016, Treasury imposed an order that said if you buy real estate through an LLC, you have to disclose the owner, but they were using title insurance as the vehicle. So the fraudsters just said, look, we won't use a mortgage, we won't use title insurance, so if you bought it with cash and didn't get title insurance, you could just avoid the whole requirement of the beneficial owner. So the bad actors typically find a way around these things, whereas the law-abiding citizens just have a lot more bureaucracy and cost. But maybe this will be different.
All right, Robert, thank you very much. The always interesting Jamie Dimon weighing in on banks, China, crypto. After the break, we'll get some technical support to help break down his comments and how you should invest around them. That's when we return in 2 minutes.
FedEx had a new low today. 3 days of selling on it. Coin holding my support. I missed my chance on Lily. Diabetes drug Mounjaro, set to enter new markets amid manufacturing boost. Economic forum. God darn, look at that. Shit. Can you imagine that? Oh my gosh. I do it every time. Unbelievable.
Deals today.
Welcome back to Power Lunch, everybody. Time now for some technicals.
Every
For our
time.
artist today is Craig Johnson, and we're going to do something special today. You may have heard a great wide-ranging interview.
I'm
with
so annoyed. I'm so annoyed. Can you imagine? I had this sucker. God darn it. Every frickin' time. $1,500. Then I had them other ones. I would have, God. I would have walked away with $2,000. Every time. Unbelievable. Oh boy. Unbelievable. Damn. It'd been more than $2,000. That first $1 would have been $2,000 right there. $3. Had an average of 155 on the other one. So maybe around $3,000. Dadgummit. Unbelievable. Every time. I should never sell at a loss. Never. Oh boy. Damn. Oh, man. Oh, gosh.
Fed, we will see the financial stocks do well. The yield curve, 2 to 10 spread, is very close to inverting into a positive sloping curve for the first time we've seen in a while. That should be positive for financials, should be a positive for the banks and JP Morgan stock too. This is one I would continue to keep buying.
All right, Craig. He'll call you now and say what a great guy you are.
I'm sure he will. He'd be happy to hear those positive comments on his stock.
Absolutely. Craig Johnson, thanks, man. Appreciate it. Tom.
Thank you.
All right, so we got more Power Lunch. Keep it right here. We'll be back in 2 minutes.
every day.
Welcome back to Power Lunch. Some breaking news right now on the fight over the Apple Watch. Pippa Stevens has those details for us. Pippa.
Watch
Hey,
Apple.
Don, well, Apple lost an appeal on the watch case today. That means the ban on Apple importing watches that read blood oxygen levels will remain in place.
Ooh.
Now, the appeal is ongoing, but this means Apple cannot sell the Apple Watch 9 and Ultra 2 for the time being. Those shares down about 0.75%. Dom?
Not good.
Pippa Stevens, thank you very much for that tie. It just seems to be a development here because the U.S. Appeals Court had already said that they were going to side with the International Trade Commission over this, so it seems like it's
an
a
incremental
formality.
change, but formality, but nevertheless, not great news for
No, not at all. So we've got just about 3 minutes left in the show and several more stories that you need to know about. Baby boomers dominate the housing market, owning nearly $19 trillion worth of U.S. real estate. By 2040,
That's
the
me, baby,
yes,
that's
that's
me.
you. The population of
A boomer.
not 80-plus-year-olds, because that's not what you are.
Well,
We'll
I'm
have more
not
than
there yet.
double from today. Some economists have predicted that a silver tsunami of Asian Americans will leave millions of homes up for grabs. Most Gen Zers will be in their prime home buying years at this crescendo. So, Tyler, this might solve the housing problem, or will it? I'm not sure this necessarily.
We want all of those people from Brooklyn to come out and
What happens when
take our
those
houses off our just.
It might be institutional buyers, though. That
I
buy
may
those
be
houses.
institutionalized at the time they buy.
There you go.
All right, Airbnb is hoping to help solve the nation's growing home affordability crisis. The company forming a new housing council of experts to advise Airbnb on how it can throw its considerable weight behind initiatives to increase the housing supply. I'm not exactly sure what they have in mind here, but
What a paradigm changer, because for those landlords who could make more money short-term renting out their house rather than leasing it out long-term.
Oh man, we missed
threw a
that.
whole tizzy into the
I think that's my close number there.
and certainly that's one of the reasons behind some of the
Yep,
bans that
sure
take
is.
place in some
Dadgummit.
cities where you can't do this.
I did not have an alert
Well,
set.
Americans may be living longer, but they are spending less time in good health. The estimated average proportion of life spent in good health declined to 83.6% in 2021. The decrease of
Cohen
time spent in good
adjusts
health is partly because
Airbnb's
medical
price target.
advances are catching and treating diseases that would once have killed us, but it's also because of the rising prevalence often among
Airbnb, Cohen raises price target 150 from 125, maintains outperformed. Mizuho adjusts Airbnb's price to 150.
Unveiling proposed changes to big banks over draft fees. President Biden calling some fees exploitation. Since 2000, Americans have paid an estimated $280 billion in such bank fees. I'll tell you what I'm seeing a lot, and maybe you can confirm this, and that is merchants applying 2%, 3%, 4% surcharges if you use a credit card.
Yes.
To fight back at the banks that are charging that vigorous.
And the other way to spin that is to give you the 5% discount if you pay for cash.
For cash.
Exactly,
That's
that
right.
kind of thing. So I think it's definitely
There's something's coming here. I'm telling you, because the prevalence of these surcharges is really something.
All right, and imagine now, if you will, the Dallas Cowboys or Philadelphia Eagles, what if they were publicly traded? And they had to disclose the financial impact of getting knocked out of the playoffs. That's what's happening to English soccer club Manchester United, cutting its annual revenue and profit forecast after getting knocked out of the Champions League in the group stage, not even making the knockout round. Transparency in sports.
As a Giants fan, my heart bleeds for the Cowboys and the Eagles.
As a Niners fan, I'm still watching the playoffs.
Oh, they're my pick to go all the way. Thanks for watching Power Lunch, everybody.
All right, guys, closing bell starts right now.
No, earnings look good.
Guys, thanks so much. Welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. This make or break hour begins with rates, the Fed, and your money. And on that note, New York Fed President John Williams speaking right now. About to anyway. You see the room. That's where he's going to be. Our Steve Leisman's going to bring you the headlines as they happen. Perfect timing, too, as questions about the road ahead for the Fed are definitely impacting the markets today. Let's take a look at your scorecard with 60 minutes to go in regulation. A strong retail sales report this morning sent yields climbing, and that immediately put pressure on stocks today. The 10-year note yield rising to 4.11. Take a look at it there. It's just below that now, 4.10. Well, growth and tech, obviously the places most impacted by that today. NASDAQ, one of the worst of the majors, led lower by Apple, Tesla, and Microsoft. You see them all there. Look at Tesla, down 2 1/3%. Not much better for Goldman and Caterpillar today. They're among the biggest drags on the Dow. Take a look at both of those stocks. Giving some back, and that's a drag. Takes us to our talk of the tape.
Caterpillar.
Investor sentiment has just gotten too bullish. Let's ask Josh Brown. He's Ritholtz Wealth Management
Oh,
CEO
boy.
and a CNBC contributor. He is with me here at Post 9. It's good to see you. Welcome back. You think that's the case? We got all bulled up because of the way we ended 23. We came in here and thought, hey, this could be smooth sailing, and maybe not so much.
Let me answer your question with a question.
Yeah.
Do you think the market goes up because people get bulled up? Or do people get bulled up because the market went up?
The latter.
Okay, I agree with you. Why wouldn't investors be bulled up? Did you see the way that market ended last year?
Sure.
It literally ended like the 4th of July. It was picnics and watermelon and then fireworks. And I don't know what, if you were an investor, what more you could have wanted to see.
Oh, God, here we go again. Irrational exuberance, you idiot.
Up. Of course people got bulled up. And that's quite all right. They should. I'd actually think there'd be something wrong if we had an S&P 500 finish the year up 25%, NASDAQ up 50%, and nobody was bullish. That would be problematic.
Yeah, but it's one thing to get all bulled up on July 4th. It's another thing to be all bulled up in March because you're waiting for the fireworks that may not go off yet because they're not supposed to go off yet. It's kind of what Jamie Dimon was talking about today out in Davos. I want you to listen to what he said about this idea.
I always listen to Jamie.
Market goes up and everybody gets bullish. Well, maybe that's a little too much. Listen.
I think it's a mistake to assume that everything's hunky-dory. And, and when stock markets are up, it's kind of like this little drug we all feel. Like, it's just great, But remember, we've had so much fiscal and monetary stimulation, so I'm a little more on the cautious side, that we are facing a lot of things in 20.
He said the same thing I said, and I didn't even listen to him.
To grips with what?
$6 trillion printed in 3 years. $6 trillion. I've never seen that happen. $6 trillion.
I would be terrified if he were on the air saying,
spending money.
Guns blazing. Let's have another breakout year like we had last year. That's not what he's supposed to be doing. Okay, this is the head of the largest deposit institution in the United States. It's a bulletproof bank. It should be a bulletproof bank, and the reason it is because Jamie Dimon is a risk manager first and foremost. That's his job. I'm glad that he's speaking that way. I hope most people are. That being said, what we're experiencing right now is exactly what you should expect after a rally as blisteringly hot.
This guy can preach. We did pull back to my support level right here on CAT. And yes, 200 to 300 in just a few months. Actually, 225 to 300, $75 gain in 2 months. That's just too much. It's not a normal run. And I'm right. I've been right ever since the first.
We are further away
Nobody can deny
from the
that.
Fed looking to take policy down, and stocks don't love that, and that's perfectly fine. If we were selling off for any other reason, I would be singing a different tune. But that's really all that's changed. Nothing else has changed. We're back in an earnings season. So far, so good. The banks all had great things to say. We've got a lot further to go, but we are not experiencing a sell-off based on a risk to corporate profits. So it could happen. It's just not the story right now.
What about the idea that we may be too bulled up on sentiment? We may be too bulled up on...
That's curing itself. It's curing itself.
The idea of all these interest rate cuts, and maybe most of all, that we're looking past a valuation that is stretched well beyond the historical average for all three of the majors, and that's what Aswath Damodaran yesterday, the so-called dean of valuation, said. The S&P's value overvalued in his mind by 9 to 10%.
But that has nothing to do with what's going on this year, and here's my proof. The worst performing sector, small caps, are the lowest valuation. So that is not what the issue is. Small caps are now down 6% on the year. They finished the fourth quarter with a 14% rally. Almost all of it happened in the last 6 weeks of the year. It's a little bit of a give back. I want to go back to the S&P though. This is important. we have an average daily advanced decline of 44% in the S&P, which means on the up days, almost half of all stocks are rising. That's pretty good. Toward the end of last year, it was 56%. That's pretty hot. That's maybe too hot. So to your point, there was a lot of sentiment froth. People were very bold up. All the surveys came out at the end of the year. People got really excited. We give a little bit back. It's perfectly normal. Happens all the time. Doesn't mean the top is in.
Maybe we're giving a little bit back on our expectations as well of what the Fed's going to do. Our CNBC senior economics correspondent, Steve.
See, Josh is a pumper. He is a pumper. He's lying.
To make his remarks. We'll have to see what he says.
Yeah, I'm not expecting Williams here to make.
Losing a little bit of respect for Josh now. He was one of my most respected.
At this time. But I really like the way Josh has approached this. It's very calm, it's very cool, it's very collected. And I think that's where the market is right now. Scott, I want to just begin talking about the change in expectations for the March rate cut. Before Powell spoke in December, we were around 46% probability of a rate cut. We went all the way up. That number there in the middle, it was probably higher, but just as an example of where we were this morning, 78%, 76%. And now we're back down to where we were. So a lot of the froth, and some of that froth, obviously, Scott, propelled the market. It has come out. Also, now take a look at the January 2025 outlook for the total rate cuts this year. Again, we were very optimistic, got a little bit more optimistic, and now we're back to where we were. So yeah, about a cut, 25 base point cut has come out of the market this morning. And I'm thinking, Scott, that if you
we
think
did take a good hit today.
March, I'm more in the mid.
At Jimmy's support.
Right
yeah, it's interesting. Let's bring in Lauren Goodwin here. She's with us as well, New York Life Investments chief economist and market strategist. Is that what you think? And Steve, you stay with us too. Is that what you think has gone on here? There's just been a little too much, hey, it's all hunky-dory, as Diamond says.
Yeah, we hit a nice little support.
To our gang out in Davos today, too. I think it's hard, he says, hard for me to see the market's view of 7 cuts, this year. I do think there's reasonable possibility of some, but it's really going to be dependent on what the data says. But 7?
Yeah, I think that's about right. If the Fed is right and they're able to engineer a soft landing, then 3's probably about right. And if the recession camp, which I happen to be in, is right, then you're probably going to see more than 7 as the Fed tries to catch up with slowing growth. I think what the market's been grappling with, though, since the December meeting is that the Fed spent 2 years talking about inflation, data. And now we're looking at data that's, if anything, firming a little bit. And we're talking about cutting, right? The paradigm has changed, and I think that's appropriate, but it means that the amount of information that the Fed is taking in is a little bit less straightforward for investors. That's why we're seeing the changes in expectations that we've seen in the past couple of weeks.
Yeah, and Steve, it does raise the issue of what could be a growing issue for the Fed of, you see the strong retail report, and rates move up, and you're like, well, the economy is.
So I just can't help. I look at things that are up 100%, in a year. I've not seen nothing like this in 20 years. These guys are pumping this market on expectations of a 6-point rate cut. That's what they said. Now the feds are coming out saying a little bit different. So I disagree with Josh 100%. I know what a bull run is, and I know what irrational exuberance is. True, everything was based on raising rates. We heard it for 2 years in a row, just constant. Soft, and they were wrong. They were wrong both years, and they're wrong again now. If they let the market pull back a little bit, more than what it is, like 9 to 10%, we're at 5, that'll give us enough room to run it back up and break that triple top. But if we talk ourselves into running it up now, it's not going to be healthy, my opinion. When I say I haven't seen stocks go up 100%. I mean, every stock I look at, these idiots or fat cats will tell you they'll be happy to get 17 to 20% a year. It is kind of like a springboard, like a squeeze. We wait, we're in, and like that other guy said in here earlier, all it takes is one idiot to push the wrong button, and then we got a nuke hitting one of our boats, and that thing will just tank. I seen it happen during 9/11 when the towers went down. I seen it happen during Kuwait. I seen it happen during the Russia, Ukraine. And what we got going on now is two fronts, and they're not worried about it. I'm telling you, don't mess around with them Muslims. They're kind of like the Russians. They'll die first. They're very, very proud people. Every stock I pull up 180%, 100, 200, 300, 400%. It's not normal. I could sit here and argue with these guys all day long. I mean, look, Microsoft, 230 to 388 in a year. Boeing's back down almost to support. We hit that 200. I don't want to get rid of these lines, but we could be seeing something very promising soon. No, here comes a Mr. Brownstein.
And maybe you want to talk them out of it or agree?
I'll do my best to talk you out of it. I agree when it comes to the equity market. Soft landing, hard landing, like we're talking about little bits.
Who gives a
on
shit about
side
the
zero,
landing?
right? Everybody expects economic growth to slow, inflation to come down. It's just a matter of degrees. So I'm with you there. That's a reasonable.
Uber. $23, 62. in a year.
And earnings growth accelerating. But more importantly, what we're seeing right now in the private markets is revenues are starting to come lower, and companies are complaining. They're screaming about how high their cost, and specifically cost of capital, is. And so while we're in the expecting a mild recession camp, I actually think that's a more optimistic scenario for capital markets than many others could be, because I think you get that really, gnarly profit eater regulated in a way that I think is important for capital.
Okay, I love that you went there. We have not seen any action whatsoever in spreads. When will we see those conditions that you're describing in the private market manifest themselves in the public markets? When do you think that alarm might start going off?
Well, the direct answer to your question is that it starts to go off when we see signs of earnings declining or unemployment claims rising. That's when you expect
no signs in sight.
No signs in sight. I will say, though, high yield credit in the public markets is one of our highest conviction calls. It was last year, it is this year, for the exact reason you're lining up. Unlike other areas of the capital markets, high yield issuers got a pretty big boost from Fed programs during the pandemic.
Yes.
Their capital stack looks really good. We've seen a move up in quality over the past couple.
Here's a good example on Citibank. So most of the year, we'd dip and we'd bounce back, bounce back up. We'd dip for a couple months and bounce back up. We'd dip and bounce back up. We had a good dip and we bounced back up. Then we hit the bottom. Then all of a sudden we just have a straight run up. No stop, no dips until now. That price at that time was $38. It ran all the way to 54. I can do that with all these. Netflix. We're at $285. Now we're at $500 in a year. Meta. This year we were at 132. Or last year, 132. Now we're running all the way up with no rest. And then had a couple little spells here. 377. I got caught in this bubble once before. And I ran it up during COVID. We had Zoom. It was a beautiful example. We've been in a year-long Darvis box with Zoom. All the way from 100 to 500, straight up. I've seen it happen with Intel back in the day. I've seen it happen with General Electric. Nice, big, frothy run. Then all of a sudden, nice, frothy run. And all of a sudden, LLY, their biggest pump out there. All the way from 27 to $647. Each one of these candles represents a year. Then all of a sudden COVID came. It's way too much. And I really want to short this sucker. And not even look at it for a year. And just go stock after stock after stock. Think of one here. This is the only one I think safe right now. Google. I mean, it could come down a little bit too. But price-wise, compared to all them others, we seen Amazon before the split came. What did it do? Run up to $4,500 from. We started trading that at around $1,200. In 1 year, it ran all the way to $4,500. Tesla, the same thing. $158 to $2,200, and the bubble busted on that one too. Intel was an old-fashioned old-timer one. I'm on her side right now.
And mid-cap growth, where the application layer of AI is being built out. High yield, like we talked about, infrastructure, some of the more structural themes that we think will be more resilient.
The wild card in everything is whether you actually.
I understood it for only one reason. Because of we were all locked out. We couldn't go to work. We had to communicate somehow. That's the only thing. That's the only reason. Not because of the capitalization, no. Not fundamentals, no. But being shut down for almost a half a year. I mean, the IRS building, I didn't work at that building for 6 or almost a year before they'd let them employees go back. And now I gotta clean that thing with a fine-tooth comb or it's no job for me. Thank God no one's ever caught COVID in there. Government employees are some of the hardest people to work for. They're so spoiled. Well, OSHA says this, OSHA says that.
I don't know. I'm not so convinced.
We'll make that the last word. Guys, that was so fun. I appreciate it very much. Lauren, thank you. Josh as well. We'll see both of you again soon. Let's send it to Pippa Stevens now for a look at the biggest.
I mean, Josh is a good trader.
We head towards the close. Hey, Pippa.
Hey, Scott. Instacart shares jumping after Wolf Research upgraded the stock to an outperform rating. The firm said the risk-reward profile is attractive.
Now I'm seeing him call these 52-week highs out, so he used to call the dips.
After earnings, the company posting an 8% year-over-year increase in revenue, although KeyBank noting full-year core funds from operations guidance was slightly below consensus, though shares down about 3%. And be sure to catch an exclusive interview with the chairman and CEO of Prologis coming up on Overtime. Scott?
All right, Pippa.
Target's a good one. That Stephanie Lincoln here. We got 3 white soldiers, but she called this out every day. Pumped this every day for a couple of years. Then all of a sudden, they went woke. Them woke stocks got hit hard. Nike. Bud seemed like it didn't lose much. Mustard. I better get to watching the market. No, I guess it has. Right in time, boy. Perfect timing, ain't it? Jimmy says wait. Patience. Ain't that right, Sue? Can't believe that stock went.
Question the market's rate cut expectations. Our next guest says stocks could see more short-term downside ahead. Morgan Stanley's Chris Toomey runs one of the highest-rated private wealth advisory teams in the country. Joins me now here at Post 9. Welcome back.
Thanks for having me.
You still don't like the market?
I'm still cautious around the market.
Why, Toomey? What's going on here?
I want to be a bull, but I have to
Well,
look
what
at...
prevents you from being one? I mean, a lot of people have turned.
Well, I mean, look, a lot of the things that we thought was going to happen last year happened, right? They were predicting a lot of good things happen, right? So inflation came down. We didn't go through an economic recession. We had an earnings recession. But if you look at earnings were actually negative for last year, right? So 219, 2022, you know, markets pronounced 219, we're expecting 215. We're right in the middle of this. You know, financials, you know, big expectations, not a really great response. So earnings weren't great. We didn't get the rate cuts that we were expecting. You look at the market.
We weren't expecting rate cuts last year.
Oh, we were totally expecting rate cuts last year, and then we got 2 rate hikes. That's my point. You know, when we were talking last year, I said if we get rate cuts, it's probably because there's something wrong with the economy. We go into a recession, or we've got a problem with all of this debt outstanding that's going to have to be refinanced. Now, we were able to thread the needle by having the economy continue to do reasonably well, but earnings were actually negative last year,
Sure,
right?
but interest rates have come down so much from the peak. Inflation's come down a ton since the peak. Fed seems to be done with the hiking. You've gone through the earnings recession. You know how the markets are. You've done this as long as anybody.
Right.
Look ahead.
No, and when we are looking ahead, right, we're in a situation, right, where valuations, while not necessarily a good predictor of market returns in the short term, in the long term are actually pretty good, and valuations don't look very good. Earnings expectations 10-12%. We think that's probably high because we think margins are really probably going to have to start contracting. Liquidity, right, which was the great equalizer last year, which was caused by the regional banking crisis and all of the activity that we put in to stabilize that, all of that stuff starts rolling off in March, right? So you're in a situation where earnings aren't looking great, valuations aren't great, and liquidity is being pulled out of the system. So I think caution is probably the right word.
Until when?
I think until you start to see a revaluation with regards to the market. I think you're right. The fact that the Fed is not talking about raising rates is a good thing, but the fact that the market's pricing 6 rate cuts is a problem.
Sure, but I mean, I think we can agree that 6 rate cuts seem a little bit adventurous. over our skis.
A little bit.
So look, the fact of the matter is they're going to
They don't know if it was.
The regime has changed from hikes to now.
They don't know if the market counted 6 rate cuts. They don't know that. They don't know what irrational exuberance is. 1989, 90, Bill Clinton came in and he acted like a dictator. And that wasn't working. So he did welfare reform, midterm. One of the best things that could have ever happened to the country. And the market loved it. And we ran up. And then Al Gore invented the internet. Then we had a big internet bubble. I mean, I'm talking about stocks running 7, 8, 900% on companies that weren't worth a shit. And only 3 or 4 of them survived. That was irrational exuberance. Greenspan came out and gave a big speech. Then we had a recession. Then we started building it back up. Bush came into office and got hit with 9/11. And then we had a crash. And about 3 months after that, we started popping back up. He was the first president, I think, to come out with stimulus checks. I got 3 of them. Because the market, the country almost come to a standstill. And this guy could be, I'm feeling the same thing this guy is. This run that we've had, you don't know. The market doesn't know if we're going to get, I don't know how they figure that out. Nobody's ever put any numbers to it. They just assumed. And I'm going, you can't. So all we need is just a little bit more of a correction, and I'll be happy with the irrational exuberance in AI. The same thing happened with Bitcoin. All these penny stocks that were like worth 0.001, 0.005, running up 20, 30, 40, 50 cents, and then $2, and then $3, and then they all tanked. Bitcoin. Cannabis, the same thing. Cron, all of them. CGC, Tilray, run to $300, then tanked. Now this AI might have more legs than the dot-com bubble, but still it's stronger than ever. The internet and the way we trade, and I think you're going to have to be well educated here. Our younger teens are going to have to be well educated, or they're going to be stuck. That's why now we've got streaming and YouTube, people making money. I know a guy just mows yards for free and makes $50,000, $60,000 a month. Just mowing yards. One a week. I sat there and I'm watching this guy right now. I'm going to see if it. I'm watching this guy right now. All they do is sit in there and make pizza. That's it. I sit here and do my stocks and I watch this pizza. Watch them making pizzas. and he's now opening up another store. He's got 18,000 followers. I want to see if he can get this up to 250,000 in a couple of years. I get fantasy. I just sit here and watch this guy. I don't know if it's this guy here. No, it's a different dude. He just comes in here and mows people's yards for free. He's got like 2.5 million views on it in a couple of days. This guy's got 200K on it. So if I had my strength, I'd be doing that. If I lived in a bigger city, I don't think I could have enough yards here.
We'll do our best. We have to come back. We'll see what we can do.
If we had the internet back when we were doing yards, we'd probably be living on Easy Street. Back in the 70s, in the 80s, we used to do yards for free sometimes. Just do it. If we found one that was kind of in bad shape.
Welcome back to Magnificent Seven, pulling back just a bit to start the year after that massive rally last year. Investors now looking ahead to those key earnings reports and who is really delivering value, growth, and returns. With me now to discuss, Rick Heitzman of First Mark Capital. Welcome back.
Thanks, Scott.
Good to have you back. That's what it's going to come down to, right? Like a lot of, it was a rising tide, lifted all boats last year.
Yes.
Now we're going to see which boats are good.
We're going to see, who's wearing a suit when the tide goes out. And I think we're going to see who's delivering real value. And in an up market, as we talked about everything from stocks to bonds to real estate last year, what's really going to happen and who's delivering real value in 24.
Do you think it was too much hype, or did you look at it and say, no, it's totally justified? This is a transformative technology. The kind of guidance that people like NVIDIA gave out was just astonishing.
It was too much hype across the board, where people said AI is going to lift all boats, or prospective falling interest rates is going to be great for everybody. It's going to be great for some people, but it's not going to be great for everyone. You still have to put up the results, and that's why I think this year is going to be a year where it's a real stock picker's market.
You look at any one of the so-called Mag 7 and say that's the one I've really got my eye on this year, because for better or worse, I mean, you see there's at least been some divergence between the performance, right?
Exactly.
Apple seems to be under a little more scrutiny this year, whereas kind of everything went up last year, and NVIDIA's run again right now has been remarkable in and of itself. The stock just keeps going up.
Well, at least NVIDIA has great fundamentals, right? They were blowing through their guidance. People are still on the AI train and haven't figured out what it's really going to be for them, but they feel like they need to get as much as they can from NVIDIA. You know, Apple, their PE doubled last year, but sales were down. And now you're seeing some troubles in China, some other things. Maybe that was a little bit overblown. If you look at the fundamentals, they're already selling more phones than anyone else in the world. How many more phones could they sell? Whereas someone like Microsoft, now integrating things like Activision, have a consumer portfolio, have an enterprise portfolio, are dominant in large parts of the market, seeing a lot of
bounced right off the double bottom.
They might seem to have greater earnings upside.
So I would imagine, in the lens that you look at the tech world from, private market valuations have a massive correction.
Yes.
And,
I think that was the day low, double bottom on the day
They
low.
expanded.
Correct.
So because the private markets went through the pain first,
No.
what happens now?
Where'd I get that red
They
line?
lagged the pain, then went through a lot more pain. So they haven't rebounded the way the public markets did last year. But everybody kind of had an ugly 22. And then we didn't
Oh,
see
yeah,
the
I
bounce in
remember now.
23 in the private markets. And what you're going to see in the private markets, largely because there's no shorting, there's no trading in and out, you're really going to see who's delivering value for their customers, who's really able to drive growth from both a top line and bottom line perspective, and which are really the great companies that are taking advantage of everything from AI to cloud infrastructure.
Are you being more discerning in what you look at and what kind of willingness you have to invest in ways that you maybe weren't, with scrutiny wasn't quite that rigid over the last, let's say, 3 years ago?
I'd say 3 years ago, scrutiny might not have been as rigid. The market was moving so fast. And obviously, like everyone else, we tightened our strike zone. We doubled down on diligence. We were much more thoughtful about what we were doing, and whether it related to pricing or the types of people we're getting into business with. And we're making 10-year commitments on these investments. We're not able to trade out of them if we decide we changed our mind. So these are deep commitments that are long-term commitments, and therefore we made a lot more stringent decisions. But that's been gone on for a couple of years, and now hopefully we're going to see the benefits of it in 24 and 25.
Talking about some of the earnings, the mega caps suck all the oxygen out of the room, but you have your eye on others. I'm not sure if you've invested in all of these companies, but DraftKings, you were early
investor,
early there. So I don't know what your expectations are there, but Vacasa, CCC, Intelligent Solutions, and Rover.
Yeah,
Oh,
there were
POTR.
a bunch of different trends. We'd say, hey, we're throwing the babies out with the bathwater. A couple of those were SPACs. So, they were SPACs that people said, hey, I don't want to invest in SPAC stocks. They don't have support. They're never going to make it. Well, DraftKings has proven, although they went public via a SPAC, it's how you were born, whether you were, it doesn't matter. It's how you're performing in the public markets. DraftKings did a great job, and Jason did a great job of not only driving revenue, but earnings. Vacasa has continued to hit their numbers and have been undervalued largely because they're a smaller cap stock. CCC has a great long-term business with great moats, but people might have overlooked them because they were a SPAC. And now I think the best investors are going back saying, hey, did people paint these with too broad of a brush, and now we have to get granular on what the quality of the business is.
How does the role of these founders now change? Even for companies that have been public.
Yes.
You don't have to use Jason as an example, Jason Robbins at DraftKings, but anybody, when now investors are going to be much more, have much more scrutiny over profitability. Correct. It's not just going to be great idea. We're going to bet 20 years from now you're going to be profitable, so we're going to give you a massive multiple and we're all in. It's not going to be that way anymore.
People came out. I mean, those people in the public markets traded out.
They sold those stocks.
And so now you're looking at people who've been able to perform both tricks, right? People that said, hey, I was able to get money in maybe 19, 20, and 21, where growth was the key metric, and I was able to drive growth and market leadership. And then as the goalposts changed, I was able to quickly pivot my business, drive my culture to drive to profitability. And now, coming into 24, those are the best CEOs who are able to say, hey, I know both tricks. I'm able to run an efficient business, and I'm able to both drive top line and bottom line, and that's why I have a market-leading company with important tailwinds, and that's why I'll continue to be important.
Got to spend a little bit differently. Obviously, raising capital is not what it was, where the cost of capital is just exponential.
And recruiting and retaining employees and telling them what's going on.
Rick, I appreciate it very much. Thank you. Rick Heitzman, First Mark. Right back on Closing Bell. Up next, we're tracking the biggest movers as we head into the close. Pippa Stevens is standing by once again with that. Hi, Pippa.
Hey, Scott. Two automaker names are stuck in neutral after Wall Street downgrades. We've got the details coming up next.
Citibank. Oh, nice little pop on Citibank. I was looking at this double bottom here. I just didn't call it out. Then bam. This one had real bad earnings. When I have a real good sense of when things are overbought and underbought. Boeing is a great example. And this is when I went long in. So you're sitting here with butterfly wings or bat wings or whatever you want to call it. A double bottom at 120. We got in this trade and it dipped on us just a little bit. I said, no, hold on. Hold on to it. And it ran all the way to 160, 172. Then it came back down again. And we had a double bottom. I was screaming, it's cheap. And back when this bounce came, I wrote a song about cheap. The month to remember. September is the month to remember. And then all of a sudden, in 1 year, it went from 120 to 260.
Buy Buzz today.
Then the bad news comes in.
We are fast approaching the closing bell. Let's get back to Pippa Stevens now for a look at the key stocks she's watching.
This is a double top
Rivian shares are lower as Deutsche
on a
Bank
3-year
cuts the
time
stock for a
frame.
hold. The firm saying their
No, what's she saying? Double top on the 3-year.
gross margin expectations, as well as questions around the company's R2 model, including timing of capital needs, production ramp, and profitability. And staying in the auto space, Ford in the red following a downgrade to neutral at UBS. The firm said the stock is fairly valued and it sees more
Ford?
limited upside to estimates for this year and next. Scott?
Pippa, appreciate it very much. Pippa Stevens. Still ahead, shares of Disney are dropping.
They want to buy it cheaper because it's not fairly valued. It's undervalued right now. It's under the 200 SMA. They want to buy it cheaper. Fairly valued would be at 20 bucks. 25. And I remember when they were pumping it at 20 saying we're going to go higher. Ford's got that new F-150. The EV, when it had the EV run. IBM was another one that I said was cheap back then. We had the double bottom down here, the 1, 2, 3 bits. Boom. Then it pulled back with a double bottom. Boom. So 120. I called this one out too. 120 all the way up 40 bucks. SPY moving up. Damn. Sam. Jeez. 440. Tesla downgraded? I don't think so. It's always getting beat up on. Tesla staring down your growing pains. No downgrades.
We have a quick programming note for you. This Friday, I'll be broadcasting live from the American Express PGA Golf Tournament, PGA Tour Golf Tournament. Big slate of guests on deck, including Delta CEO. That will be at 8 a.m. The CEO of American Express at noon on Halftime Report. Stephen Squarey joining me in an exclusive Market Zones next.
Got more green on my ticket. Not much. Well, Yeah, a little bit more green on here.
With Vocalax.
DWAC's about to hit my 2244.
We're in the closing bell market zone. CNBC senior markets commentator Mike Santoli here to break down the crucial moments of this trading day. Plus Julia Borston on the fight for Disney board seats, and Kate Rooney looking ahead to Discover Financial. Those results are out in overtime. Mike, your thoughts on this day?
Things stayed within the rails. You know, it could have been worse, I think, given that we've had a really weak underlying tone to the market, definitely in pullback mode for a while. You know, we'll see if this is a real lasting show of resilience above 4,700 in the S&P or not. But we do, I think, you can now say if we did get over our skis in terms of getting too bullish, getting too aggressively positioned, assuming the soft landing was in the bag, it happened a month ago. And we've been basically paying for that for the last 3 or 4 weeks because we've made no progress. The average stock, you know, half the S&P is 10% off its high, off its 52-week high.
10%.
So underneath the surface, I think we've been coming to terms.
That's
with
my
this
number.
idea. So far, still in routine pullback mode. We knew we needed it. We're checking back to mid-December levels. I still think 4,600 is the line between routine pullback.
I said that too.
And something worse.
At 425 is sort of your line on the 10-year
Essentially where it goes, and again, that takes us back to the
Who's
Fed
this
meeting
guy?
in December. That's more or less where we started things.
All right, so the latest chapter in the Disney Pelts Chronicles was released today. Julia Borston.
No, I didn't say that.
What's in there?
Well, Disney shares are down about 3% today. On a Barclays note out warning.
Oh, yeah.
that,
Yeah, I
there's
did.
A whole lot of noise and very little light.
I did
at
say
the
that.
moment in Disney, pointing to the risk that Disney's proxy battle with Nelson Peltz distracts management from the critical strategic decisions which could shape the company's narrative for years to come, mentioning the sale process for Disney's India business, the upcoming deal renewal with the NBA, and finding a new partner for ESPN. Now, all of this comes on the heels of Disney releasing its preliminary proxy outlining its case against the nomination of Nelson Peltz and Jay Rizzullo for Disney's board, saying that Peltz has not presented a single strategic idea and that Rizzullo's experience was outdated. Disney saying that Iger has made considerable progress on its strategic priorities. So we'll see how this all plays out at the annual meeting.
Certainly will. All right, be interesting. Julia, thank you. That's Julia Borston. Now to Kate Rooney on Discover Financial, because those results are coming out in OT. What do we expect?
Hey, Scott, so for Discover, watch credit card delinquencies. Back at the end of November, delinquencies had climbed to 1.54%. That was up from 1.47% at the end of October. Charge-off rates also climbed at the end of last year. Investors are looking to see if there's been a peak in credit losses, also watching for some commentary around the possible reinstatement of regular share buybacks and the sale of its student loan portfolio. And then there's compliance-related costs. Discover's CEO left abruptly in August amid compliance issues, namely an SEC investigation around misclassifying certain card charges. Discover has said that could result in enforcement actions or monetary penalties. There may also be some commentary around that leadership shakeup that's expected earlier this month. Discover appointed Michael Rhodes as the new CEO and president. That is effective on or before March 6th. Scott, back to you.
All right, Kate, we'll see what happens. Kate Rooney, again, Discover Financial and OT, so make sure to stay tuned to that. You heard the sound effects, so we're about a minute left here. But Dow's come off its lows of the day. I mean, the market, to your point, is just kind of just hanging in there in the face of a lot.
I mean, and the question is whether it's kind of forestalling, you know, something that we need, which is to pull that slingshot back a little bit more.
Okie dokie. But yeah, he's right. 4,600, that peak. I mean, that'd be a lot bigger correction. If we're down 10% already, that's what I was looking for. But we could easily, like I said before, in all these other trades that we called out, that was my support. And I got it recorded back at the end of the year, the double top, when we hit the double top. You can go back and watch that video, and you can learn quite a bit from that. I knew we weren't going to break it. I had a real good reason. These three candles here, each one of them represent a year, and that's a triple top. And if you Google triple top, Triple top is a technical chart pattern that signals that the asset is no longer rallying and that lower prices are on the way. Here's a website for anybody that wants to look things up. I use this here website a lot when I was begin trading. And I'll put this in the room and in here on Jimmy said it first. So I'm going to get out of here. Triple top, 1, 2, 3, boom. I got to bring some of my emotion out of this here, because I like to sit here and argue with these guys. And I swear we got a mole in here. Going straight to Jim Cramer and say, Jimmy, yippers, everybody have a great night. I'm going to relax. Watch my little YouTube videos and get a good night's sleep. I'm real tired. So, thanks a lot. Yabba dabba doo. I don't want to keep sounding like I'm a broken record. So I got to come up with some different stuff.